Hello, bankers. A very good evening to all of you. Welcome back. So, guys, in this particular session onwards, we are going to start with our AFM Module C, right? So, when it comes to Module C, it is all about financial management. Okay? So, it includes form of business, different type of businesses, which we have discussed in our Module B itself, right? Company is or sole proprietorship, limited liability, and others. Then financial decision in a firm and what are the core components of those decision making. Objectives of financial management, fundamental principle of finance like opportunity cost, time value of money, and others. Building blocks in financial modern finance, which include planning, organizing, and all. Risk and return trade-off. Again, higher the risk, higher the return. Then we have agency problem and ethics and social responsibility, organization of finance functions, relationship of finance to economics and accounting, emerging role of finance management in India. Okay, so these are the subtopics and these are very basic one. You can expect half to 1 marks question, and even that question will be based on or that can be covered through the other topic also. Okay, I'll never suggest any sort of like one time you could watch this particular one for a safer side. Okay, if you left with only one subject, but if you are going in a first attempt, if you want to skip, you can for this particular, because all these things which we are going to discuss in detail with the remaining units and all, right? So guys, when it comes to financial management, so basically what we are doing here, we are doing some sort of investment management, right? We are doing some sort of portfolio management, wealth management again. And whenever it comes to this particular job, so there is a category or there is a department called investment banking who generally take care around these one. Again, when it comes to investment banking, they have two primary role. They generally cater to their business type is B2B. Okay? So they generally help MSMEs and others. And underwriting and that mergers and acquisitions are the core role which is generally played by this one. Okay? Now, this is something when a company is making some sort of capital decisions, like capital budgeting. Let's say you want to expand your business, okay? And for that expansion purpose, let's say you are deploying 100 crore rupees in your business, right? So, first of all, what should be your capital structure, from where or from what sources you are going to arrange that particular funds. So that is your, like we have two things with two major component. One is equity, another one is debt. So we capital structure is a combination of debt and equity. So now what should be the optimal capital structure for a business? That depend on the business type. You cannot fix it, is not a kind of universal things, right? So then that is part of capital budgeting and capital structure. Then you have, let's say if you have 100 crore rupees in your hand, you'll have multiple alternates. So what are the best alternates, where what are the best project where we can maximize our ROI, return on investment. So for that sake, we have capital investment methods, the different theories and others. And whenever it comes to the investment, so it follow the trinity of risk, return, and liquidity. So there are so many things. We have to consider the time value of money. We have to consider the liquidity aspect or the taxation things and others. That's generally part of this one. We'll come to all these particular one, but first we will start things with our the very first one is types of companies, which we have already discussed in our module B, that company accounts. Let's have a quick look, right? So we have sole proprietorship. Sole proprietorship is something, let's say as an individual, you have started a business called in the name of, let's say there is a Mahesh enterprise, or there is a Suresh enterprise, there is a Rohan enterprise. So that is a sole proprietorship. Okay? So where like it is something or similar to a individual who is working in some organizations, which is in, while we work with the organizations, we work on payrolls. So the taxation things get deferred. When you are working, or you, let's say you are providing some sort of services, like let's say you are a CA, you are providing consultancy to different companies. Or let's say like in case of me, let's say I am delivering these particular classes for JIIB, CIB or UPSC or regulatory bodies and others. So that is something, while we do the taxation things, that is a part of sole proprietorship, right? So where we have only one owner. So owned and run by one person. Owner and business are legally the same thing. Usually in other case, in case of company, we have to follow the entity concept, right? So where owners are different from the businesses. Business is a separate economic unit, right? In this particular case, that does not get applied. Again. Profit tax as personal income. Simple, minimal regulations, but limited by the owner's resources and capital itself. Okay. Partnership firm where we need minimum 2 and maximum 50 partners, and we have to follow the partnership act आपका, ठीक है. So here basically we do not enjoy the perpetual succession. It is like, let's say me and you started a business called A and B Private Limited, again, or partnership firm. So where we are delivering some sort of services. Okay? We have an agreement where we have a division of capital or the ownership in that particular one. Once there is something happen with one partner, that partnership deed will got that will get ended. Okay? So there is no perpetual succession in this case, right? So governed by the Indian Partnership Act 1932, involve two or more peoples with an agreement to share profit. Partners have unlimited liability. Okay? That means any responsibility that will belongs to those particular partners. Okay? Can have maximum 50 partners. No separate legal identity from the partners. Registration is optional in this particular case also, right? Next one. Limited liability partnership. So that is introduced by the LLP Act 2008. Combined feature of partnership and companies. It's a kind of a midway of a company or a partnership. Partners have limited liability up to their contribution in all. Must be registered with a registrar of firms. Separate legal entity, which is a company features, unlike a normal partnership. Hindu undivided family, HUF. This is something which is the Karta, who is the head of that particular family, who is he is a kind of a CEO of that organization. And the things they get passed from the, like, let's say there is a senior citizen, Dadaji, and we have the family tree. Okay? So whoever is the senior most, he will be leading that particular business. Okay? Exists only in India under the Hindu law, based on the birth in a Hindu family, not by the contract. Okay? Managed by the eldest male members, which is called Karta. Okay? Separate entity for taxation purpose also. Then association of person or body of individuals. Okay? Group of persons, natural and artificial, joining a common purpose. AOP include individual or entities. BOI only individuals. So here it can be entities also, the other registered companies and all. So both are separate entities for taxation under the Income Tax Act. Company, this we have discussed in detail. An artificial person created by law, have so many features like perpetual succession, shares limited by the ownership or the face value, or there is no minimum paid up capital now. And the other feature also. So association of persons contributing money or money worth to a common stock of the common purpose, created and governed by the Companies Act 2013. A company is a legal person with right and obligations, but without physical existence. That's why it is generally known as an artificial person. And stamp, I hope you remember that one. So recognized as separate legal entity distinct from its members or owners, can be a different type, like one person company, or we have the types of companies, I hope you remember, on the basis of ownership: private company, public company, government company, statutory company, or a chartered company. On the basis of holding, shareholdings, we have different type of companies, or we have like subsidiary, associate holdings and others, government company and others. Then we have on the basis of liability, limited liability, full liability, guarantee and others. They are generally part of this. Then we have cooperative societies also. So a business organization where individuals join to promote common goals. Main objective is mutual assistance and service, and usually these are for non-profit making. They're registered under a law and recognized as a separate legal entity, independent of its members, can own property, sue and can be sued, similar to company, managed by a committee elected by the members itself. Okay, so these are the different form of business which we generally have in our in India itself, right? So now, financial decision of a firm. Okay, so whenever a company make financial decision, there are so many factors. We can have two major categories: internal, which is something which is related to that company, like capital structure, or it can be external, like business environment, or the overall business scopes, customers and others. Okay? So they are generally part of this one. Okay? So this chart will help you. Type of financial decision, we can have capital budgeting. Okay? So when it comes to capital budgeting, there's something where we are planning for some expansion, okay? Application of funds. Okay? We are using funds for the expansion purpose. So that is the one. Capital structure, which is a combination of equity and debt. Okay? So let's say if we are investing 100 crore rupees in our business, out of 100 crore rupees, how much we have raised through equity or how much we have raised through the debt portion. Okay? So procurements of funds, which is generally known as. Okay? Then we have dividend decision आपका, ठीक है. So dividend is something which is a portion of profit which we distribute among the shareholders of that company. Then working capital management decisions, ठीक है. This is something again the day-to-day working, how we are managing our business activities, how much money will be required and how much money we should hold so we can smoothly run our overall activities. Now, when it comes to these many subtopics, so capital budgeting a separate unit, capital structure separate unit, then we have dividend will definitely come with these particular one. Working capital, we have a separate units. So all these things which we are going to discuss in detail in this one. Okay? So financial decision, आपका investment decision. When it comes to investment decision, it is about capital budgeting and working capital. Okay? So capital budgeting, which is assist through the आपका capital structure and capital investment decision. Okay? Capital budgeting is, let's say, how much money we want to start or invest in that particular business for the long term. Okay? Capital investment are generally usually long term in nature. Okay? They are expenditure on creating property, plants, equipments, goodwill and others. Okay? So let's say there is a firm who is planning to invest 50 crore rupees in their business for the expansion purpose of their product or their overall services. So now then we decide what should be the capital structure, what should be the contribution through the equity or through the debt. Okay? Then we whatever money we have, let's say we have 50 crore rupees. So what are the best alternatives available in the market? So we do the project appraisals and all. And working capital, which is something our day to day, how we are meeting with our current liabilities. It is a combination or sync between current liabilities and current asset itself. Financial decision, financing decision आपका, ठीक है. So this is the structure: equity, debt and financial institution. ठीक है. Debt and equity, which is a structure. Structure means, let's say if we are raising let's say if you are planning to make a capital investment of 50 crore rupees. So out of 50 crore rupees, what will be the portion of equity and what will be the portion of debt? Let's say we are planning for a debt to equity ratio of 30:70 आपका, ठीक है. So that means, let's say for this particular firm, this is the optimal capital structure ratio. That means 30% of 50 crores will raise through the equity and the remaining 70% will take in the form of debt. So this is outside liability also. Here you do not, in this particular case, you do not have to pay any interest and all, but you will lose some sort of degree of control in your business. But when it comes to debt, in case of debt, it is outside liability, but you have some advantages like tax benefits or whatever interest you will pay, that will be accounted as operating expense during your profit and loss accounts. Okay? And you will have financial leverages also. Financial leverages is like, let's say your company's valuation before this borrowing is supposed at 100 crore rupees. Okay? Now with if you'll raise funds through equity, there will be no change in this market value of this company. But if you raise funds through debt, so it will directly increase the debt portion. Let's say it is 30 crores. So it will directly increase your company's valuation by 30 crores. What we are doing, we have borrowed 30 crore rupees, let's say on an average of 8%. Okay? And now we are deploying that particular money in our business, and our ROA should be greater than 8%. Let's say your ROA is 10%. So you are making 2% profit from that particular one after returning the 8% of the investors. Okay? Then dividend decision aapka, it can be, we can have two things. Let's say we made a profit of 10 crore rupees during that period. So how we want to distribute that particular one? Profit and loss appropriation account. Let's say out of 10 crore rupees, we distributed 3 crore rupees among the shareholders. Okay, that is dividend in the form of dividends. And the remaining 7 crore we reinvested in our business. That is your, or we kept in our reserve and surplus. So that is your retained earning, right? So that will be liability in that particular one. So this is something. Now, when company should announce dividend, how company should decide this optimal ratio? It should be 30-70 or 50-50 or 70-30. Okay? So what should be the optimal ratio for that organization, or what should be the sources, or which project we should adopt? That all things that generally comes under the financial decision. So these all things we will be discussing with the help of capital structure, capital budgeting and capital structure, cost of capital, and your investment decisioning. Okay? So they are generally part of your curriculum. Now, financial decision of a firm. Okay? So first, these are some major elements. Estimating capital requirement, how much we should invest in our business. Okay? That is the one. Deciding the structure, a combination of equity and debt. Okay? So what should be the optimal ratio for our business? Deciding source of funds again, from where we will be borrowing that particular money. Okay? Equity, should we go for the common equity or preference shares? Debt, should we go for the bonds or debentures or a bank loan? Okay? That is a source of funds. Okay? Uses of long-term funds, where we are going to invest that particular money so we can maximize our return on investments. Okay? Corporate strategy, should we go for any sort of corporate strategy like mergers and acquisition and all these kind of things? Apart from this, uses of short-term funds or working capital, how we can effectively use our working capital money, like how much money we should kept in current assets so we can easily meet our day-to-day requirements, or it should not be like under or over. So if it is under, so maybe you will quickly enter into a risk of liquidity. If it is over, you are not utilizing your funds properly, right? So then we have this we will learn through the working capital and ratio analysis. Financial control आपका, the utilization of funds. Compliances we have to meet with this one, and investment decision and retained earnings. And this is the one. Basic things. So all these things will come with the help of your one by one topics. So objective of financial management, it help organization or businesses to optimum utilization of funds. It takes sound capital investment decision. So where you have 50 crore rupees in your hand, you have multiple projects. So which project will have or will give the maximum return to our business, or where we have maximum suitability? So that you will get to know with this. To decide the optimal capital structure, so it should be 50-50 or 30. Capital structure is combination of equity and debt. So what should be the optimal capital structure for your business? 50-50 or 30-70 or 40-60 or 60-40, these kind of things. Ensure statutory and regulatory compliances. Ensure balance between shareholders' benefit and organizational objectives through the stakeholders theory. To ensure appropriate financial risk management system. Very simple one. This get asked so many times, and maximum 90% people they correctly answer this one. Now the next one, key principle of finance. So when it comes to key principle of finance, I hope you guys are aware about these particular thing a little bit. So first one is time value of money, then opportunity cost, risk and return, liquidity and return, diversification, reduce asset liability mismatch, and cash flows. Okay? So these are the elements of this particular one. So when it comes to first one, time value of money. Time value of money is something which is like in 2025 and 2000, let's say 30. So if you compare rupees one, okay, so it is so obvious like when it comes to the present value of this and that present value of that. Okay? So today's rupee one have much higher value than compared to this 2030s rupee one. Okay? Because just a simple idea is your inflation. Okay? So inflation will grow during these 5 years and the value of 1 rupee will come down, or else we have opportunity cost. Okay? So opportunity cost is like, let's say if we have let's say if you gave me 1 rupee today and after 10 years I return you only 1 rupee, so you miss that opportunity cost, right? So if you have invested that particular 1 rupee for the 10 years, it might become 2 rupees or 3 rupees. So that is something which is very important in this. Okay? So while we discount the cash flows, right? While we do the appraisals of any project, or while we do the capital investment decisioning, there is a method called net present value. So where we will be using time value of money concept. So first one, ठीक है. So opportunity cost आपका, ठीक है. So here, if you have, let's say, cash or the equivalents in your hand, ठीक है. So if you invest that particular one, you can get some sort of return during that particular period, ठीक है. Or you have multiple alternates. So investing in best, let's say if we invest in project A or B. So what is the opportunity cost? If we would have invested that particular money in B, so is there any positive side or negative side? Risk and return आपका, ठीक है. So simple when it comes to risk and return payoff. It is as simple as that. Lower risk, lower the return. ठीक है. This is suppose that risk and this is your return. ठीक है. And higher the risk, higher the return. Like if we deposit money in saving accounts, this is something like this. If we invest in joint ventures or stock equities in others, so high risk, high return. Okay? That is the simple rule. Liquidity and return. So while we make investment, okay, so we also have to consider the liquidity factors. Liquidity factors is sometimes, let's say, if we are investing in some securities, they are blocked for 10 years. Now, if you require some sort of emergency funds, so how you will manage that particular one? So you do not have to invest in single type of securities. You do not have to deal with any sort of concentration risk. You have to diversify your portfolio properly. So you can have some liquid asset, and if you find some better opportunities in market, after converting those particular one into cash, you can make the you can encash those particular opportunities also. Okay? So again, what return we are getting and what liquidity we are achieving through those particular one. Diversification, don't put all eggs in one basket. Okay? So like investment should be like this. आपका not like this. Okay? So there is a two banks, let's say, one who have invested like this, another one who have invested like this. Okay? So here they have maximum concentration on this security A. Okay? If something happened bad with this security, your half of portfolio will vanish. So that is the case. Asset liability mismatch. Okay? If there is a asset liability mismatch, okay, so you have to fill that particular gap, especially in case of bank. Let's say your receivables through the asset is scheduled for 15, but your payables are on first. So there is a gap of 15 days or 14 days. How you will manage that particular one? So that is the one. And also the cash flows. Okay? So if you are investing in any project, after how many years that will start giving you inflow or cash flows in others, that also you have to this. Okay? So we generally follow the discounted cash flows in others. Okay? So these are some key principles of your finance. Okay? Here you have explanation also. So quickly read out these ones. So time value of money. Money today is more valuable than in the future, okay, due to inflation and earning potential, opportunity cost through the investment. People pay interest to borrow money because of the this principle. Okay. Opportunity cost, investing in one option means sacrificing the chance to invest in another. used for evaluating both new and existing investment. If old give lower returns, then may we have to replace it with the new one. Okay. Risk and return, higher the risk, higher the return. Higher risk usually higher returns, lower risk, lower return. Every investment can carries both profit potential and losses. Investor must carefully balance risk and rewards. Liquidity and returns. Liquidity, which is after how easily you are able to convert your money into cash. Highly liquid investment may offer lower returns, while less liquid offer higher returns. Okay? Important for investors to consider marketability along with the profitability. Diversifications should spread across the multiple investment. Avoid concentrating money that done by that company. Okay? So follow the idea of do not or don't pull all eggs, put all eggs in your one basket. Okay? In one basket. Okay? Reducing asset liability mismatch. Okay? Long-term funds need should be financed by the long-term sources. Short-term needs should be met with the short-term sources. Cash flows. Okay? So two key aspects: balancing inflow and outflow to ensure liquidity, applying the time value of money by discounting cash flows to present value. So that means what does it mean? It is get applied in NPV also. Let's say if we are investing in a project, let's say where your outflow, there is a project for 3 years, and the outflow is suppose that 5 lakhs. The present value of this outflow is 5 lakh. Okay? So initially you are investing 5 lakh rupees. Year 1 you getting 1 lakh rupees. Year 2 you getting 3 lakh rupees. Year 4 you are getting 2 lakh rupees. So overall in general you are getting 6 lakh rupees. So that means if you invest 5 lakh today, you will get 6 lakh rupees in future. But this is not that investment decisioning. This is on the basis of this outflow or inflow, you are not going to make your decision. Reason, time value of money. So this is the future value of the money. At the end of first year or at the end of third year, you will get this much of money, right? So first you have to calculate the present value of future inflows. If it is greater than others, so if it is greater than 5 lakhs, then only you have to invest. Let's say this is after 80,000, this is after 2.5 lakhs, and this is supposed that 1 lakh. That means it is less than 5 lakhs. So there is no return from this investment, and you should avoid this kind of investment. So that is comes under this. All right. Now, when it comes to modern finance, modern finance, which is a process driven. Nowadays, we do not make random decision in all. So we do a proper planning, and then we organize things, means allocation of resources and others. Then we make the decisions. So according to the traditional approach, finance function consists financial planning, raising of funds, allocation of funds, and financial control. So this is something आपका planning, raising funds, allocation of funds, and financial control. Modern approach consider that the corporate finance function should 4 blocks. One is planning, decision making, organizing and directing, and controlling. This is something which is also part of your management functions. When it comes to management functions, so planning, organizing, staffing, directing, controlling. So similar planning, then आपका decision making, organizing and directing, and आपका controlling. Means you have to plan where we need to invest and how much we need to invest. Then we have to find out the alternates, and we have to make decision about that one. Then we have to organize whatever money you have, how you are going to allocate that particular one. Directing is आपका proper control around that things. So directing is something where the execution part of that particular investment. Controlling, which is part of the planning. Your degree of control is decided by degree of plan. So controlling, which makes sure your plan got achieved. So that is something which is generally part of this. So risk return trade-off, this we have discussed earlier also. So let's say if this is return and this is risk. So lower the risk, lower the return, and higher the risk, higher the return. So we have so many examples for this one. Very simple one. Now, theories of conflict of interest. Nowadays, all these businesses, especially in case of a company, they get like company is an association of person which who generally contribute money or money worth to achieve a common purpose. ठीक है? Company is an artificial person which is created by law. As per the business entity concept, company is separated from the owners of that particular one. Okay. So now, while we run this particular one, there is two things, two type of businesses or the business activities or companies activities get governed through two ways. One is agency theory, another one is stakeholders theory. When it comes to agency theory, where basically promoters or shareholders they appoint some representatives in the name of board of directors, and they make decisions on behalf of these particular one. Okay? So now when it comes to agency theory, what challenges we find with this particular one, कि sometimes these persons, those who are actually running this business, so they give more preferences to their personal interest rather than the all the stakeholders interest. Okay, let's say you XYZ, you are running a XYZ business, you hired three board of directors. Okay? Now they always try to please you because their job is like to keep you happy, or you will get happy with your while they maximize your return. So they are only considering the written part. They are not considering the other stakeholders like customers, employees, and others. Because that happened in this one. Okay? So that is agency theory, where principal means the owner of that business. They are appointing some agents, and these agents are running the business or they are making the decision. Okay? And there is some sort of lag in this particular system, okay, if it is properly not monitored. The another one is आपका stakeholders theory, where we have like nowadays the corporate governance of the country itself, they generally support the stakeholders theory. Stakeholders means we have anyone who get affected by the company's decision. Okay? It can be internal and external. Internal like the employees, the management, the shareholders, the owners, or external means the customer, communities, societies, and others. So whenever you are making decision about that company, you have to consider, or you should consider, all the stakeholders of that particular organizations. So everyone or so we can able, or we can make some sort of fair decision of for the situation itself, right? So agency theory, so where principal they generally hire the agents आपका, ठीक है, and it have been noticed that like so many times they generally start working in self interest, okay, where they are doing things which is eventually going to benefit them, right? So not to the company and others. So that is a major problem with this, okay? So agency theory describe the problems that occur when one party are representing others party in business, holding different views on key business issues. Okay? The agent may follow personal belief to influence in a key business decisions. Okay? So they are eventually trying to meet their own goals. They want to keep their principals happy, just principal, not the other stakeholders. Okay? Other stakeholders like management, company, and employees, or the customers, or the communities, they are not bothering around those one, right? So the another one is stakeholders. When it comes to stakeholders, okay, so nowadays we generally follow this particular one through the corporate governance itself. Okay. So we have company, we have stakeholders. Stakeholders like shareholders, employees, customers, creditors, and others. Okay. So whenever we are making any decision, we are considering all these particular one. Okay. So this is आपका stakeholders theory. So stakeholders आपका theory which include the interest of each and every party which get affected with the company's decision. Okay? As simple as that. So this is something where we generally. So for this one, like who make these decision? Board make decision. Okay? So like to protect the interest of shareholders, we have independent directors in our board. To protect the interest of employees, we have directors who been part of that organization from long time, so they can present the interest of this one. We have some external directors and others. So that composition of board that help us to achieve this particular goal also. Okay? So stakeholders theory highlight the differences of interest between individual within an organization such as employees and investors and suppliers or the local communities. Apart from this, we have given ethics also. Okay, ethics in business. Okay, so ethics is basically all about rightfulness and wrongfulness. Okay, what is right, how to achieve that right, what is wrong, how to avoid that wrong. Okay, so for that sake, we have every organization, they have some ethical principles, or these are some guiding principles which generally help them how to deal with any sort of ethical dilemma. Okay, ethical dilemma is basically selecting between two rights. So there is, like, sometime it happened na? So we have two rights. Aapka now, if you adopt this, there is some stakeholders, they'll get hurt with this decision. If you select this, there are some stakeholders which will get hurt with that particular one. So what decision we should make in this kind of dharma sankat or dilemma? Okay, so if we let's say if we finally adopt this, why we have opted this, and what will be your justification to these many stakeholders and all. So ethical principles or ethical norms are some, these are some sort of guiding principles to our actions or to our decision in the business itself. And ethics is very important in every business nowadays. So because your one wrong steps that can destroy the entire organization. So the code of conduct adopted by an organization is affected by both nature of company or business location and all. So the broad principle or code of conduct or ethics in business, like personal responsibility, corporate responsibility, so individual ethics or upper corporate ethics, corporate transparency in their finance or the other, even let's say as an employee also we want transparency in policies. As a stakeholders or as a shareholders, we want transparency in your final accounts and all. Okay? Honesty, very simple. Integrity, promise keeping. Okay? So you are not making any false promises to your employees or your customers. Trustworthiness, loyalty, fairness, concern for others, respect for others, and customer prioritizations. Okay? So whenever it comes to ethics, ethics is all about good or bad, and the theories or the ethical studies which generally taught us how to achieve that good and how to avoid that bad, right? The another part is social responsibility. Okay? CSR, corporate social responsibility, which is something which is linked with the corporate governance topic. Okay? But in your curriculum, these all topics, like if you study ethics for UPSC or regulatory bodies, they have like entire books for that one. Okay? If you study corporate governance or CSR and others, so we have very detailed topic. But in your curriculum, I guess this is the final time where they have discussed around the CSR ethics things and all. Ethics, we have one module in your PPP, that module D. So around 5 to 6 sessions are 6 topics are there, and that is very important. Again, whenever you go for any sort of certification, like in case of a CFP, so in every examination or every level, means level 1, level 2, level 3, they have given 15% of weightage to your aapka ethics topic, and this is like, which is very important for all these kind of certifications and all. Okay? So now the another one is social responsibility, which is majorly optional in most of the countries, but in our country it is a legal activity. Okay? So it is legal when you meet those particular requirements. Okay? So section 135 of Companies Act 2013, which generally define the CSR activities. Okay? So we have two type of activities. One is called social responsibility. Another one is environmental responsibility. This is as simple as that. Like, let's say you are running a business in a society, so you are taking some advantages from that society, so in return you have some responsibility toward that society, right? So like you are an artificial person, like let's say we are living in a society, so we do have some responsibilities towards society, family, and people. Similarly, you are also an artificial person, so there are some responsibilities that belongs to you, that you have to like you have to pay back to the people which are generally part of that particular one, correct? So legal aspect of CSR, mostly it is optional, But when it comes to India, so it is legal. So you have to spend 2% of your net profit of last 3 years in CSR activities. Okay? In PPP also, we have this one, and so many times they ask one case study around this one also. Okay? So in India, most companies are legally required to spend at least 2% of their average net profit from past three financial year on CSR activities in current year's team. Companies must disclose CSR activities separately in the annual report of Board of Directors. The statutory requirement is laid down as Section 135 of Companies Act 2013. The Act also specifies the type of activities can be undertaken, like social responsibility and your आपका social responsibility. In AFM also we have this social responsibility as well as environmental responsibility, and even there is some penalties also. Earlier it used to be criminal offense as per this Companies Act 2013. In 2019 we changed this from criminal offense to civil wrong. Now it is categorized under civil wrong. The difference is, in case of criminal offense, we can, or the owners or the CSR persons or the head of that particular one, they can face any sort of imprisonment also. Okay? But we remove this particular clause. Now it is aapka only civil wrong. Okay? If any organization or their people, if they do not follow the requirements of CSR, so they'll have monetary penalty. Like company, it can be 1 crore and multiples. And for people those who are part of that team, they can also have penalty of 2 lakh rupees or something. Okay? So that is the case. So this is all about the introduction. So we have meanings of accounting ratios, classification, traditional and functional, uses, limitations. Then we have calculation and interpretation of various ratios, one of the most important subtopic, different users of ratios and their uses, right? So that is these are the subtopics which are generally part of this one. So when it comes to ratio analysis, it is generally part of the interpretations. Basically, we start our accounting subject with the basic things like the recording, classifying, summarizing, reporting. Now, this is the stage of interpretation. So where we are using the final accounts, we will be using final accounts like data from balance sheet or profit and loss account, and we'll making some sort of comparison, and we do have some ready-made tools or financial models. They are generally known as ratio analysis, right? So it is majorly part of the decision making and interpretations, which is used by the different stakeholders. Like it can be managers to make decision about the efficiency of the business, or it can be any external stakeholders about the profitability or the decision making related to shares, EPS, DPS and others. They all generally comes under this particular one, right? So when it comes to ratio analysis, as I said, it is part of the interpretations. Okay? So with the help of these particular ratios, we generally make some sort of financial decision about the organization. Let's say you are an investor, you want to invest in some company's shares. So for that one, you have market prospect ratios, like you have earning per shares and PE ratio, price to earning ratio. If you are dividend oriented, so it is DPS, dividend per shares. So dividend payout ratios and others, they are generally part of that particular one, right? So now, like let's say if you want to check the profitability of that particular firm, so we have gross profit, operating profit, net profit. If you want to check how this company is going to meet their short-term requirements, so for that sake, we have that gross profit ratio, or that cash ratio or liquidity ratios basically. Okay. If you want to check the solvency of that particular business in long term, so you have solvency ratios like debt to equity ratio, debt coverage ratio, interest payout ratios and others. They are generally part of this one. So basically, it is kind of a arithmetical representations of the financial data, right? So it is not easy to understand balance sheet and profit and loss accounts for all, right? So what we have done, we have developed some financial models by applying these particular one, and if the data is positive side, so you can easily make your decision. You do not have to care about the how that balance sheet is doing, right? So you just have to pick those particular figures, and if these figures are in favorable conditions, so accordingly you have to make your decision. So that is the kind of, like, if people, they do not have understanding of entire balance sheet and profit and loss account, what they are saying. So what you can do, based on the limited data which you will get from the balance sheet or profit and loss account or cash flow statements, you can interpret that particular one easily and you can make your decision itself, right? So ratio analysis is a quantitative procedures of obtaining firms functional efficiency, like how the organization is using the resources, that is generally part of this liquidity, how they are going to meet their short-term obligations. Then we have revenues, like gross profit, operating profit, net profit, or we have profit, revenue and profitability by analyzing the firm records and statements. Records and statement means your financial statements or your income statements and your position statement, means profit and loss account and balance sheet. It is a technique which involve in regrouping of data by application of arithmetical relationship through though the interpretation is complex in matter and all, right? So this is something where, like, let's say if you want to make a certain decision about that business by applying that particular ratio, and let's say if you want to check how that company is going to meet the short term requirements, or how they are going to pay off their liabilities, so you'll use current ratio. If the company's current ratio is in between 1.2 to 2, that means the company is at safer side. That means they have enough cash with them. Or else, if you want to check the company is facing any sort of liquidity issues, or they have some sort of there is underutilization of funds, so again you can check by applying these particular ratios as well, right? So objectives aapka, here now, what are the key objectives which we want to achieve with the ratio analysis? So they help in decision making, majorly saying it can be internal, or the users or the stakeholders can be internal, means the management of that particular business, or it can be any external, like the investors, or those who want to invest in that particular company, or the lenders, those who planning to give loan to that particular company, right? So basically, to know the areas of business which are need more attention, so we will identify these particular areas. To know about the potential areas which can be improved with the efforts in the desired direction, or to provide deeper analysis of profitability, liquidity, solvency. Solvency is basically how this business is doing in long term, how they are using their long term assets and liabilities, like debt to equity ratios and all. Efficiency levels in the businesses also, right? So apart from this, we try to achieve, so provide information for the making cross sectional analysis by comparing the performance with the best industry average, how other companies are doing, and what is the status of any XYZ company or target company. Okay. To provide information derived from the financial statements, useful for making projections and estimate for the future, like how the EPS, what is the current EPS, and how it is going to be benefited if we invest in that particular company's shares and all. So these kind of things which we generally get through this particular one, right? Now, uses of accounting ratios. So what are the primary uses of accounting ratios? Very simple ones, like whatever we have read so far. So this is which is given in your book also. Okay, so this is exactly from your book. So simplify financial statements. Okay, so financial statements, they are very complex in nature, and everyone, they does not have proper understanding of those particular book, like assets, the balance sheet, or the profit and loss account. So with the help of these ratios, we are trying to simplify that particular data according to the need of that particular users, okay, which is generally categorized as functional ratio analysis. So make financial data easier to understand and interpret. Okay. Then we have facilitate inter firm comparison. So with the help of EPS, after studying EPS of 5 companies, you can compare among them. Or after studying the profitability, you can compare among them, right? So help compare different firms, showing strong versus weak, or overvalued versus and undervalued businesses and all. So facilitate inter-firm comparison within organization also. Let's say if if a company is running 4 products, so how these 4 products are doing. Okay? So even you can do the comparison among the products, okay, which is the best product for the company, which is become the burden for the company. So we can eliminate that burden if it is like out of control, and we can work toward we can focus more on those who are contributing more, right? So allow comparison among the different division of the firm, useful for checking efficiency and performance also. So help in planning आपका team, assist in forecasting, identifying trends and detecting future problems, support management in planning, coordinations, control and communication also. So these are some major uses of financial ratios which we usually do in our day-to-day business. Now, when it comes to financial ratios, they do have some limitations. Limitations means like you cannot only rely on these particular numbers. These are kind of a supporting tools. Okay? So while you are making decision about the business or any investment decision, so these are kind of one of parameters. Okay? You cannot make your decision solely based on these particular one, right? Because they do have some limitations. Okay? Limitations like the data which is available, that is the historical data, right? So that is the data of last 5 years. Maybe in future the situation is different, right? And it does not adjust the inflation or the changing norms, trends, and others. Sometimes due to these particular one, whatever output we get, that got failed. So that's why I told you these are one of the parameters to make decision. Investors or the users, they should not make decisions solely based on these particular one, right? So limitations aapka historical information, whatever information we have. Let's say if you are doing EPS calculation, so the profit after tax you are calculating for the previous years, okay? Or let's say if you are calculating some other formulas like gross profit, net profit, that is again for the current years or the past years, okay? So that is sometimes become a challenge. Maybe like right now we are having some sort of the business environment become very complex. Every day there are new things, so these new things can have a positive or negative impact on their businesses. So you cannot rely solely based on these particular one. Another one is inflation effects आपका, ठीक है? So the numbers which we are getting from a balance sheet or profit and loss account, they are not inflation adjusted, right? So that is one effects which will make the decisions bit challenging. ठीक है? Change in accounting policy, sometime there is regulatory environment got changed, so that also makes some impact, a negative impact. Operational changes also. So maybe last year the operation was different, or while we are doing some sort of moving average analysis of last 5 years. So those in last 5 years, the scenario was totally different as compared to the current one. Okay? Seasonal effects also in some businesses, while especially while you are calculating the cash flows, or where we have like there is a construction company who is receiving projects for the long terms or the seasonal things and others. So that can be a problems or a manipulations. Okay? Sometime if there is some sort of manipulation in the financial reports, or your in your balance sheet or in your profit and loss account, that is eventually because we are 100% relying on that data. Whenever we are using ratio analysis, let's say if you are using total assets, so you are picking those assets from the balance sheet, or if you are using current assets, you are using from the balance sheet. If there is some malpractice in those particular numbers or with those numbers, your data or your output will be 100% wrong. So that's why it is always said ki yeah, these are the tools to support your decisions, or your decision should not only based on these particular one, right? So hope this is clear. So limitations आपका the detail historical information based on past result. So may not predict future performances sometimes, or the prediction can be wrong in some ways. Inflationary effect, inflation does not comparability across different time period. Changes in accounting policies after financial reporting, making comparison inconsistent. Operational changes, major changes in operations can mislead comparison of past and present metrics. Seasonal variations can distort ratios if not adjusted. Manipulations in financial reports, ratio rely on reported data which may be manipulated by the management itself. So these are some major challenges, and this get asked so many times for half marks and 1 marks. So please do take care about this one. This is something which is very important, and I have experienced so many times they have asked this particular question, easy to understand. So please do take care about this one. Okay. Now the real game will start from here. So ratio analysis. Now these ratio analysis or the study of ratio analysis is further categorized between two parts. The traditional study or the traditional classification and the functional classification. So when it comes to traditional classification, we have three type of ratios. So traditionally we used to have three type of ratios. One is आपका balance sheet ratio. So balance sheet ratios. Then another one is आपका profit and loss account ratios. Profit and loss account ratio, and third one is composite. So these are very basic. So the previous classification was something like this. So how this classification works? So in case of balance sheet ratio, let's say this is your balance sheet, right? So this is let's say your capital or term loans and others. And here we have suppose that property, plants, equipments, or cash and other components. Okay. So when it comes to balance sheet ratios, it is the classification is when we compare two components, when we compare among two components of or two variables from balance sheet only. Okay. So when we are doing comparison between two variables, and these two variables belongs to balance sheet, so that is balance sheet ratio. Similarly, profit and loss account ratio, let's say this is your profit and loss account statements. Okay. So when we are comparing two variables from profit and loss account only, that is your profit and loss account ratio. When it comes to composite, so when we are comparing one variable from profit and loss account and another variable from your balance sheet, so this is generally known as composite. As simple as that. You just have to remember these three. Okay? Apart from this, all are functional ratios. Okay? So this is something earlier we used to classify the ratio analysis. But now in modern era or in modern finance, we have a classification that is called functional classification. So when it comes to functional classification, it is use-based classification. Okay, let's say if the user want to check the liquidity, liquidity, or which is also known as short-term solvency. So we have liquidity ratios. So that means we should go through only those kind of ratios like current ratio, cash ratio, asset test ratio, and cash and equivalents and all. If you want to check the profitability, so for profitability we have different ratios like gross profit, net profit, your that is operating profit. We have a return on investment, return on assets, and others. If you want to invest in market, so for that one you have marketability ratio or market prospect ratios like earning per share, आपका price to earning ratios and others. They are generally part of this particular one. See, so now functional is basically use-based classification. It is generally known as use-based classification. Okay? So we have two types. Let's go for this one. Okay? Traditional classification, where we have statement of profit and loss account ratio, a ratio of two variables from statement of profit and loss account is known as profit and loss account ratio. Balance sheet ratio, both variables are from the balance sheet. It is classified as balance sheet. Composite आपका, if the ratio computed with one variable from profit and loss account, another is from your balance sheet. So that is generally known as composite. Very simple. Okay? You just have to remember this one because sometimes for half marks they ask some question like which of the following is not a classification of under the ratio classification under the functional analysis. So If you remember all these, let's say, obviously, if it is not out of these three, you'll see one. So if you just have to find out that particular one, and remaining are your functional ratios, right? When it comes to functional classification of ratio analysis, basically we have these major type, like we have liquidity ratios, through which we generally try to check the liquidity, how like what form of liquidity that particular organization is maintaining. Okay, so we have current ratio, current asset divided by current liabilities. We have asset test ratio or quick ratio, quick asset divided by liabilities, current liabilities. Okay, we have cash ratio, cash divided by liabilities, and others. Solvency ratios, so they generally help us to check the solvency or long-term viability of about that particular business. So we have debt to equity ratio, debt ratio, equity ratio, interest payout ratios, and others. We have activity ratio, or it is also known as turnover ratio. So we have turnover ratio, and debt coverage ratio. We have inventory management ratios and others. Profitability ratios, so gross profit, net profit, operating profit, ROI, ROE, these are the part of this one. Market prospect आपका, we have in case of market prospect, we have EPS, DPS, your PE ratios and others. Now, in your curriculum, they have explained all these particular one in detail. In detail means they haven't just the every form of ratio analysis, but they have included few ratios. Few ratios means from liquidity ratio, they have current ratio and asset test ratio. Okay? So asset test ratio, which is also known as quick ratio. So these are the two ratios which are generally part of from this one. Okay? Solvency ratio, in case of solvency ratio, they have debt to equity ratio. Okay? When in case of activity ratio, they have turnover ratio in your curriculum. Okay? Profitability ratio, they have operating profit margin or ratio, gross profit and net profit. All the three ratios are part of this one. Apart from this, they have ROE also. Okay? Return on investments, or ROI. I guess they have ROI only. Okay? So we have return on investment, we have return on uh, assets or equity, all are generally part of this one, but they have in only this one. In case of market prospect ratio, they have only two. One is PE ratio, take a price to earning ratio, and another one is EPS, earning per share ratio. So these are the only ratios which are generally part of your curriculum. So you just have to focus on these particular one, right? So whatever it is given in your book or part of your curriculum, that we are going to discuss one by one. Okay? So let's start our discussion. ROI was the part of this one. Okay? So first one is ROI, return on investment. So yesterday also in the introduction class itself, we talk around this particular one. So profitability ratio, it generally comes under profitability ratio, return on investment. So it is basically your profit divided by total cost. Take a profit divided by total cost. Sometime you'll see this is defined in this particular manner also, or even if you'll open some books, or if you'll do some sort of online checking and all that. Okay? So you'll see like profit or net income divided by total cost. Okay? So it is something ki how like that business is doing. Basically, it is a kind of overall analysis of that particular business, how that business is generating income on year on year basis by utilizing those assets and all. Okay, let's say you have created 1000 crore rupees assets. So how these 1000 crore rupees assets is generating revenue for your business, that we get to know with the help of return on investment. So return on investment indicate percentage of return on total capital employed in business. Okay? Like it is as simple as that. You have invested 100 rupees in let's say in saving account or FD. So what return that 100 rupees is generating for you. Okay? So your income, let's say it generated 7 rupees per annum. Okay? So 7 rupees is your income, and capital employed is after 100 rupees into 100. So the outcome is your ratio for that particular one. As simple as that. Okay? And you have to keep things very simple. Okay? So overall profitability ratio. Okay? So return on investments, operating profit आपका divide by capital employed into 100. So this is the formula. So capital employed means आपका everything which you have invested in that business, like टोटल एसेट्स आपका, ठीक है, फिक्स एसेट्स, लॉन्ग टर्म फंड्स लाइक शेयर कैपिटल, रिजर्व एंड सरप्लस, लॉन्ग टर्म loans minus non-business and fixed asset. So that is generally part of this particular one. Okay. So operating profit आपका, how we calculate operating profit? Profit before taxes. That is your operating profit. Okay. So before profit before interest and taxes. Sorry. Okay. Profit before interest and taxes, excluding non-trading items like government securities and file losses and etc. They are not part of this one. Okay. So like we used to calculate that gross profit. All right, gross profit is आपका sales, net sales minus your cost of goods sold, direct cost. Okay. Then we have in that while we prepare that profit and loss account, we calculated the net profit. Net profit is basically your आपका gross profit minus other income plus gross profit plus other income minus indirect expenses. Okay. So before interest and taxes payment, you will use that particular one, and that is your number itself, right? So significance of return on investment, where we generally use this particular one. So measure profit earn on investment per unit of the capital. As I gave you an example of, you have invested 100 rupees, you get an interest of 7%. Okay? So what was 7? That is your profit, divide by 100 into 100. So this is your profitability, that is your ROI on that particular one. Okay? So it shows the overall efficiency or inefficiency of the business operations. Okay? Useful for comparison across departments, plants, companies and industries and investment also. Again, like if we are investment 1, investment 2, investment 3, department 1, department 2, department 3, or plant 1, plant 2, company, subsidiary A, subsidiary B, subsidiary D. Okay, that is the one. Help judge performance since it consider profit before deductions and total capital like equity, preference shares, reserve and debentures also. Okay. Next one, we will be practicing a set of questions based on all these particular one. Okay. So next one is earning per share. Again, the sequence they have given in your book. So I have aligned the content similar to this. Okay. If you'll study this particular one for exam like CFA, so I'll not teach like this. In that one, we'll be going through the ratio wise, okay? Like liquidity, then solvency, then profitability and all. But in your book, they have a limited portion. So that's why I kept the content limited to that particular one. And I have covered 100% of content, okay? Whatever the overall ratios which are given in that particular one. So you do not have to worry around that one, okay? So EPS आपका earning per share, it is part of the market prospect ratio. So if when investors they plan investment in companies, so they generally do comparison of earning per share. Okay? If I invest in this particular company shares, so based on the past data, how much return I'll get or what earnings we will have per shares. Okay? So how we calculate EPS आपका? Okay. So what is the formula for EPS? Earning per share is equal to your profit after tax minus dividend. Dividend on preference shares divide by number of shares, total number of shares. So that is a very simple formula which you have to remember. So the profit after tax that will be given here in your question itself. That net profit, then we have PAT, profit after tax, the adjustment, interest and the taxes adjustment is already done. Then we have if dividend is given, so you have to minus that particular one. If dividend is not given, you just have to ignore that particular one, or you have to assume dividend is 0. Divide by number of shares. Okay? So it's the financial ratio that represent how much the company is earning on each shares. It is the key financial matrix to understand the profitability of the company, to understand whether it was undervalued or overvalued. If it is undervalued, we should invest in that particular company. That means we should buy the shares of that particular company. If it is overvalued, if you already have, sell them. Or if you do not have, do not purchase the shares of those particular companies, because if you'll purchase, you are not going to have any return from those particular one. Okay? And how we calculate, this is the one. Okay? And now how you'll get the questions, let's say let's assume प्रॉफिट आफ्टर टैक्स इज आपका 10 करोड़, ठीक है। डिविडेंड इज सपोज, दिस इज आपका प्रॉफिट आफ्टर टैक्स, ठीक है। डिविडेंड इज सपोज दैट 2 करोड़, ठीक है। एंड नंबर ऑफ शेयर्स, ठीक है, नंबर ऑफ शेयर ऑफ दैट पर्टिकुलर कंपनी इज सपोज दैट आपका 1 करोड़, ठीक है। दे हैव 1 करोड़ शेयर्स इन द मार्केट, ठीक है। सो नाउ प्रॉफिट आफ्टर टैक्स, ठीक है। सो इट इज प्रॉफिट आफ्टर टैक्स इज आपका 10 करोड़ minus 2 crores divided by 1 crores. That means 8 divided by 10 आपका 1, so it is आपका 8. So this is the EPS of that particular company. So earning per share of that particular company is 8 rupees in this particular case itself. So that is as simple as that, right? So net income आपका, ठीक है, net income minus preferred dividends divide by weighted average number of outstanding shares. So this is the formula. Now what you have to do, I have kept all the formulas in one sheet, ठीक है. So you can take the screenshot of those particular one, ठीक है. Or what else you can do, you can write down these all formulas, and wherever you study, just paste those particular one. Initially just do the open cheating. Open cheating means, let's say you are solving a question related to EPS. Let's say you won't be able to find out the right answer for that one. Just see the formula. If you do 2-3 times now, believe me, you will be able to memorize or recall this particular formula for the third time or fourth time. Okay? So you do not have to worry around this one. So significance of EPS, earning per equity shares. It generally shows earning per equity shares. Okay? Help determine the market price of the shares, useful for comparing with other companies' EPS, indicate efficiency of equity share capital utilizations, again, assist estimating dividend paying capacity of that particular business also. So these are the uses of it. Okay, so EPS is as simple as that. If a company have 8 crore shares in 1 crore shares in the market, after the when we compare that particular number of shares with the overall profitability or net profit, so that means one share is generating 8 rupees for that particular business, as we discuss in this particular case also. Okay. Next one, guys. Okay, there is one small question. A company priced, okay, this is bit advanced, no worries. Price to earning ratio is rupees 10, and earning per share is आपका 15. So what is the market price of the shares? Very simple question, but you need to know about the price to earning ratio. Okay? So the next one should be price to earning ratio only. Okay? So how we calculate P ratio? P ratio is equal to current market price divided by EPS, earning per share. Okay? So now in this particular case, P ratio is already given, which is 10, and current market price you have to find out, and EPS is how much? EPS is 15. So it is आपका current market price is equal to 10 into this, so it will become 150. So 150 should be right answer for this particular. Just completely formula driven. Okay? So with the next ratio itself, we will be discussing this. So next one, we have price to earning ratio. Okay? Next ratio, which is price to earning ratio. So it is the proportion of a company's share price to its earning per share. A high PE ratio could mean that the company's stock is overvalued and investor expected high growth rate in that particular case. And how we calculate P ratio? Just again, do remember this formula again. So P ratio is equal to current market price of the shares divided by earning per shares. You'll definitely get one question around this particular one. Most of the time they do not ask question around the EPS. They ask question around the P ratio. How they ask this particular question? So basically, let's say that same question, the previous question. So let's say profit after tax was how much? 10 crores, and dividend is suppose that 2 crores. Number of shares, number of shares was how much? How many? 1 crores. 1 crores, and the current market price of the company is suppose that 100, let's say it is 80 rupees. It is आपका 80 rupees. The current market price is आपका 80 rupees. So if I'll ask you to calculate the P ratio, I hope everybody will able to calculate this one. How you'll calculate it? So now current market price is 80. First you have to calculate the EPS. So what will be your EPS in this particular case? EPS is equal to profit after tax minus dividend, right? Divide by shares, number of shares. So profit after tax minus dividend means 8 crore divided by 1, so it is आपका rupees 8. So now we get to know कि our EPS is 8. So now current market price divided by this. So what will be your correct answer for this one? The company's P ratio is आपका 10 rupees. As simple as that. Alright, getting my point, guys? So share price divided by earning current market price divided by earning per share, okay, which is आपका EPS. So this is the formula which we have practiced, right? So significance, it help show how many times earning are overrated by the share prices, okay, or the current market prices. Help investor to decide whether to buy share at the current market price or not. Reflect investors' expectations about the future earnings. Okay? So, like if the investors are investing, that means they are that means after the prices will go up in the near future. One question, guys. Okay? So ABC Corporation reported on net income of 5 lakhs for the fiscal year. The company has 1 lakh shares. There is no preferred stocks. Additionally, the market price of equity is आपका 40 rupees. Calculate the P ratio. I hope everybody will be able to solve this particular one. So how we calculate P ratio आपका, ठीक है? So P ratio is equal to current market price divided by EPS, earning per shares. Current market price in this particular case is 40 and EPS. So first you have to calculate the EPS. It is profit after tax आपका 5 lakhs and there is no preference stock 1 lakh. So EPS is how much? Rupees 5. So EPS of this particular company is 5 and PE ratio is आपका, so it is 8. So what will be your correct answer? 8 will be right answer for this particular question. Understood, guys? Okay, so this is the one. So most of the time they ask you to calculate PE ratio. Reason being, with one question they'll check your concepts or fundamentals around the both the side आपका, ठीक है? So 8 will be right answer. चलो, now next question. Next ratio. So that is gross profit. Now next 3 ratios is around gross profit ratio or gross profit margin. So before starting this particular one, I'll give you an idea around the. So we all know how we calculate gross profit again. So gross profit margin or ratio is equal to gross profit divided by sales. Gross profit divided by sales into 100. When it comes to operating profit, it is आपका operating profit divided by sales. Operating profit divided by sales into 100. And when it comes to net profit, again, net profit margin or ratio, it is net profit divided by sales. So this is all about your all these 3 ratios. Now the probabilities, 100% you'll get one question based on these 3 ratios, either in your AFM, but the more important is you'll get question in your PPB, no, RBWM, branch profitability. Maximum time they ask this question in branch profitability, right? So because these are the measures of profitability itself. So now based on these particular one, along with that ROA and ROE, right? So these are the 3 areas. Now sometime what will happen, they'll give you one small case study, like let's say there is a company whose net sales is equal to, suppose that 10 crores. Their cost of goods sold is suppose that 5 crores. And their operating expense is suppose that 1 crore. And let's say their other expenses, other indirect expenses are suppose that 50 lakhs. So first, what we have to do? First, we have to calculate the gross profit, operating profit, net profit. So how you'll calculate gross profit? So gross profit in this particular case will be आपका net sales minus cost. So gross profit will be 5 crores. Operating profit आपका gross profit minus your operating expense. That is 4 crores. Then third one is net profit. Net profit is equal to operating profit 4 crores minus this, that is 3.50 crores. Okay? Rest all you know. Okay? So now in this particular case, it will be how much? 5 crores divided by आपका sale is 10 crore into 100. In this in first case आपका into 100. In second case आपका 4 crores divided by 10 crores into 100. In third case आपका 3.5 crores divided by 10 crores into 100. So this is your आपका gross profit, net profit and operating profit ratio or margin. ठीक है? So let's start the discussion. A key financial matrix that evaluate the company's profitability by dividing gross profit to net sales. This percentage based on ratio reflect how efficiently a company generating profit from its primary business activities. Primary business activities is like core operating activities, core operations. So it only include the net sales. It does not include your other income as well as indirect expenses or operating expenses. So gross profit is divided by net sales into 100. This is the formula for this particular one. Significance: measure relationship between gross profit and sales. Indicate efficiency of production, purchasing and pricing. So this is something which is showing the relationship among these things. Okay? That is generally part of your curriculum. Next one, net profit आपका, ठीक है, net profit. So net profit margin is a crucial financial ratio that measure a company's profitability by showing the percentage of revenue remaining after deducting all expenses. ठीक है? So indirect expenses also, including operating cost, interest and taxes. So what is the formula? Net profit divided by sales into 100. Simple. So that is the one. Okay? If a company's net profit is 1,20,000, sales is 6 lakh. Okay? So what is the net profit margin? So what will be your correct answer? So net profit margin or ratio is equal to आपका net profit divided by sales. ठीक है? Into 100. So in this particular case, net profit is 1.2, half 0.5, 0.2, 0.2 and 20. 20% will be right answer for this particular question. So 0.2 into 100. So 20% will be right answer for this particular question. All right. Significance आपका, what is the uses? ठीक है? So measure efficiency of business management, overall business, increase in ratio with constant gross profit ratio, so improve in business operational efficiency, effective tool for checking overall profitability of the firm. Investor consider cost of capital, industry return and market conditions. No fixed norms but consistent increase years after indicate improving business performance also, right? So these are the one in your curriculum. So they have only आपका gross profit and net profit. So you can just stick to those particular formulas. You do not have to worry around the other things. Whatever given, that is like more than sufficient, and we just have to focus on those particular ones. So there is one case also similar to this one. I found this particular one on internet. So this is very simple, as we have discussed earlier also. So this is similar to these are the numbers. If you'll put these particular number, let's say when it comes to gross profit, so gross profit divided by sales. When it comes to operating profit, so this is the gross profit. This is gross profit and this is sales. Operating profit divided by sales. Net profit, where is net profit? Net profit. So net profit divided by sales. So if you'll into 100, so you'll get to know the exact numbers. Chalo. Next one आपका. So far we have discussed the profitability ratios. Now the next ratio is about the solvency. Solvency is basically the long-term viability of that particular business. How that business is going to handle the long-term assets and liabilities. So measure the firm's ability to meet long-term and short-term obligations smoothly. So long-term solvency. So solvency which include, we can have short-term solvency which is also known as liquidity. Majorly this solvency terms we use for the long-term viability, but in your book they have included that liquidity with this particular one itself. That's why the another line is mentioned. Usually it is defined as the liquidity ratio, and solvency we generally use for the long term perspective about that particular business. So we have fixed asset ratio first. So fixed asset divided by the formula is आपका fixed asset ratio, ठीक है. Fixed assets divided by long term funds, ठीक है, sources of funds, ठीक है. So it should not exceed 1, ठीक है. Less than 1 part of working capital financed by the long term funds, ठीक है. It is desirable. Sometimes they ask these particular one, and for very few formulas they have given the interpretations also. So please try to remember this one. Okay? This was the there are only 3 ratios for which they have given this interpretation part. So please do remember those one. Okay? So should not exceed 1. If it is more than 1, that is our negative side. Okay? That means less than 1 part of the working capital financed by the long-term funds, which is desirable. Okay? More than once short-term sources diverted for fixed asset, undesirable. Okay? Ratio of 6.67 is below is satisfactory. Okay? The industry average or the excellence ratio for the fixed asset ratio is 0.67 or below that, so that is आपका desirable और satisfactory. ठीक है. Components आपका ठीक है, fixed assets आपका net fixed asset divided by trade investments, ठीक है. Long term funds आपका share capital reserve and long term loans. All these we have discussed with the balance sheet itself. You just have to remember the formulas, right? So D ratio आपका ठीक है. The next one आपका first one was your fixed asset ratio, but the most important from the solvency ratios is your debt to equity ratio. This gets asked so many times. Like for liquidity, once we'll come to the short term solvency or liquidity, that is your asset test ratio that get asked so many times. Similarly, this debt to equity ratio also that get asked so many times. So you have to be very careful around this. So debt to equity ratio आपका debt to equity ratio. So debt to equity ratio. So it is आपका the portion of total debt. Debt means आपका outside liability, and equity is आपका the owner's money in that business. So let's say we have overall, let's say the overall asset is 100 crores. Okay. So out of 100 crores, like asset is equal to liability plus equity. So let's say we have 70 crores liability and 30 crores equity, or else there is a reverse gear structure. Is suppose that debt is आपका 30 crores and 70 crores is through equity. So that is the one. So that comparison, how much money is deployed by the owners of that particular business and how much money they have taken from the outsiders. Okay? So outsiders means that is a liability and they have to pay regular returns on those particular funds. Okay? So debt to equity ratio is used to evaluate a company's financial leverage. Financial leverage is something which is related to debt. How they are using that leverage means how they are taking money from the outsiders and they investing in the business. It is calculated by dividing company's total liabilities, means total debt, by the shareholders' equity. Total debt divided by equity. So debt divided by equity, or total liability divided by equity, or short-term debt, long-term debt, other fixed payments divided by your shareholders' equity. Okay? So if a company's debt is 5 lakh, means outside liability, and equity is 1 lakh. So what is debt to equity ratio? 5%. Okay? 5% means आपका as per this one 0.50%. As simple as that. Okay? So total debt divided by equity. Next one. Short-term solvency, so they have only debt to equity ratio and fixed asset ratio in case of your long-term solvency. But if you'll study, you'll see the other ratios like interest payout ratio, interest coverage ratio, we have equity ratio, debt ratio, and others. They are also part of that one. Okay. Now, short-term solvency, which is also known as, which are all majorly known as आपका liquidity ratios. How that company is going to meet their short-term obligations. So for that one, we have cash ratio, we have current ratio, cash ratio, we have cash and equivalents, we have asset test ratios and others. But in your curriculum, they have only two, current ratio and asset test ratio, right? So first one is current ratio, also known as working capital ratio. Again, both are same, working capital ratio or current ratio. Current asset divided by current liabilities. How we calculate working capital? Net working capital is equal to current asset minus current liabilities. Okay. Measure the capability of a business to meet its short-term obligations that are due within a year. The ratio consider the weightage of total current asset versus total current liabilities. That means when it comes to the ratio, so current ratio is equal to current assets divided by current liabilities. Okay? And the good ratio should be आपका 1.22 आपका 2. This is a good range which is आपका favorable, right? So like this is something ki how much money you are have like how liquid asset you have in your hands, so you can meet your short-term obligations and all. Okay? So current ratio is equal to your current asset divided by current liabilities. So when it comes to the areas, so it show the ability to meet short-term liabilities. Ideal range is this is the one 1.222. ठीक है. Low ratio indicate liquidity problems. ठीक है. High आपका inefficient use of funds. ठीक है. So let's say there is a company whose current ratio is 10. That means they won't be able to utilize the funds. ठीक है. So they can have two max two. The remaining 8 rupees they can invest, or 8% they can invest in some business activities, and they can generate some profit for the business. Okay? Significance index of financial stability indicate the working capital level. High ratio is ideal fund and low ratio is आपका danger signals. ठीक है, business trading beyond the resources. ठीक है, let's say if the current ratio is suppose that 0.5, that means you have runway for only 6 months. After 6 months you do not you will not have funds in your hands to meet your liabilities, means आपका salary payments and others. ठीक है. So ABC incorporation following information: current asset, आपका non current current liabilities. So calculate current ratio. So it is आपका 2.5 is to 1 is current ratio. Again, additionally, what would be the effect if the if we using new shares? So it will improve, because while we issue shares for a time being we receive cash. So 2.5 is to आपका improve in current ratio. Okay, so 3 will be right answer for this one. This we have discussed during the introduction session also. Now the next one is asset test ratio. Asset test ratio, which is also known as quick ratio. Okay, this get asked so many times from this liquidity ratios. So how we calculate आपका quick ratio? So quick ratio is equal to quick assets divided by current liabilities. ठीक है? And how you calculate quick assets? So quick assets is आपका equal to current assets minus आपका stock or inventory. ठीक है? Inventory. Sometime आपका it is prepaid expenses also, but in your book they have given this only, and the examples are also around this. So just keep it here. So liquidity ratio, that measure how sufficient a company's short-term assets are to cover its current liabilities. See, it is something which is somewhere around the current ratio itself, but it is like it is accounting more assets, आपका more current assets, which can quickly or anytime can be converted into cash. Why we are not keeping inventory part of this? Inventory is part of current asset, but we are not including this because inventory may take time to convert into cash, right? Prepaid expenses you have already paid. Maybe they won't return your rent or your advance salaries and all. Okay, so that's why they are not get included in this particular case, right? So, in another word, the asset test ratio is measure of how well a company can satisfy the short-term or current financial obligations. Similar to current ratio, but it is more current than that. Okay? More current than the current ratio. So, current asset minus inventories divided by current liabilities. So, inventory, see here it is mentioned. Okay? Inventory and prepaid expenses are excluded from liquid asset. Okay? So while we calculate the current ratio, current assets, it is आपका quick assets. Quick asset is equal to current asset minus inventory minus prepaid expenses, because we cannot convert or encash these particular one on demand basis. Okay? So if you have inventory, it will take time to get converted into cash. If you have already paid rent for next 11 months or salaries for next 5 years, maybe they won't return that particular one. Or if they wish to return that particular one, it will take time, right? So that is the one. स्टैंडर्ड आपका क्विक रेशियो अबव 1 कंसीडर सेटिस्फैक्टरी। सिग्निफिकेंस आपका measure short term solvency more strictly, ठीक है। Comparison with current ratio show inventory hold ups, ठीक है। Low quick ratio versus current ratio is overstockings, ठीक है। High quick ratio is आपका stronger liquidity positions, ठीक है। Next one आपका, so we have done with the आपका profitability and then solvency. Now the third one C आपका, which is turnover ratio, ठीक है। So in your case I guess they have given only one or two, ठीक है। हाँ, two आपका। So one is आपका stock turnover ratio is a financial matrix that measure how often a company inventory is sold and replaced over a specific period, your cash to cash period. Two different approaches to calculate this particular one is आपका focusing on the different aspect of the inventory management here. So we have stock turnover ratio, cost of goods sold, that is आपका direct cost divided by average inventory. Very simple, just do remember this one, ठीक है। So cost of goods sold, you know how to calculate cost of goods sold, ठीक है। Opening stock, क्या था formula भूल गए? So opening stock plus purchase minus closing stock. If any direct expense is given, you have to add that particular one, ठीक है। And average inventory, whatever inventory you have, you just have to do average. Significance आपका, ठीक है, show efficiency of inventory utilization, high ratio bricks sales और बेटर लिक्विडिटी, ठीक है। लो रेशियो आपका ओवर स्टॉकिंग्स, ठीक है, ब्लॉक फंड्स एंड रिस्क ऑफ लॉसेस फ्रॉम द ऑब्सोलेंसेस एंड डिट्रेशंस, ठीक है। सो इट इज समथिंग लाइक you won't be able to clear your inventories and all, ठीक है। So that inventory is taking a dust on yourself. Next one we have debtors turnover ratio, ठीक है। So debtors, again it is part of your operating cycle, ठीक है। So debtors turnover ratio is formula is crucial for financial matters to evaluate the company's ability to collect outstanding debt, ठीक है। Let's say if we have done sales on credit, ठीक है। So how frequently you are receiving this, what is your debtor cycle, ठीक है, within how many times or how many days you are receiving back that particular money. So it is calculated by dividing the total credit sales, total credit sales by the average account receivables balance during the specific period, ठीक है। So credit sales divide by average trade receivables. So this is the formula to calculate this one. ABC company, a small business, sell furniture on credit. The company credit 30 days, meaning customers will have this. In the past year, ABC has a net credit sale of 10 lakh. Company average account receivables is आपका 2,50,000. So 10 lakh divided by 2,50,000 is your how much? आपका 4. So 4 will be right answer for this particular one. So if it is not given, so 4 will be right answer for this one. As simple, right? Next one आपका debt collection period ratio, ठीक है। So debt collection period ratio, also average collection period आपका, ठीक है, or debtors days is a crucial financial matrix of a company efficiency in collecting payments from the customers who have made purchases on credit. One another way to calculate this, ठीक है, it measure how long it will take average for business to convert credit sales into cash, ठीक है। So average collection period is account receivable balance divided by total net sales into 365, which is days आपका, ठीक है। If it is in months, 12 or the other one. So shorter collection period, faster recovery, prompt payments and reduce chances of debt. Longer collection period, insufficient credit collection, similar to that previous one, and block funds. Should be compared with the industry average. Too liberal, block funds, or too restrict, reduce the sales and profit, it will have impact. So standard varies by the industry, but generally receivables should not exceed 3 to 4 months of credit sales. Okay, this is, I hope you got the meaning of this. Should be compared with the industry average. For every industry, we have, like, it is depend on their operating cycles, cash to cash cycles and all. Okay? So if it is too liberal, like let's say you are letting them ki like chalo theek hai, pay in 5 months, 6 months, so it will block your funds. Okay? But if you are if you'll become very restrictive, we want money anyhow within 1 month, So that will make your make a negative impact on your sales. Okay? So because there are very few buyers who will make the payments, or the mediators who will purchase that particular one for 1 month, because they also need time to sell those particular products in market. So you have, that is the meaning of these particular. Okay? So apart from this, different users and their uses of ratios, same things, whatever we have discussed, same. So accounting ratios use by long-term creditors. Long-term creditors means आपका like in case of a bonds, or it can case of a banks and others. So fixed charge cover आपका, we have debt service coverage ratio, and they just have given the formula, nothing else. There is no explanation in others or uses. Accounting ratios, bank granting short-term loans like working capital loan and others. So quick ratio, current ratio. Accounting ratio, shareholders आपका earning per shares, dividend per shares and all. So just do remember all these formulas. Very simple, right? Chalo. So this is all about this. So first, the same things I'll repeat. Just write down the formulas, every formula or every ratio which is part of your curriculum that we have gone through in last 1 hour. So just write down these particular one, and you can initially you can do the open cheating whenever you study these particular one, and later on, once you like, if you practice 2-3 times, believe me, you will be able to recall each and every topics, right? So meaning of debt, introduction to bonds, then we have term associated with bonds, types of bonds, optionality in bonds, valuation of bonds, bonds value with semi-annual interest rate, current yield on bonds, yield to maturity, theorem of bonds, duration, properties of duration, then we have bond price volatility. So when it comes to this particular unit, there are few important subtopics. So one is आपका terminology. Sometime you'll get question around this. Different type of bonds, optionality in bonds, valuation of bonds, and current yield, right? And then theorems of bond value is again, and theorem of durations. These are some important areas, and you can expect 2 marks question based on this particular unit, right? So like full of concept, you have to develop concept very well, then only you will be able to answer question related to this particular topic. Okay, so I hope everybody know what is debt or what is bond. So debt is a part of the capital structure. So companies, they can raise funds through like when it comes to the capital structure, it can be either equity, where they are sharing the ownership with the prospective investors. The another form is debt. So debt means they are taking it as a liability, and they have to pay off these particular one. Okay, when it comes to debt, it is like the one of the most important or most famous tool under the debt securities is basically your bonds. Okay? So when it comes to bonds, bonds are kind of like these are the financial instruments which generally offer a fixed rate of return most of the cases. And this return is usually semi-annual, or means in every 6 months they release that particular interest rate. So they get issued on a like fixed coupon rate. And when it comes to like companies, they are raising funds for a fixed time duration, right? Let's say there is a XYZ company, they raise funds, they issue a bond, I like XYZ company promise to pay this amount. Let's say आपका face value is 1000 at a coupon rate which is called rate of interest of 10%, which is payable आपका, it can be per annum or it can be semi annum also. And the maturity, like they are raising this particular funds for 10 years. Sometimes these type of instruments, they get issued on discount also, especially when it comes to the sovereign bonds which are generally issued by government of India. They always issue bonds on discount. Discount means they'll issue bonds on discount on face value. So let's say the face value of that particular bond is 1000, so they'll issue it at let's say for 600. So at the time of maturity, investors, they'll get 1000 rupees, and at the time of investment they have to pay 600 rupees. These kind of things. So there are so many things, terminologies and all, they are generally associated with this. So when it comes to bonds, it is a debt instrument through which companies and governments, they are raising funds for long term period at a fixed rate of interest for a fixed time duration, right? So that timing is generally known as your maturity. So that, like, let's say in this particular case it is 10 year. Coupon rate is basically the annual interest which is paid by the company to the bond holders or investors, and face value is basically which is placed on the face of that particular bond, right? Nowadays bond, they also get traded in secondary market. So basically like bond, they generally get listed in stock exchange, and investors, they generally buy sell them in the secondary market also. As we used to do trading in equities, similarly you can also do trading in bond also. So that's why sometimes what you will do, their market price is different from their face आपका face value. So the market value can differ from the face value, right? Let's say the face value is 1000 and the bond is trading at 900. If it is trading at 900, that means it is on discount. It is a case of discount here. And if the market value is 1100, so it's a case of premium. Okay? So it's a case of premium. That means like why this is a case of discount or why this is a case of premium, because if you purchase that particular bond today at 900, at the end of the 10th year it will become, or you will get 1000. That is the face value of that particular one. Okay? And that means it is on discount. Okay? And when, let's say, the market value of bond is 1000, 1100, sorry, okay? And face value of 1000, okay? If you purchase this bond today, at the end of that maturity it will become 1000. So it will automatically, the prices will come down till maturity, it will become 1000 only, right? So at the time of maturity. So this is case of premium and all. Okay? So bonds, basically companies, corporate houses, and mostly government, they issue these kind of instruments, and we have so many type of bonds available in the market. Like, I hope you heard about the sovereign bonds or inflation linked bonds, or we have corporate bonds, or we have treasury bonds and other also. Okay? So as per the issuing authorities and all. Okay? So in this session we will be discussing all these along with this premium discount case, or the YTM things, how we calculate the bond value. So and the current yield. So one aspect is current yield. They ask this question every time in your examination. So current yield is basically key. Let's say how they'll ask you question. There is a bond whose face value is आपका 1000 and bond is currently trading at आपका 900 in the market. And the coupon rate is 10%. So calculate the current yield. Current yield is something, the concept why it is if I purchase that bond today, so if I hold till the maturity, so what return I'll get from that particular one. In this case, if it is a case of discount, obviously your return will be more than आपका this current this coupon rate. If the bond is in आपका premium, so your current yield will be less than your आपका coupon rate and others. So these are the things which are generally part of this particular one. So in this session, with bond theorems and others, we will make our understanding, will understand all these particular. So let's start the session with very basic things, which is your bond terminology. So there are so many terms which are generally associated with bonds. So let's decode all these particular terms first. So first one, we have face value, which is also known as par value. So face value is nothing, it is the value which is stated on the face of bonds. That means this is the amount which is the company or the corporate or the governments, they are raising from the public. Let's say the face value is 1000 of a bond. So that means they are raising or the investors, the borrowers, they are raising 1000 rupees from investors, where they are making some sort of commitment ki the coupon rate is 10%. So they'll pay 10% per annum return on this one. So they are like simply saying it's a kind of a, let's say when we invest in FD, you invested 5 lakh rupees at 7% per annum, okay, on compounded basis. So this is something like this. Okay. So this is a kind of a like, let's say we have 1 unit and that 1 unit will cost you 1000, and on this 1000 we will pay you 10% return. Okay. So when it comes to face value, which is also known as par value, okay, so the amount borrowed by a firm stated on the face of bonds repaid after specified period means your maturity period. Okay. So investors, they'll get back this particular value 1000 rupees at the time of maturity itself, right? The another one is coupon rate. It is nothing, it is just the rate of interest. Okay. So this is the this is called coupon rate. Okay. The specified rate of interest on bonds, which is called coupon rate. Okay. Maturity, for how long we have issued this particular bond, or for how long that borrower is raising funds. Okay. So this is your maturity, 10 years, like let's say in this particular case. Okay. Redemption value. Okay. Redemption value is something like, as an investor, if we purchase this bond and if we hold till maturity, so what amount I'll get. Okay. Let's say at the end of first year, the redemption value will be 1100. How it came to 1100? So 1000 rupees is the face value which we have invested. We got 10% return. 10% of 1000 is 100. So 1100 rupees is the redemption if the bond period is 1 year. So that is the case. So value received by bondholders on maturity generally are redeemed at par value. Next one, interest rate आपका fixed. So now we can have interest rate, we can have fixed or floating. ठीक है. So fixed rate known bondholders, also called coupon rate. ठीक है. So interest on debentures or this market value, which can be differ, like this nowadays bond, they generally get traded in secondary market. So market value, which generally decided on the basis of demand and supply. Let's say if there is a high demand for that particular bonds, the value will go up. So suppose that that bond is currently trading at 1050 rupees. So that is the market value of that particular bond, which differ from the face value or par value. Okay? But at the end of the maturity period, at the end of 10th year, it will come down to your aapka the face value of that particular bond. Okay? Price at which the bond bought or sold in the secondary market may differ from the par value or redemption value. Okay? Then we have day count convention. This is very, very important. This get asked so many times in your examination. So now it is about the interest rate calculations. Okay? It is very simple concept. Okay? So when it comes to day count conventions, it is like how we are going to calculate that particular interest. Okay? Like let's say we have these are the different one, actual 365. Okay? Or we have actual, we have actual 360, and we have 360. So what is the meaning of this? Actual, okay? The number of days we hold that particular bonds and the number of days in the month. Okay? That is actual. Okay? Use actual number of days. So that is the one. Okay? So method used to calculate interest payments. Okay? Actual. Let's say you purchase a bond and you sell after 20 days. So your interest we will calculate on actual. Let's say the annual interest is 10% per annum. Okay? So then we can that 10% can be, we can have half annually, 6 months. Then we can have quarterly, we can have monthly, and we can have daily. In India, we stop that calculation on daily basis. Take a 10% per annum. Then if it is आपका half yearly, so it is आपका in simple interest it is 5%, but when you go for the compound interest it will vary, right? Then we have monthly आपका 10% divide by 12 आपका, we have daily 10% divided by 365. So that daily interest, so we will pay out only for 20 days in that particular case. Actual 365, actually how many days you have hold that particular bond, and we will assume there are 365 days in a year, okay? Even including the leap year. Okay? In leap year, let's say if we have 364, we will not consider that one. We will go for we'll assume that there are 365 days in the year itself. Okay? Actual 360 आपका, assume there are 360 days in a month, in a year. Okay? And 30 360s. In a month, we will be considering आपका 30 days. In a year, we will be considering 360 days आपका. So each month assume have to 30 days. If you hold for 30 days in others, so that will be accordingly this. Okay? Alright guys, so this is something which is आपका that is generally known as day count conventions, right? चलो, so I hope you get this particular thing clearly. You got one unexpected get. What are you doing here? Go, sit there. Sit. All right. So this is something which you have to remember. Okay. Now we will be discussing some terminologies in detail also. Okay. So coupon rate आपका. I hope now you get these particular thing clearly. Still, you can go for this one. Okay. A bond carries specific rate of interest, which is called coupon rates. How we calculate this? So coupon rate is आपका annual coupon payments divided by face value of bond into 100. ठीक है. So annual coupon payments means आपका let's say let's say as I gave you in case, okay, so face value is suppose that 1000, okay, and your coupon rate is suppose that आपका 10%. Okay, so if you have to calculate the annual, so it is आपका annual coupon which is how much? आपका 10% of 1000 is 100, okay, divided by आपका 1000 into 100. So that is the outcome for this one. Okay, so as it is already mentioned 10%, so that is the case in this one. Okay. The another one is maturity. A bond is issued for a specified period, which is repaid on maturity. Like it can be for 10 years, 15 years, or आपका like sometime it is, if it is deep discounted bond, it can be for 30 years also, right? The next one is a redemption value. The value that bondholders get on the maturity, that is called redemption value. Day count conventions, sorry, face value. Then we have two things, face value and place value. So when it comes to face value, it is also known as par value, which is placed on the face of that particular bond. Like in our case, it was 1000. Stated on the face of bond, it represents the amount borrowed by the firm which it promised to repay after a specified period, right? Place value is आपका in multiple of, let's say the face value is 1000 and there is a investor who is purchasing 10 units, so it is into 10, or it can be 100, or it can be 1000, or it can be 1 lakh. Okay, so these number of bonds, like that is the overall value that we are going. Okay, so place value is defined as the digit multiplied whenever wherever it is placed, either by hundreds or thousands and all. Okay, so the overall value, like this is the face value 5 rupees, and that investor is investing in 1000 units. So 5 into 1000, so this is your place value, that is आपका 5000 rupees. So market value, now as I told you this. So the bond may traded in stock exchange. Market value is the price at which bond is usually bought and sold in market. Market value may differ from the par value or redemption value. It can be in discount, it can be in discount, or it can be in premium. So what will be the case of discount? When the face value is higher than your market price. And what will be the case of premium? When face value is आपका face value is higher than your market price. Let's say the face value of a bond, is 1000, and the bond is currently trading, market price is suppose that 900. So it is a case of discount. And premium is the bond is currently trading at, let's say, 1200. So it's a case of premium. So that is the one. This understanding is very important. You'll get to know while you calculate the current yield and also that will help you, right? So day count conventions. So we can have the interest payment are made based on the day count convention. Various day count convention are there. Actual. Then we have actual 365. Usually we use this one. In Indian debt market, we use actual 365. We calculate the actual number of days for that period investor hold that bonds, and in a year we calculate आपका 365 days. Actual 360 आपका, where we are considering in a year we have 360 days, and 360 आपका in a month we are considering 30 days, even if it is February also. And in a year we are considering 360 days आपका. So that is the conditions. So these are the terminologies which are associated with the bonds. Now the next part आपका, that is types of bonds. So types of bonds. So we have various type of bonds. So it is categorized based on the issuer also, ठीक है, like government bonds, आपका corporate bonds and others. It can be आपका fixed and floating rate bonds आपका. It can be discounted bonds, ठीक है, zero coupon bonds. It can be inflation link आपका. So inflation link bonds and others, tax free and others. So there are so many things, ठीक है. So we have fixed rate bonds, floating bonds, zero coupon bonds, inflation linked bonds, perpetual bonds, subordinated bonds or debt, or corporate bonds. Apart from this, we have another list also. Okay. So out of this, fixed and floating rate. Okay. So when it comes to fixed rate bonds, that is आपका, let's say there is a XYZ or the government of India, they issue a bond at a face value of 1000, okay, and the coupon rate is supposed at 10% per annum. Okay. So this is a fixed rate bonds where basically government, they are raising funds for 10 years at a fixed rate of interest, that is 10%. Okay. So government is making some sort of promise, or the issuing authority or the company is making some sort of promise ki we will pay you this much of interest for during this particular period and all. Okay. And there will be no change in the in that particular interest. Now the another one is floating rate आपका, ठीक है, where interest rate is linked with some indices. ठीक है. So let's say this is आपका, there is a bond which is issued by government of India, ठीक है, and which is आपका floating. So that is, let's say this is linked with आपका LIBOR, ठीक है. So this is linked with your LIBOR system or ARR system, ठीक है. So accordingly, like in every quarters, we'll change the rate of interest of this particular one will change. Let's say it is LIBOR plus 1%. So whatever changes in this particular index, so these are index आपका link bonds, ठीक है. So as this index rate will get changed, similarly the interest rate of bond will also get changed, ठीक है. So that is your floating rate. So they are linked with some indices. That indices can be any benchmark, right? So then we have zero coupon bonds. Mostly you will see whenever government issues securities, they issue securities on zero coupon bonds, or zero coupon, like it can be treasury bills or else in bond also. Let's say government of India, they come up with a bonds whose face value is supposed at 1000, and currently this bond is get issued on discount, and the discount price is supposed at आपका 600, ठीक है. So what government is saying, and the maturity period is supposed at आपका 7 years, ठीक है. So what government is saying in this particular case, you give us 600 rupees right now, ठीक है, and we will pay you आपका 1000 rupees at the time of maturity. So zero coupon means there is no interest rate. That does not mean कि you will not get return from these kind of securities. Then otherwise, why we will invest in these kind of securities, right? So when it comes to zero coupon bonds, it is they get issued on discount basis, right? So the bond face value or par value is 1000, and government issued these bonds at आपका discount at 600, ठीक है. So you pay us 600 rupees right now, and at the time of maturity we will give you 1000. So there is a kind of, you are getting a return of 400 rupees in these kind of instruments. So that is zero coupon bond. Inflation linked bond, this we'll discuss in detail. We have a dedicated slide for this. Perpetual bonds, when it comes to perpetual bonds, it is also known as PrEP. PrEP means a kind of equity. So this is called bond with no maturity. So bond with no maturity period. So bond with no maturity period. So that means like there is no maturity in these particular case. It is a kind of a equity. But the difference between perpetual bonds and equity is, in case of equity, as an investor, we does not get any sort of fixed return. But here, the other features are of bond, like you will get 10% per annum return for आपका till the time the company redeem those particular bonds. But they does not have any maturity period or any clearly stated maturity on these particular one. Subordinated bonds. Subordinated, as the name said, subordinated means secondary. It is also known as secondary debt. They are risky in nature. That's why they offer higher rate of interest also, right? So this is similar to bonds, but if that company fall in any case of liquidations, so the priority given to these type of bond holders is secondary. First, company will pay off the primary debt, then they'll pay off these kind of investors. Okay? Then corporate bonds, which is issued by the corporate house, let's say TCS or Reliance, they issue some bonds, that is a corporate bonds. Okay? Tax-free bonds, which generally provide some majorly these type of bond issued by the government, and they are for a specific purpose like infrastructure bonds or green bonds and all, and the government, they offer some sort of tax relaxation with these kind of things. Okay? So public sector आपका government, municipal authorities, state governments, central government. Okay? So these are basically based on the issuing authority, that is the categorization. Okay? So now one by one some important areas, so that we'll be discussing all these. Okay? So as I told you about this inflation linked bond, a security designed to help protect investors from आपका inflation. Okay? So now I hope you guys remember the concept of that we have discussed in our IA and IFS, real income concept, right? Let's take a case so you can easily relate this particular one. So suppose that there is a bond or आपका, let's say there is a company XYZ, they come up with a bonds, and whose face value is supposed at 1000, and the coupon rate on this particular bond is 9% per annum. And the bond is for suppose that 10 years. This bond is issued for the 10 years. Now what happened in this particular case? So suppose that, like that, the simple meaning of this particular one is, suppose that if you pay 1000 rupees today, so every year we will pay you 9% rate of interest on that particular one. That the basic interpretation of this one till 10 years, for next 10 years. Usually how we generally make this investments. So now what will happen, or how the inflation sometime affect this particular thing. So suppose that if you count the simple interest, so every year you are getting 90 rupees on this particular bond. So sorry, 90 rupees आपका. The annual coupon will be 90 rupees आपका. So you are getting 90 rupees on this particular bond. Sometime what happened now? Let's say this is the average return for the next 10 years. During that particular period, the average inflation during this particular period, this particular period was supposed that 10%. It can be like in India we have 5% inflation on an average. Sometimes it may go up, right? So there are some circumstances, and it happened in past also. Okay, so where the inflation rate was 10%, 11%, 12%. That's why we come up with these kind of instruments. Okay, in 2010-11, the inflation rate was 10.406%. Okay? So government, like those who invested in bonds, their return went in negative, right? So this is the situation. So now we have invested in some securities where we are getting 9% interest, but during that particular period inflation is 10%. So you are getting nothing from that particular investment, right? So after 10 years, the average inflation of that period, like how you calculate, so it is called your concept of real income. So real income, how we calculate real income? It is your interest minus inflation. So interest minus inflation. Inflation is increase in prices. I hope everybody know this. So in this case, your interest is 9% and aapka inflation is 10%. So your investment went in negative, that is aapka minus 1%. Okay? So that is the case. So you did not get anything or a single rupee from that particular investment, and that went completely wrong. So like assume that you have placed aapka 100 crore rupees in these kind of securities, debt securities, and after 10 years you are getting nothing from those particular investments. So how you will feel? So to understand, after understanding this particular the effect of inflation, what government did, they generally come up with the inflation linked bond. Now how we generally come up, what is the structure of or the structuring of this inflation bonds? These are generally linked with CPI. So we have CPI plus, let's say, 2%. Okay? So now they generally work on a formula of max inflation can be max or zero. Okay? We will not consider the negative inflation. If the, let's say that in that economy there is a deflation during that period of 2% minus, so we will consider it as a zero. Okay? And max side, let's say if inflation is आपका let's say your inflation is 15%, so plus 2%. ठीक है, you in any cases you will get this 2% written that got fixed with these kind of instrument. ठीक है, so let's say inflation is आपका -2%, so आपका you will get 2% of return because we have to follow the max or zero. ठीक है, so we will consider inflation as zero and we will get this rate of return. ठीक है, so that is inflation linked bond, right? So inflation linked bonds are indexes to inflation so that the principal and interest payments rise and fall with the rate of inflation. Now, like let's say in this situation, आपका if inflation is 10%, you'll get 10 plus 2%. Okay? That means this 2% anyhow you'll get from the market. You'll get overall 12% rate of interest. Out of 12, this आपका this is the fixed thing. Okay? That is the value which you are going to get from the market itself or from that particular investment itself, right? So inflation linked bond, perpetual bonds, which is also called a PREP, perpetual. So a bond with no maturity date, therefore it may be treated as equity, not as debt, and they are risky in nature. The feature which generally differentiate perpetual bonds from the equity आपका because they offer a fixed rate of return, right? Then we have zero coupon bonds, as I gave you an example. These are when bonds get issued on discount. Okay? So the face value was 1000 and it got issued on discount of 700. Okay? Maturity is 5 years. So the case is simple. You pay us 700 rupees as of now. At the time of maturity, we will pay you 1000 rupees. So you will get 300 rupees return from this particular bond. That zero coupon, that does not mean you will not get any interest from this one, right? A zero coupon bond is a bond in which the face value is repaid at the time of maturity. It does not make periodic interest payment or so-called coupon. Hence, it is generally known as zero coupon bond, right? Next one, subordinated secondary आपका, ठीक है? So secondary debt आपका, so a debt which rank after other debt or primary debt fall at the time of liquidations, ठीक है? So again they are risky in nature, right? Then the next case is again very important. Okay? That is optionality in bonds. Okay? So I hope we all know about the options. Okay? So we have two type of options. One is आपका call option, another one is put option. Okay? So call option and put option. Similarly in bond also we have two options. Okay? One is आपका one is known as callable bonds, another one is आपका putable bonds. Okay? Optionality in bonds. So now see how this basically works. Okay? So let's say there is a company XYZ Limited who issue a bond at face value of 1000. Coupon rate is supposed that 10% and the bond maturity period is आपका 10 years. ठीक है? They issued this particular bond for 10 years. ठीक है? Now in this particular case, if this bond, like this bond can have two options. One is आपका callable, another one is आपका putable. ठीक है? So if the bond is callable bond, if the bond which is issued by XYZ Limited is the callable bonds, that means or that give right to issuer. Okay? Callable bonds which generally give right to issuer of the bond. Okay? Issuer means in our case it is XYZ Limited. Okay? They what right they get? A right to buy back that particular bond. Okay? Buyback means to redeem that particular bond from the market after a specified time duration. Okay? So company they issued this particular bond for 10 years and they have a call option in this particular bond कि they can buy back that particular bond from investors after 2 years. So this is a right of company. They can exercise that particular right. This is a right but not an obligations. So they can buy back that particular bond after 2 year of period. Okay? That is generally comes under this particular one. Okay? So that is generally known as callable bonds. First आपका, when it comes to putable bonds, which generally give right to putable bonds, which generally give right to investors. Investors of that particular bonds. So this आपका investors bonds. So that is putable bonds. They have a same right. They can convert that particular bond into equity, or they can force to the issuer to pay them back, right? So this is something आपका putable bond. So putable bonds which give right to investors. You just have to remember this line and this line. ठीक है? So here they have आपका right to buy back, and here the investor they have right to sell back. ठीक है? Sell back to the आपका issuer, sell back to the issuer of that particular bonds, means that XYZ company after a specified or predetermined time duration. Callable and putable bonds. Very important one, get asked so many times. So please do remember this one. A callable bond is a type of bonds that allow the issuer of a bond to retain the privilege of redeeming the bonds at some point before the bond reach its date of maturity. Okay? So it is आपका that allow or give right to issuer. Okay? You have to remember this one. When it comes to putable bonds, so putable bonds that give right to holder or आपका the holder of the putable bonds the right but not an obligation to demand early payment from of the principal. Okay? So a putable bond is a type of bonds that provide the holder, means investors, the right but not an obligation to force the issuer to redeem the bonds before the maturity date. See, so optionality in bonds, callable and putable. Very important one. I hope you get this particular point clearly. Now, apart from this, like fixed rate, we have discussed. Coupon remain fixed throughout the period. Floating rate, these are the definition which were given in your book also. So coupon varies with a reference interest rate like ARR or LIBOR and others. High yield bonds, they provide high rate of interest, simply high risky. So as I gave you an example of that, subordinated bonds. Convertible bonds which can be converted into shares of that particular company after a specified period. Inflation linked bonds, आपका principal and interest payment adjust according to inflation. They are linked with some inflation indices. Asset back, आपका backed by the cash flow from the assets. So like this is something secure bonds. Subordinated bonds, आपका lower priority for the repayments compared to other debt. So they get secondary priority at the time of liquidation. After the company will pay the primary debt, then the money will come to the subordinated. That's why they are risky. Then we have covered bonds backed by the mortgage or public sector assets remain on issuer's balance sheet. Okay, let's say there is a company who issue bonds based on their आपका own building and all. Okay, so that is something. So that building will remain in the asset book of that particular company itself or issuer. But at the time of failure of that, like if that company fail, so the jurisdiction will sell the asset and they'll repay the amount of the investors. Perpetual bonds, prep, no maturity date, continue indefinitely. Bearer bonds, आपका certificate based, no registered owner. Whoever is holder of that particular bond, he is the owner of that bond. Earlier we used to have, but nowadays we do not have this. Government bonds, आपका, which is issued by the government. Majorly these get issued on discount basis, right? Now the next portion, which is something which will help you in your JAIB as well as in CIB, or if you'll go for some other certifications like CFP, CFAs and others, definitely you will see this particular things along with whatever we have discussed so far, right? So in JAIB, in my experience, they never touch the आपका YTM things and all. So they though they ask a question based on current yield, but they never ask question based on the how to calculate or determine the value of a bond. But still, we'll try to make our understanding around this one. So as it is given in your book itself. So when it comes to valuation of bonds, how we decide the market value or that of any आपका bond. So bond provide future cash flows, which is आपका periodic interest payment. It can be half yearly or annually. And we have redemption value at maturity, which is par value or your आपका that face value. The value of bond is equal to present value of all expected future cash flows. The intrinsic value of a bond is a present value of all these benefits. So value of bond is आपका present value of all expected future inflows. Let's say how come there is a bond which get issued for 5 years. The maturity is आपका suppose that 5 year of a bond. face value of this bond is 1000, and the coupon rate is आपका 10%. ठीक है, suppose that. So this is the case. Now that means at the end of first year you will get 100 rupees. Then every year you will get 100 rupees from this particular one. ठीक है, at the end of first year, second year, third year, fourth year, fifth year, every year you will get 100 rupees. But this is something which is called future value. ठीक है, you are getting this 100 rupee at the end of first year, you getting this 100 rupee at the end of आपका fifth year. ठीक है, so if you compare, and this outflow, the investment you are making in this particular bond 1000 rupees, that is your current outflow. ठीक है, so you are investing today 1000 rupees in that bond, and you are getting return at the end of first year, second year, third year, fourth year. Now we know the time value of money concept. Okay? So time value of money says today's 1 rupee आपका which has higher value than आपका after 1 years or 2 years, 3 years, 5 years, 1 rupee. Reason, we can have opportunity cost, and we do have inflation effect and all, right? So what you have to do, you have to calculate present value of these future inflows. Okay, so you have to calculate present value of these future inflows. How you will calculate that particular one? That is आपका in case of bond, it is interest 1 plus r की power, and it can be like in case of first year it is 1, in second year it is 2, 3, 4, 5. ठीक है, so by this particular formula you'll get to know the present value of this 100 rupees. ठीक है, so if I'm making an expense of 1000 rupees today, so and I'm getting 100 rupees by the end of first year, so I have to calculate the present value. This is the future value. You have to calculate the present value, and how you will calculate the present value is this. So the value of bond is present value of all expected future inflows. So if you calculate, let's say it is 90 rupees, it is 85 rupees, it is 70 rupees, it is 65 rupees. So this is the present value of inflow from this particular bond. That is the case. Okay? So how we calculate, how actually we do the valuation of bond. So we have a formula, that is sum of आपका, this is interest, the coupon rate, or the coupon or the income or the interest you are getting. Like let's say in case of as I gave you, in face value is 1000 and coupon rate was आपका 10%. Okay? So that means your annual coupon will equal to, or this I will equal to 100 rupees in this case. So 100 divide by 1 plus KD. ठीक है, KD is आपका cost of capital. ठीक है, so let's say it is आपका 10%, 12%, 13% or 9%, whatever it is. ठीक है, that will be given in question itself. ठीक है, plus आपका future value. ठीक है, future value, how much you are getting during that period. Again आपका 1 plus KD. ठीक है, so time and आपका n. ठीक है, so value of bond is equal to annual interest coupon. In this case, annual interest coupon is आपका how much? 100 rupees. Redemption आपका face value. ठीक है, face value is how much? 1000. ठीक है, face value is 1000. So then we have number of years, ठीक है, and we have cost of capital. So that is discounted basis. ठीक है, so like how we are discounting the future values. There will the one numbers is given, like let's say it is 8%, 9%, 12% and all. So that will be in the case in this. Okay? So let's say, so take this example. Okay? So there is a bond whose face value is 1000. Coupon rate is आपका 10%. Okay? Annual interest is आपका, so annual interest or annual coupon is आपका 100. Okay? So 10% of 1000. Maturity period is 3 years आपका. Okay? And the cost of capital, or it is also known as discount rate, is 12%. So how you will calculate this? Now very simple. So आपका 100 divided by 1 plus KD was how much? Your KD was 12%. So 0.12. Okay? So you will do the same thing for 3 years. Okay? So 100 divided by 1 plus 0.12 2, then 3, then whatever value will reach, then आपका face value is 1000, 1 plus 0.12, so it is for 3 years. ठीक है, so now whatever outcome you will receive, ठीक है, if the outcome, let's say the outcome is suppose that 970 rupees. Okay? After solving this equation, we reach to like I'm just doing assumption. Okay? I'm not calculating this. I'll show you the calculation. Okay? So 970 rupees. If it is 970 rupees, that means the face value is 1000 and the face value is आपका 1000 and the bond, the current value of bond. This is the current value. Current value of bond is 970 rupees. That means it is in discount and you should buy that particular bond. Okay? So this is in discount case. It is a case of discount when face value is greater than the आपका market value. So this is on discount and you should आपका buy. Why I'm suggesting you to buy? Because at the time of maturity it will become 1000. So that is the case. Okay? So how you will do the calculations? Okay? So PV interest आपका first equation. This first equation I'm solving. So this one, this part first. Then we'll do calculation for this part. Okay? So आपका 100 1 plus 1 point मतलब it was 1 plus आपका KD, so 0.12 फिर 1 point is 3 years. ठीक है? So we reach to these particular numbers and the total of this is how much? इनका total करना पड़ेगा आपको. ठीक है? So the total is 89.29 plus 79.72 plus 71.19. ठीक है? So it is equal to 240.2. ठीक है? So this is the आपका present value of, what is this? This is the present value of future inflows. ठीक है? What we have calculated so far, present value of future inflows. ठीक है? So this is the first part we have solved. ठीक है? Now in second part, what we have, face value divided by आपका KD. So it is आपका 1.12 की power 3 for 3, the maturity is 3 years. ठीक है? So we reach to आपका how much? 712. ठीक है? So now plus if you add this particular one, it will be 240.20. ठीक है? So it will come plus 712.99 is equal to so the current market value of this bond should be 953.19. Okay, this is the current market value of this particular bond. So now the face value is आपका 1000 and means it is a par value. At the time of maturity you will get this amount. Okay? And the current market value is this. So that means this bond is in discount. Okay? So this is the how we calculate, how we do the valuation of bonds. This is the formula and this is the, if the value will be higher than that, let's say it is आपका 1100, so this will be in premium. ठीक है? So that is the case. It is mentioned here. So 953.19. ठीक है? So since the this less than the face value, the bond is selling in discount. ठीक है? So we'll be suggesting you to purchase this bond. The first case आपका bond valuation. In my experience of last 5 to 6 years, you never ask any question around the valuation things. Though you can practice these particular things. In CIB definitely you will get this one. Okay? Now the next one is आपका, this get asked every time. Like in last 3 years, 6 session, every session you will see one question around the your current yield. Okay? So what is current yield? Let's say there is a bond. Again आपका, let's say there is a bond whose face value is आपका 1000. Okay? It got launched in year 2000, let's say 23. Okay? So in 2023, this bond got listed in stock exchange. Yeah. Coupon rate is supposed at 9%. Okay? And the maturity is supposed at 10 years. Okay? So the bond get launched in 2023 or let's say 2020. Okay? So that means 10 years means it will get maturity in 2030. आपका, ठीक है? And we are in 2025. That means 5 years are remaining. ठीक है? So what this concept tell you? So this current yield on bonds, कि if you purchase this bond in 2025, if you purchase this bond today, and if you hold till maturity, if you hold that bond till maturity, what return you will get from this particular bond, or what interest or coupon you will achieve from that particular bond. So this is something which is आपका current yield, right? So how we'll calculate this particular one? It is annual coupon divided by your current market price into 100. That is a basic formula to calculate this one. Okay? So measure the rate of return on bonds based on coupon interest and current market price. Okay? So how you will calculate? Let's say in this particular case. Okay? So the present value is 1000 and currently in 2025 the current market price of this particular bond is supposed that how much it is आपका 1050. ठीक है, means आपका the current market value is higher than the face value, it is in premium. If it is in premium, please listen carefully. If it is in premium, the current yield will be less than this. Your current yield will be less than 9%. How come? Chalo, let's calculate. So now your we know the formula annual coupon. Okay? So it is, you can also write it like current yield is equal to annual coupon divided by आपका current market price into 100. ठीक है, in percentage. So what is your annual coupon? Annual interest rate. So it is 9% of 1000, which is 90 rupees. ठीक है, so आपका 90 rupees divided by current market price is how much? आपका 1050. 1050. So if you'll calculate this, 90 divided by 1050, so it is equal to 0.0857 into 100 percentage. So it is आपका, so your current yield is equal to into 100. So your current yield equal to 8.5714. This is your answer for this particular question. Okay? So it's as simple as that. And you will get 1 mark, or sometime you will get surprisingly 2 marks also, right? So this will be first question. And sometime the same logic which you will, while you study the theorems of bonds, these things are given in theorems. Okay, if bond is in premium, so the annual coupon is higher than the your current yield, which is true, right? So that is a theorem. Okay? And if bond is in discount, the annual coupon is आपका lower than the आपका current yield. That is also true. That we have proved through this particular one. Understood, guys? I hope you're getting this particular point. We'll solve 2-3 questions also. Okay? Unit number 23, financial mathematics, which include forex arithmetics, the basic introduction to forex market, fundamentals of foreign exchange, Indian forex market, again, direct and indirect quotations, and basics exchange rate arithmetics, which include cross rate, chain rule, and value rate. Again, forward exchange rate. So we have forward point, arbitrage, calculating forward point, premium, and case of discount. Okay? So these are the subtopics which are generally part of this particular unit, and one by one we are going to discuss all these particular one. All right. So first, let's start the discussion with the foreign exchange market or forex market. So whenever it comes to forex market, it is generally a market where we generally convert one currency, majorly the domestic currency, into foreign currency, or a conversion of two currencies. Let's say you are going abroad for the travel purpose. While you transit from India, so you will be requiring the local currency of the destination country. Let's say you are going Europe, so you have to convert the INR into euro. So that is like the market where you are going to convert those particular currencies. That is called your forex market, and the rate at which you will be converting that particular currency. Let's say for one euro, you need to pay 94 rupees. So that rate is generally known as forex rate, right? Now, like due to the globalization things, nowadays this market is very vast again, and it is open 24 into 7, and we have different type of deals in this particular market. It can be spot or it can be forward also, right? And the major reason for the expansion of this particular market is globalization. Nowadays, like businesses, individuals, they have global aspirations. Okay? So they generally deal with multiple currencies or countries, so they need to convert the currencies itself, right? So that conversion happen in this particular market. Like it can be quoted in direct or indirect. Okay? So direct quotation is like where one unit of foreign currency is given in term of domestic currency. Like $1, for $1 you need to pay, let's say, 87 rupees. Okay? So now like rupees at lowest point in the history itself. Okay? After this Trump the tariff things and all. Okay? So it went 87. It touched 87 below 87 today. Okay? So that for $1 you need to pay 87. That is direct quotation. Or indirect quotation is when 1 unit of domestic currency is quoted in foreign currency, right? Like for 1 rupee you will get 0.0122 dollars. So that is something a indirect quotation. So these all particular terminologies, fundamentals and all, first we will discuss these particular one, then we will be discussing the concept part from the practice part from this particular unit, right? So foreign exchange is a trading of one currency for another, like dollar to INR. Okay. So foreign exchange transaction can take place on the forex market, also known as foreign exchange market. Very simple. Okay. Now, a reason, the fundamentals why this global forex market is increasing on day-to-day basis. As I told you earlier, also. Okay. So the most important feature or the factors which give a huge push to this forex market is globalization. Nowadays, every country or every economy is connected with other. Okay. So in term of trade, in term of tour and travel, education, or the other purposes, right? So due to this globalization things, which lead to आपका international trade, cross-border movement of manpower and capital, travel and tourism, investment opportunities and all, they generally get expanded. And while two economies, like let's say if some foreign investors making investment in India, let's say there is a foreign investor called Mr. X who want to invest 10 million US dollar in Indian market. So first, what they have to do, they have to convert their 10 million US dollar into INR, right? So that is conversion will happen in forex market itself. Okay, let's say as an individual, you are making some ODI investment, you are opening some joint ventures or wholly owned subsidiary in some other countries. So you have to convert your INR into that country's local currency, So that is something which boost this entire forex market. Okay? And apart from this, we also use, like there are number of importers, exporters. They get involved in the swap agreements or the forward and future agreements. Okay? And for trading perspective also, it expanded drastically in past few years. Okay? So nowadays, like there are number of traders who generally deal in this particular market itself, right? So when it comes to features of this market, this is something which is part of your INIFS, but just I want to give you a basic idea around these particular ones. So while you study that आपका INIFS unit, you won't face any issues, right? So when it comes to, and this was a question in your like the recent sent in your INIFS. The characteristics of foreign exchange market can be like it's a 24-hour market again, and over the counter as well as exchange driven market. Okay, so deals in this particular like OTC is basically it's a private agreement between two parties. Like bank, they enter into a swap contract with some exporters. So that is a OTC. Okay? So that is swap and forward are OTC contract, which is generally used for the hedging purpose. And for a speculation and trading purpose, we have exchange traded derivative. You can also purchase the call option or the put option or the future contract of currency that is traded on regulated stock exchanges, right? A global market with no barriers, no specific locations. Okay. A market that support large capital and trade flows, as I gave you that example, that investment, again, highly liquid because we have number of buyers and sellers that belongs to different countries. So we have number of buyers, number of sellers, and high fluctuation also. Yeah. So basically the pricing that change on per second basis. Okay. That is the one. Okay. So these are some core features or characteristics of your forex market, right? Now, if it comes to the participants who participate in this particular market, so we have numerous participants like central bank who work as a custodian of forex for the government. Okay. Then we have corporate houses, we have bank, they usually involve in this particular market through their authorized dealer branches. Okay. We have three categories: authorized dealer 1, 2, 3, and we have FFMCs also, full-fledged money changers. Okay. We have corporation, we have the individuals or retail customers and all. So they can also deal with this particular market. Okay, so central bank manage forex reserve, reduce volatility and stabilize home currency value. Commercial bank exchange currencies for client, has invest assets and speculate currencies. ठीक है, investment bank or funds, ठीक है, move funds internationally, invest hedge across countries. Forex brokers act as intermediaries. Corporation companies they transfer funds across countries, and individual use forex for investment purpose, trade purpose, tourism, personal needs. So which can be categorized into capital and current account transactions. Okay? As an individual, we have one scheme called LRS that we'll be discussing in INIFS, okay? Liberalized remittance scheme, through which you can remit up to 2,50,000 US dollar per financial year for your current as well as capital account transactions, right? So now what is foreign exchange, that I have already told you. Okay? The rate at which we convert our domestic currency into foreign currency, or we acquire foreign currency, that is your exchange rate. Like let's say for $1 you need to pay suppose that 87 rupees. So that is आपका exchange rate. ठीक है? So exchange rate is the rate at which one currency can be exchanged into other. So value of one currency with reference to others. ठीक है? Like $1 is equal to 84.6050. So this is a kind of a conversion rate, right? So that is called exchange rate. Now we have two type of quotations. So one is आपका basically in forex market we have two type of quotation. One is direct quotation. Nowadays means since 1992 onwards, mostly currencies get quoted in direct quotation itself. So direct quotation is when one unit of foreign currency is quoted like when one unit of foreign currency is quoted uh, in term of domestic currency. Like as I gave you an example, okay, let's say for $1 you need to pay 87.2030 INR. Okay, so this is आपका direct quotations. Okay, so when it comes to direct quotations, okay, so like quotation means while you interact with the authorized dealer banks and all, so they'll quote something like this. Or even if you'll see the आपका bank branches, sometime especially those who deal with forex, they have one kind of notice board where these kind of rate get mentioned. Okay? So that is a quotations. Okay? So a direct quotation is when one unit of foreign currency is expressed in term of domestic currency, and the reverse is indirect quotation. Indirect quotation is something like this: when let's say 1 rupee is equal to 0.0125 dollar. So this is your आपका indirect quotation. So mostly you will see this type of quotation in the market itself. Okay? It can be €1 is equal to 95 INR, or one INR is equal to 0.120 euro, and this something like this, right? So direct and indirect quotation, very simple. So when it comes to your quotations or direct quotation, when one unit of foreign currency is expressed in term of domestic currency, $1 is equal to 84.6050. What is the 6050? This is called pips. I'll explain this particular one. When it comes to indirect quotations, the quote is indirect when the price of one unit of domestic currency is expressed in term of foreign currency. Like 1 rupee is equal to 0.0121 dollars. So that is a case of indirect quotation. But mostly you will see currencies, they generally get quoted in direct quotation itself. Okay? Now the next one is cross rate. Very interesting one. Okay? So when it comes to cross rate calculations, so cross rate is something आपका where like let's say cross rate which generally work on chain rule. So we will be understanding both the concept with one example here. So let's say there is a quotation given in the market, like let's say we have direct quotation for dollar and INR. So we have a direct quotation between dollar and INR. We have, let's say, direct quotation between dollar and yen. Okay? Let's say we have just direct quotation in the market. Okay? But there is a problem. Suppose that we do not have any direct quotation between these two currencies. Okay? So that means there is a case आपका where you have to define कि 1 yen is equal to how many INR. Okay? So if we have to calculate this particular one, so in this particular case, we generally apply the chain rule, and with the help of chain rule, we calculate the आपका direct quotation. Chain rule means now out of these two currency pair, ठीक है, so we have one base currency, ठीक है, so that base currency is आपका dollar, ठीक है, so we will use dollar as a medium, ठीक है, as a chain which is linking two currencies, आपका dollar, sorry, yen and INR, ठीक है, so how we are converting this, like this is working as a chain, ठीक है, chain is like basically which is linking two things, आपका, ठीक है, we use that particular one ना, so that is chain, ठीक है, this is also chain, ठीक है, so what we will do in this particular case, first from the rupee, like in case of India, let's say you have 1 lakh rupees, ठीक है, so with this 1 lakh rupees, suppose that you get आपका 1000 your $1000, ठीक है, so with 1 lakh rupees, suppose that you got 1000 rupees, now $1000, ठीक है, so now this $1000 you will dispose of against the आपका yen itself. So simply you will be calculating the exchange rate and you will be able to convert your INR into yen itself. Okay? So this is after this cross multiplication. So what we are doing basically in this particular situation, we are doing a cross multiplication scheme where we are using dollar as a chain, dollar as a base currency. So this is your cross rate and the rule we apply to convert the currency where they are not directly quoted. So we do yen and INR are not directly quoted. So we are using a common currency. So that is simply known as your chain rule. Okay? So a cross rate is exchange rate between two currencies when neither currency is the dollar, calculated by using their respective exchange rate against the common currency, which is mostly आपका US dollar. As I gave you an example also. Okay? So let's say this is an example. Okay? So let's find the cross rate between euro and GBP, assuming there is no direct quotation between euro and GBP. Okay? So these are the market rates आपका euro USD. 1 euro is equal to 1.10 USD. And GBP USD rate is 1 GBP is equal to 1.25 USD. So what we have to do, first from the euro, we will purchase the dollar. Same dollar we will dispose of against the आपका GBP itself. Okay? So when we'll calculate this particular rate, so convert euro into USD, which is 1.10 USD. Okay? Convert resulting आपका USD to GBP. So 1 GBP is equal to this. Then 1 divided by 1.25 this. So it will reach to आपका 0.80. ठीक है. So euro GBP is 1 euro is equal to 1.10 USD into 0.80. So it will come. What will be the figure आपका? This is incomplete actually. ठीक है. So 1.10 into 0.8. So your answer will be 0.88 will be the right answer for this particular one. Okay? So 0.88 is the rate which we are going to quote in this particular situation. Okay? So simply saying cross rate, if a person want to remit euro from India, and as a banker and for an argument's sake, rupee and euro are not normally quoted, and therefore what we have to do, first from rupee we will purchase dollar, same dollar we will dispose of against the euros itself, right? Let's take this particular case. If a rate in Mumbai market are $1 is equal to 78.18, rate in London market is $1 is equal to 0.83 euros. We will get $1 for 78.18 and $1 will get 0.83. So we just have to do the cross multiplication. So if 0.83 euros is equal to $1 and so 1 euro is equal to how much one so 78.18 divided by 0.83, so you will reach to आपका 94.19. So 1 euro is equal to 94.19 rupees आपका. So that is the cross multiplication, and this cross multiplication we are using through the chain rule. So what is chain rule? That mediators आपका, mostly it is dollar in most of the currencies. So calculation of the cross rate is based on a common sense approach where it can be reduced to a chain rule known as chain rule with similar steps. Chain rule is an arithmetic methods to find the cross rate the exchange rate between two currencies by using a common third currency, as we use dollar in our previous two cases, ठीक है, as an intermediary. ठीक है. You multiply or divide the given exchange rate against the common currency to achieve the desired rate where the common currency unit is eliminated. ठीक है. So this is something आपका this methodology which we use to calculate cross rate, that is generally known as chain rule. If you'll open your book, you will find only this much of statement. Okay? So like they have given references to the cross rate, the previous one, which the step to step journey, that is where we are using a common currency which is quoted for both the currencies like euro and INR, and with the help of that common currency we are converting euro to INR or vice versa, right? So this is the one. Next one. Next concept is आपका value date concept. Very important one and get asked so many time in your examination. So when it comes to value date concept, it is something like it is very simple first of all, right? So sometime what happen कि there is a date of trade, ठीक है? So date of trade, there is a difference between date of trade and date of settlement, ठीक है? So date of trade and date of settlement, right? So the time differences between these two. This happened due to time zone differences. Like in India, we have different time zone. In US, Europe, in any other country, we have different time zone. Okay? So sometime what happened? Let's say there is a trade which took place on suppose that 1st of August 2025. Okay? And now if it gets settled now, like see, date of trade and date of settlement. The date of settlement is equal to your value date. Okay? So value date, there was like when you'll come to the CIB, so there is one risk called Hersted risk, which arise due to this particular one. Okay? The time zone differences. There was one bank from Frankfurt, Germany called Hersted Bank. Okay? So what happened? Like they entered into a trade, and due to time zone differences, at the time when they have to do the settlement, the German central banks, they liquidated that particular bank in 1973, right? So after, there are a number of banks who issue or release DOS mark against that particular bank. Then we form a committee. We approaches BIS, Bank for International Settlement, one of the oldest financial institution in the world, 1930 onwards. So then we approaches BIS. BIS frame a committee to deal with these kind of issues. That committee is today it is known as BCBS, Basel Committee on Banking Supervision. So they also known as Basel norms, right? So you study this story sometime. So now this is something आपका कि trade आपका, so the day, if there is a difference between date of trade and date of settlement. So if the date of trade is 1st August, and if settlement took place on same day means T plus 0 trading and same date. So it is called cash. Okay, it is known as cash or TOD or ready. Okay. So if the settlement means आपका T plus 0 means on 1st August itself. Okay. If the settlement took place on 2nd August, assuming there is no holiday, no Saturday, Sunday, that means आपका T plus 1 next trading date. Okay. So it is generally known as tomorrow. Okay. So TOM, it is get represented at tomorrow, TOM. Okay. If settlement took place on 3rd August, again assuming there is no holiday in between, no Saturday, Sunday, means आपका T plus 2. T plus 2 means 2 working days. So it is generally known as your spot. It is आपका known as spot आपका. So now this is the one. Date of trade is 1st, date of settlement is आपका 3rd. So it will be known as spot. Now if date of trade is 1st and settlement took place on 15th of October 2025. So this is generally known as, this type of contract are generally known as forward. So you just have to remember this one. You are okay with this particular concept. Okay? So now date of the date of trade and the date of settlement. If there is any differences, so which is generally called value date. Okay? So value date is defined in term of cash, TOD आपका spot or forward. ठीक है, this means we can have two type of trade in forex market. One is spot, another one is forward. ठीक है, so cash is आपका when the date of trade and date of settlement is same. TOM is आपका when date of trade is this and date of settlement is T plus 1. If it is T plus 2, it is called spot. If settlement took place any date after the spot date, that is generally known as forward contract, right? So that is the one. That's it about the your value date system आपका, ठीक है? So let's go through this particular one. Okay. So in forex trading, the value date is regarded as the delivery date on which counterparties to transactions agree to settle their respective obligation. Buyer is transferring funds and seller is transferring the security itself, right? So that is the one. Okay. So that is called settlement. So like we have an example here also. Okay. So suppose that the date of deal is आपका 15th of March 2025. There is one trade which got executed between buyer and seller on 15th of March 2025. If it gets settled on same day, which is 15 March 2025, so it is generally known as cash. If it gets settled on 16th March, T plus 1, it is called Tom. If it gets settled on T plus 2, spot. A day, any day after the 17 March 25, it is called forward. Okay? So please do remember this one. Okay? So also this T plus 0, T plus 1, T plus 2. Okay? So these are the settlements. Otherwise, it is, if it is beyond this, it will be known as आपका forward contract. Okay? So cash exchange take place on the same day. When it comes to Tom, tomorrow, exchange occur on next working day. ठीक है, spot आपका exchange occur on second working day, T plus 2. ठीक है, so T plus 0, T plus 1 and T plus 2. ठीक है, forward rate exchange occur after spot rate. ठीक है, so it is called forward rate. ठीक है, apart from this premium and discount. ठीक है, now we'll be discussing this, but this is something which is not part of value date actually, but in your book they have compiled this particular one. Okay, so what is the case of premium and discount? Let's make this understanding. Let's say USD, the market rate for $1 is quoted as 87.2030. Okay, this is the current market rate today. So this is, that means for $1 you need to pay 87 rupees INR. Okay. Now first you have to make your understanding what is this 0.2030. Okay. So see, in this particular case, like if, let's say as a banker we are quoting like this. That means if you visit exchange houses, they'll quote something like this. That means if you want to buy, so the buyer rate is आपका 87.20, and if you want to sell, seller want to sell at 87.30. Okay? So this is the meaning of this. This is a buy rate and this is a sell rate. Okay? So buyer always want to buy at lower price, seller always want to sell at higher price. That's the basic logic of the market itself, right? So this is the one. Okay? Now this is spot rate. Okay? This is spot rate, means आपका current market rate आपका. Now the currency is, can be, let's say, and we have currency future also. So suppose that the same USD INR 3-month contract, 3 months आपका later contract, a future contract, which is quoted in market as $1 is equal to, let's say, 88.5060. Okay? So this is the mean, this is a case of premium. Why it is called premium? Okay? So what is the formula or the basic logic? When your forward rate or future rate is greater than your spot rate, so it's a situation of premium. Okay? And the premium will be discounted on, premium will get added in both. Like in this case, your buy rate is 88.50, here it was 87.20. Here sell rate is, this is your buy rate, this is your sell rate, 88.60, 87.30. So that premium, first of all, this currency is in premium because their future rate or forward rate is higher than the spot rate. Okay, so this is the situation of premium. The another one, let's say there is one case आपका, ठीक है, let's say the 6 month later or the let's say 6 month later contract of the same currency is quoted as this is spot rate. Okay, so it is quoted as 85.2030. Okay, or it is 2030. Okay, I'll change these numbers. So let's say 4050. Okay, it is आपका 4050. So this is a case of discount. Okay, the spot rate is आपका 87.2030 and the 6 month future contract आपका where buy rate is आपका 85.40 and sell rate is 85.50, right? So that means it's a case of discount. Why this is a case of discount? Why this is a case of discount? Because your forward rate or future rate is less than your spot rate. So that's why it is called आपका currency is in discount, and this discount will get deducted from both buying rate as well as selling rate. Buy rate 87.20, here it is 85.40, right? So that is the case. Now, currency costlier in forward market again. So premium means currency costlier in forward market. That means what? Your forward rate is greater than your spot rate. Okay? And when the reverse case, आपका currency is cheaper in forward market means your forward rate is less than your spot rate. So that is said to be in discount. Okay? So this will help you while you solve the question sets. Okay? Now the most important part and the most difficult part also. So this is a case of आपका forward rate exchange. Forward exchange rate. How we determine forward exchange rate. This is something which generally like we use different methods आपका. Like let's say, as I said, कि let's say the spot rate is suppose that 87.2030 for USD INR. USD INR currency. Now 3 months later, the forward rate is what will be the forward rate? So let's assume it is आपका 87.8090. So how we calculated this particular one? So what is the calculation method for this particular one? That is your forward rate calculations. So first of all, forward rate are basically these get settled in a future date. Future date means आपका date of trade is, let's say, they generally get settled after the spot date. Okay? So we can have two type of trade. One is spot, which gets settled in T+2. Another one is आपका forward rate, again, which gets settled in future date. Like as I gave you an example, the date of trade was 1st August and date of settlement was 15th of October, right? So that is forward rate. So how we calculate these particular pricing and all? So that is this. So foreign exchange, also referred to the forward rate, is the rate at which a bank agree to exchange one currency for another at a future date when it enter into a forward contract. Okay? How we calculate usually these kind of things? So we have a formula. So forward rate is equal to your spot rate plus आपका premium minus margin. Okay? So this is the formula which we have to use in case of when you are quoting the buy rate. When you are quoting sell rate, again, this is the case of आपका buy rate. Again. So when you are quoting the sell rate, how you calculate this particular one? So it is equal to forward rate is equal to your spot rate plus premium plus margin. Okay? So this is the one which formulas we use to calculate this one. Okay? So in our previous session where we generally talk about the forward rate. Okay? So when it comes to forex market, basically we have two type of major position. One is which gets settled up to T+2, which is 2 working days from the date of trade. Basically that is generally known as spot. Okay? The another one is we have when settlement took place in any future date beyond the spot date. So that is generally known as forward. Okay? Now, like forward contract, they get traded on OTC as well as recognized stock exchange. We have 4 different type of contract. Like it can be when it comes to exchange traded, we have future and options. when it comes to OTC, we have forward and swaps, right? So how we do generally valuations of these particular ones? So that is which we are going to discuss in this particular case. How we generally decide the prices based on the current market price, right? Or the spot rate. So when it comes to a forward, your forward exchange rate, so it is also referred to the forward rate or forward price, is the exchange rate at which a bank agree to exchange one currency for the another at a future date, when it is entered into a forward contract with an investors. But before understanding this particular one, how actually we calculate these particular things and all, so as I said yesterday also, so these are the formulas and all. I'll just like when it comes to the formula, so this is the formula. But before that, you have to make your understanding how actually these particular work. Okay, so let's say there is a currency pair. Suppose that USD INR. Okay, so let's say in USD INR, the spot rate, the current market price, okay, which is equal to, suppose that 87.2030. Suppose that this is the current market price for USD INR. Okay? So that means for $1 you need to pay आपका 87 rupees. Buyer want to buy at 87.20 and seller want to sell at 87.30. Okay? So out of this, I hope you remember that buy and sell rate. Okay? So what does it mean? So buyers, the rate quotation is आपका basically buyer want to buy at 87.20 and seller want to sell this particular one at 87.30. That means when you are quoting a buy rate, so when you are quoting a buy rate, you will take this particular price, and when you are quoting sell rate to your customers, so in that case you have to take this particular price, right? So now, like a bank, they generally entered into a forward contract or swap contracts or future contracts with the importers, exporters. Okay? So now what you have to remember, like when you quote the buy rate, okay? So what will be your formula? So when you are quoting a buy rate आपका, ठीक है? So buy rate, which we generally quote in the case of export, so exports आपका, ठीक है? So that is something, your forward rate or future rate is equal to spot rate plus your premium, ठीक है, minus आपका margin, ठीक है? So this is the formula for the your buy rate, ठीक है? When you are quoting the same rate for the when you are quoting sell rate, which is usually in case of imports, ठीक है? So imports. So what will be the formula? Your forward rate is equal to spot rate plus premium plus margin in this particular case, आपका, ठीक है? Now like there are two other points. Spot rate we all know, okay? So now what is this premium or margin? Okay, so this will be given in question itself, okay? So this is something which is called intrinsic value, okay? Which include the time value and opportunity cost, okay? So because these contracts belongs to a future date and there are some chances or there is kind of a there will be some sort of movements or there will be there are some investors expectations or the time period or the time value of money which is involved in this particular one. Margin is something, while we buy the things, we have to pay some initial margin. When we sell, we receive the margin. So that's why in this particular case you are paying the margin. In this particular case you are adding the margin. Okay? So that is the basic calculations in this particular one. Okay? Now this is the formula which you have to remember first of all, because it will help you. Believe me, if you understood this particular very well, you will be able to solve each and every single question. I hope you guys remember. Let's say the 3 month later, USD INR is quoted as suppose that 88.5060. Okay, that means this is in आपका premium. This is the case of premium. Okay, so it is a case of premium. And when it is quoted as like the discount quote, the discount is something, let's say आपका there is one another, like let's say 6 month 6-month contract of USD INR, which is quoted as suppose that 85.4050. ठीक है, this is a case of your आपका discount. ठीक है, this is a case of discount. ठीक है, so yesterday also I talked around this. ठीक है, so premium means आपका when your forward rate is greater than the spot rate. ठीक है, just do remember this particular one. And when it comes to discount, ठीक है, so discount is equal to when your forward rate is less than your spot rate, as you can see in this particular one. And this premium or discount, when it is a case of premium, it will get added in buying rate as well as in selling rate. So this is the buy rate and this is the sell rate. So here buy rate is 88.50, here it is आपका 87.20. That means there is a premium in buying and premium also available in selling, 88.60, 87.30, right? So that is the case. Similarly, when it comes to the discount, so also it get involved in both buying rate as well as in selling rate, right? Now with this particular with the help of this particular one, so with the help of few questions, we will try to build our understanding here. So like forward rate is equal to it's a buy case. The rate is quoted here, the formula buy rate, or it is kind of for a export bill. So buy rate is equal to your spot rate plus premium, or आपका if it is a discount, so you have to minus discount. So discount will this is the case. See one another thing. So forward rate आपका plus premium in case of when it is in premium. If it is a situation of discount, you have to minus that particular one. As I gave you two different examples. If it is a case of premium, you have to add, or if it is a case of discount, you have to minus. In case of sell rate, when it comes to sell rate, so in case of sell rate, you have to quote like आपका spot rate, then we have plus premium plus margin. So margin you have to add. Margin is like the initial money which we pay. And if it is a case of discount, so you have to minus discount. Similarly, the only thing that will change, that is this margin point, right? Now let's go through the question. If inflow of 10,000 US dollar by telegraphic transfer for credit to your exporters account, it is mentioned exporters account. That means you have to quote the buy rate. Being advance payment for export credit received in Nostro are many video statements received from the New York correspondent bank. What rate will you quote to the customer if the current market rate is this? So they just have to ask like what rate you are going to quote to the customer. So what rate you will quote in this particular case? You are going to quote आपका what is the buy rate in this particular situation. So what is your buy rate? So buy rate is आपका buy is equal to so buy rate is equal to so buy rate is आपका 84.10. That is the answer of this question. So if it is a case of import, so you have to quote the sell rate. So sell rate is आपका 84.15. So this is the answer for this particular one. If but the question will not that simple. This is just to build your understanding. We'll come to the question itself. So it will be a purchase USD from the customer for which USD will have sold in the market. Say USD INR is being quoted at 84.1050, meaning the market buy USD at 84.10 and sell at 84.15. That we have discussed. We shall have to quote rate to the customers on the basis of market buying. So the rate is आपका 84.10, and if there is any premium or आपका margin is given, so you have to accordingly adjust this particular one. If it is a buy rate, so as our case is a buy rate, so you have to add premium and minus margin. Or if there is discount, you have to minus discount and आपका minus margin itself. So that is applicable to arrive TTE for this particular one. So the first question, second one. Now this type of questions, if you understood this, you will be able to solve BFM case study in your CIB. Though like there are very less chances in your JIB. I never seen this type of questions, but they have given in your curriculum. So let's try to understand this. So 15 September, a customer request for booking forward contract for export bill 2 lakh US dollar. So it is आपका forward for export bill, आपका export bill 2 lakh US dollar to be realized in the month of December. ठीक है. The given USD INR rate is suppose that 68.4550 and forward premium are under this. ठीक है. And the margin is आपका this. So now you have to calculate something. ठीक है. So that is like how we calculate this. Forward rate is equal to your spot rate plus this is a case of premium minus margin. Okay, so this is the formula which you have to apply here, right? So now in this particular case, so it's a buy rate. Why I have quoted the buy? Because it is an export bill. You are going to purchase those particular one. Okay. So now in this case, you'll see two things. Okay. First one is when it comes to this is the current rate आपका. ठीक है. So the spot rate which you are going to quote here, that is 68.45. ठीक है. This is the rate which we are going to quote. This is the spot rate for the buy. ठीक है. Spot rate आपका. ठीक है. Why not this 50? Because if it is a sell case, ठीक है. If it is a import case or if where you have to quote the sell rate, so you will take 68.50. ठीक है. So this is your buy and we are buying in this particular one and this is your sell. ठीक है. Now the premium. ठीक है. So premium, now they have given 3 month consecutive premium. So in this case, now you have to remember this month आपका. ठीक है. So they are asking you to calculate आपका this forward rate for the month of December. ठीक है. And as there is no date mentioned here, so in this type of situation, you have to always assume this is for 1st December, right? If they'll like if they want to calculate for 15 December or end of December, that will be clearly stated in the question itself. Okay? So whenever you'll see this kind of statement, that means you have to quote the you have to take the premium from the month of December itself. Okay? Now in this case, sorry, you have to quote for the December. That means 1st December. That means you will take premium for the month of November, right? So November, that means there is no uses of this as well as this. You will take this buy side premium. Okay? So this is the buy side premium. This is the sell side premium. As we are quoting a buy rate, so you will take आपका premium. So add premium. That is how much? 0.25. Okay? That is your premium in this particular situation. Okay? So why we take this particular one? Why not this? Why we are not adding this? No. Because see, this is 25 paisa, the premium which is part of this particular one, that already include, it is a combination of time value and intrinsic value which already include this October 20. And now we are quoting for the 1st of December. If it is 31st December or end of December, then in that case you will take this particular one. Understood? And in case of selling, if it would be selling rate, you have to calculate sell rate. So here you will take 68.50 and here you will take आपका 30 पैसा. ठीक है. Now the margin is आपका how much? 0.05 पैसा. So finally, like this is total आपका 0.7. ठीक है. 0.68 minus margin. ठीक है. As it is a case of buy rate, if it is sell rate, you have to add the margin, and it is a case of sell rate, so you have to minus margin. How much? 0.05. So it is, your answer will be the rate which we are going to quote customer, which is 68.65. Okay? This is the rate which we are going to quote in this particular one. Okay? So this is your forward rate. So sometime though you will be understanding these particular things in CIB in detail, but here they have given a basics around this entire concept, right? So for calculating rate forward purchase contract, we need to take forward premium for November. The one that is market would pay that is 30 paisa. Again, spot rate is 68.45 and getting the forward interbank is your 68.75 and the margin is आपका 0.05. So it will come to 68 point. It was not 40 paisa. It is 25 paisa. Sorry. ठीक है. So it is buy side. It is आपका 25 paisa. So it is आपका this. So we reach to this minus margin 68 points आपका 65. ठीक है. So this is something. Here it is clearly mentioned. ठीक है. So forward margin for the period prior to the start of the delivery period would be pass on as customer has option to deliver currency on first day itself, so it is that's why we are considering 1st December, right? So that is the logic behind this. Now, after forward rate, there is one terminology called that is generally known as forward points. आपका ठीक है? Forward point is nothing. It is very basic and it get asked in so many times. ठीक है? So it is the differences आपका ठीक है? So sometime you'll see the differences. Differences is like as we quoted. Let's say it should be given in this case. ठीक है? हाँ, let's go through this one. ठीक है? So forward point express the difference in price between the current spot rate or the future rate for the currency. They are expressed in pips, the smallest unit of the of a currency quoted, like 0.0001, and are added or subtracted from the spot rate to arrive the forward rate. Yeah, that is also known as your premium or आपका discount case. For example, if a spot rate is आपका 1.200 and the forward point is 25 paisa, 25 paisa, ठीक है? So forward rate would be, you have to add this particular one, so it will be आपका 1.2025, ठीक है? With one example, ठीक है? Let's say this is the case. So difference between the spot rate and forward rate is, spot rate आपका 1 euro is equal to आपका $1.2181, ठीक है? So 3 month for this is the spot rate and the forward rate is 1 euro is equal to 1.330, ठीक है? 1.2330. So the differences between these two, ठीक है? So this minus this, so that is the difference that is generally known as your आपका forward point. So which is 150 in this particular case. You just have to do plus minus, nothing else. Okay. So factor determining forward rate. So it is basically this is something which is linked with the fundamentals of currency. So in which situation currency will get strength or in which situation currency will get weaker, right? So let's say there is a currency pair USD INR. Okay. So if there is let's say the current rate, suppose that USD INR, okay, and the spot rate is supposed at 87.2030. Now that means for $1 you need to pay 87 rupees, okay, or 87.20 rupees if you want to buy this particular one. Okay. So now when this dollar will get a strength, okay, means when it will become 89, or when this dollar will become weaker, that means for $1 we have to pay only 84 rupees. Okay. So if it is coming down, that means dollar is we have quoted the core base currency is dollar. Okay. So in this case dollar is getting strength. For $1 you have to pay more rupees. In this case आपका dollar is getting weaker because for $1 you are getting less number of INR, right? So now when will this particular happen? How this currency will move upward or downwards? Okay? So there are so many reasons. These reasons are further categorized among fundamental and technical. Okay? When we'll come to the IA and IFS, this is part of IA and IFS actually. Okay? So fundamental reason are basically the BOP of the economy. So they are directly linked with the economic situations. Okay? So let's say there are some let's say India's BOP is getting higher. Let's take the recent action by the US government. Okay. So US government or Donald Trump government, they generally increase tariffs on India. Now we have to pay more. That means our BOP will come down. Okay. So our balance of payment will reduce. That means we have to pay more. So that will give a strength to a dollar. Okay. That is giving some sort of strength to dollars. So dollar will go up. Okay? So if your BOP, if you are studying with point of view of US, if their economy or their BOP is getting strength, the dollar will go up. Okay? If they have a political stability, if they have some fundamental reasons, the other fundamental reasons like their monetary fiscal policy or the interest rate in the economy. So if they are in favor of US economy, dollar will get strength. Okay? And if there is a reverse case, let's say if Indian economy is getting some sort of strength from the fundamental elements like BOP, our BOP is getting let's say strength, or our export is increasing, we are receiving more and more investments, so that will provide strength to Indian economy, ठीक है? So and the dollar will आपका come down in this case. So that will decide the things आपका. The forward point is basically what is the expectations of investors from that economy in the coming futures. Let's say if it is of 6-month context, so how we see Indian economy in next 6 months, what will be the overall payment and remittances in next 6 months. If it is in India's favor, so this will come down. If it is in US favor, so this will आपका dollar will go up, right? So supply and demand, okay, that is simply आपका, if we will have demand for a US dollar, obviously the prices will increase. If we will have supply for dollar, the prices will come down. Okay? For the currency on settlement date, market view, expectations about the future interest rate and forex development, interest rate differential between countries, that is for the capital flow. Like let's say if economies like Indian economy, they have higher interest rate compared to US. That's why we attract more and more investment in the country itself, right? So these kind of things. So if you're, let's say if we are giving higher rate of return, so investors will invest in your economy. So it will bring some cash flows in the economy. Obviously, there will be demand for INR, right? So forward point reflect the trade-off between interest earned in one currency versus opportunities foregone in another currency, right? So this is the one. Now, premium and discount case, this we have already discussed earlier also. So this is the last point. As I gave you an example, let's say the USD INR, the USD INR spot rate is supposed at 87.3040. Okay? Let's assume this is the spot rate. Okay? And it can be quoted in premium. Aapka, okay? Let's say 6 months later, premium, it is in premium. Okay? So let's say 6 months later, aapka, it is quoted in premium. That means the price will be higher than this. Okay? Let's say it is quoted as 88.2030. Okay? So this is the case aapka. Okay? So this is the case of premium. Premium is equal to your, when your forward rate is greater than spot rate. Okay? Then it can be in discount also. Okay? So when it comes to discount, so it is aapka when your forward rate is less than your spot rate, right? So that is the situation. So let's say it is quoted at 85.6 months later, it is quoted as 85.7080. So this is the situation of discount. And the premium, if it is premium, it will be in buying rate as well as in selling rate. If it is discount, so it will be in both buying and selling rate. So forward premium, when the currency's interest rate is lower than another, its forward rate will be higher than its spot rate. The point added to the spot rate are forward. The positive side aapka pointers. And the discount rate aapka, a similar one, and lower than the spot rate, the points subtracted to this particular one. So to calculate, if it is a case of premium, you have to add the forward point. If it is a case of discount, you have to minus those particular forward points. As we discussed earlier also. I gave you one case now, that's 68 point something. Then we added premium. Why added premium? Because that is the logic. And this is aapka this. So this is all about your concepts. Okay, we have arbitrage also, sorry. So next one is aapka arbitrage. So arbitrage, when it comes to arbitrage, it is very simple. Buying in one market, selling in another market. Sometimes what happened due to market inefficiencies, you majorly aapka. Okay? So it is something like there is a differences between two prices. Same differences in prices of same security or commodity in two different market. Like let's say, let's take an example in Shimla. If you go Shimla, so apple is very like you'll get 50 rupees per kg. If you'll come back to Delhi, the apple per kg is 150 rupees per kg. So it's a kind of a risk-free interest. Okay? If you buy in Shimla, and let's say there is a cost of 50 rupees to bring those apple from Shimla to Delhi, let's say still you'll have 50 rupees in your hand without any risk. So that is a case. Okay? Let's say there is a security. Let's take an example of USD INR. Okay? Suppose that in market A, it is aapka 80, let's say it is 86.50. Okay? Buy rate is this. Okay? 86.5060, ठीक है. In market B, it is trading at, suppose that 87.1020, ठीक है. So what you will do in this particular case, you will buy here and you will sell there, ठीक है. So you will buy a dollar in this particular market at 86.50. Same dollar you can sell here 87.20. So the difference between these two prices is your risk-free profit. So this is generally known as arbitrage, right? I hope everybody know about this. So arbitrage is the simultaneous purchase and sale of the same asset in different market to profit from temporary price differences, exploiting the market inefficiencies, as we did in this particular case. So this is the situation of arbitrage itself, right? So how arbitrage work? Spotting an inefficiency, first of all, okay, you have to find out where this difference it is. Okay. So, or it can be triangular also. Okay. So like as I gave you an example, it's a आपका it is between two currencies. Sometimes it can be like when you'll come to CIB, we'll be understanding that one. Okay. There are triangular arbitrage also. There are link between different currency, USD INR, USD Euro, and USD Pound. So if you study all these particular one, do the conversion, cross rate conversion, sometime you'll find opportunity or there is a gap between forward pointing gap between all these particular pairs. So what you'll do, you buy, sell, and then you'll make a risk-free profit also, right? So spotting an inefficiency and arbitrage identify the same asset trading at different prices in two market. Again, simultaneous execution. So you have to buy one market and sell in another one. Okay, so quickly make benefit from this one. Okay. And profit realization. The differences between the buying and selling price after accounting for cost. It is आपका arbitrage profit, okay? But it is illegal in the market, okay? Especially in case of equities, it is not allowed, right? In equities also, you can buy in BSE and sell in NSE, right? So that option is available, but it cannot be done in intraday trade. So that's why that is like to block these kind of arbitrage opportunities itself, right? So this is it. The basic introduction and then factor influencing decision on capital structure, theories of capital structuring, taxation, concept of cost of capital, cost of debt and cost of equity, then weighted average cost of capital, factor affecting weighted average cost of capital, marginal cost of capital, then we have flotation cost and cost of capital. So these are some subtopics which are very important from this particular unit, right? So most of the time, examiner they ask one question around the factors. The another one question for sure you'll get from this particular one. Okay? So especially that net income theory of David Durant. Okay? Then taxation and capital structure. This will be kind of a case study combination of these two. Then one question for sure you'll get on weighted average cost of capital every time they ask this question here, and flotation cost and the other one also. Okay, so these are some important subtopics which are generally part of this particular unit. So we will be discussing all these one by one. Okay, before that, I have started taking live session for your November 2025 examination as well. Okay. So for AFM, those who are only part of specific AFM batch, so your classes will be on Thursday, team. So Thursday and Friday and आपका Saturday. ठीक है? These 3 days I'll be seeing you with live classes at 7 p.m. ठीक है? So you'll get notification if you are specifically part of any AFM course and all. ठीक है? So please make your availability on this particular one. And the prerequisite is you have to watch the concept videos. Though with the help of questions and concept, we will be trying to revise or build our concept also, right? So let's start the discussion. So when it comes to capital structure, this is again this is a topic which will help you in ABFM subject in your CIB examination also. And if you go for any other examination, 100% this will be a part of that one also, right? So guys, when it comes to capital structure, it is like how companies they are arranging their overall funds, take a sources of funds. Take a, like let's say companies or businesses, they do some sort of, they are planning for some sort of business expansion and all. Okay? So for that expansion, they'll be requiring some sort of funds. Okay? Let's say there is an XYZ company who is planning for any sort of expansion. Okay? And for this, their capital budgeting is suppose that they require a budget of suppose that 100 crore rupees. Okay? So they need 100 crore rupees to finance these particular activities and all. Okay? Now, like by what sources they are going to finance these particular activities. Okay? So they can have two major areas. One is the equity, which is आपका sale of ownership. Another one is आपका debt. ठीक है, debt is kind of this is outside liability. ठीक है, so these are the two one. ठीक है, when it comes to choices between equity and debt, that is your capital structure decision making. ठीक है, and this is the capital structure. Let's say there is a company, like let's say this XYZ company, they are planning for a ratio of 30:70. ठीक है, that means 30 crore rupees they are going to raise through equities, and 70 crore they are going to raise through your आपका debt portion in loan, bonds and others. ठीक है, so overall 100 crore rupees आपका. Now these decisions, like before making this kind of decision, which is part of the optimal capital structure, it can be differ from each and every business or industry wise, or based on the financial risk. Okay? How we decide this particular one, we will discuss that particular one. Okay? But most of the time, what you will see, ki, yeah, the two elements, one is equity. When it comes to equity, basically this is something where you are going to share some sort of ownership, being a owner of this particular company in this, in term of shares. Okay? You do not have to pay any sort of interest on these kind of this kind of for this, like let's say you issue 30 crore rupees equity in the market, you do not have to pay any interest on that particular one. When it comes to this is outside liability, and this you have to pay back, you have to pay them, the lenders, basically amount which is आपका in term of interest itself, right? And you have to repay this particular amount after the committed time, right? Now companies, when you'll see maximum time, you'll see the debt portion is higher than the your equity portion, because there are so many reasons behind this one. Okay? For the core reason are like, with debt we got some sort of financial leverages. Okay? So while you raise funds through debt, it will help you to increase the market value of that particular company. Let's assume the company's market value is 1000 crore. Okay? Now they issue, if they issue 100% equity, 100% equity, if they raise, means this 100 crore rupees through equity only, their market value will remain 1000 crore only, because from this ownership itself they are sharing some ownership point with the common shareholders. But when they raise this particular one, let's say if they are raising this particular one 100% through debt, so now their market value will increase to 1000 crore plus आपका 100 crore. So their market value will become 1100 crores आपका, ठीक है, 1100 crores in this case. So this is called trading on equity or the financial leverages. ठीक है. Now but here in this particular case you have to pay, this is your outside liability, so you have to pay return the interest to the users also. Now you'll never see something like this, but most of the time there will be the combination of both equity as well as debt. But maximum time the debt portion will be higher, because one thing, it help company to take the financial leverages, it increase the market value of company, and the interest you are going to pay to the customers, that you can show as a operating expense, so you can adjust that particular one before tax payments. How it will make an impact, very important. Let's say there is a company who raise this one. Okay, so suppose that they raise like if they go with this particular one, suppose that tax rate is in India is 25%. Okay? So in this particular case, they are not paying any interest. So the tax, total tax will be zero. Okay? They won't get any benefit from this one. Okay? But when it comes to this one, okay, so let's say during that particular period, now like they have, sorry, tax rate will be 25%. So 100 crore ka, like whatever profit they have made, okay, let's say their profit during that particular period is aapka 10 crores. So 10 crore ka 25%, that is 2.5 crore rupees they have to pay as a taxes आपका, ठीक है, whatever the number it is, ठीक है, 2.5 crores or 25 lakhs, ठीक है, so that they have to pay as a it is 25 lakhs only, ठीक है, not let's assume it is 100 crore, okay, they made a profit of 100 crore rupees, okay, so they have to pay taxes of 2.5 crore rupees in this particular case. Now when it comes to the debt side financing, what will happen, okay, let's say their profit is आपका 100 crore rupees, ठीक है, and the interest paid by the company, let's say the interest paid on this debt form was, suppose that interest was equal to 10%. So that means 10 crore rupees आपका 100 crore का 10% is 10 crore rupees. So this आपका 90 this will become 90 crore, ठीक है, so you have to minus the this, and 90 crore का at the rate of 25% they have to pay the taxes, ठीक है. See, so with this debt portion they are getting a benefit of they are getting tax benefit also, because here this 10 crore rupees which we have paid to the these lenders, that will get deducted as an operating expense. So this is something which we have, okay? So every tool they have their own benefits or their own liabilities, okay? And why companies they keep this particular one high? There are two major reasons. One is the overall market value will increase. Another one is they'll have tax benefit also. And in this case, they the owner they generally lose the degree of control also. Now there is one another thing which is called cost of capital. So when it comes to cost of capital, it is as simple as that. Again, so cost of capital is equal to, or cost of debt is equal to आपका, ठीक है, which is generally known as KD, ठीक है. So cost of debt is equal to your cost of equity plus आपका cost of debt, ठीक है, so cost of debt. So these two आपका which is generally part of this one. When it comes to weighted average cost of capital, so it is how we calculate weighted average cost of capital. It is equal to cost of equity into portion of equity, again portion of equity plus आपका cost of debt into portion of debt, ठीक है, so that is the formula to calculate this one. So you'll get weighted average cost of capital of that particular company, and based on that particular one only you'll get the questions also. So when it comes to capital structure, it is all about how companies they are managing their budget, from which sources they should raise funds, okay, that get that bifurcation between equity and debt, that is called capital structure, okay? And how what should be the optimal ratio for this one? There are so many elements, and for that sake we have three major theories. आपका net income theory, ठीक है, the another one is net interest income, आपका irrelevant theory and traditional theory, right? So these are the areas, ठीक है. And why debt portion is higher? What is weighted average cost of capital, cost of debt, ठीक है, weighted average marginal cost of capital, in others these things they are interlinked with each other, and even the tax benefit also. So we will be discussing all these particular one by one in this particular session, okay? So when it comes to आपका basically this is generally known as balance sheet equation. Asset equal to आपका liabilities plus owner's equity, ठीक है. So what should be the portion of equity and debt? What will be the portion of equity and debt? That is generally known as your capital structure, ठीक है. Let's say it can be आपका 50-50, ठीक है, or else it can be your 20-80, or it can be your 70-30 or the others one, ठीक है. So it is depend on the type of business and their the financial risk or the overall business risk involved in the market itself, ठीक है. So there are two major elements. One is equity, another one is debt. Now we can have equity, we can have different type of equity, like preferred equity or the common equity. In case of debt, we can have different sort of different form of debt, like we can have bank loan, term loan, it can be in the form of debentures, it can be in the form of bonds and others. Okay? So that's generally part of this particular one. Okay? So in this particular session, we will be discussing all these things. So capital structure refer to a specific mix of debt and equity used to finance a company's assets and its operation. From a corporate perspective, equity represent a more expensive. You have to always remember this particular one. So cost of equity is higher than cost of debt. That's why most of the time what you will see. So as I mentioned there also, so let's say the debt to equity ratio is supposed that why it is 70 to 30, because the cost of equity is always higher than cost of debt. Okay? So because we lose the degree of control, though you are not paying any interest on this particular one, but you are losing आपका degree of control. You are not having that tax benefits and others, so that's why that's becoming expensive. Okay? But it is a permanent source of capital with greater financial flexibility, right? So debt and equity are the two primary type of capital sources for a business. Capital structure is defined as a combination of equity and debt that is put into use by the company in order to finance the overall operation of the company and for its growth. Okay, as I gave you an example of that XYZ Limited. Okay, they are planning for the expansion purpose, and for that expansion purpose they need, let's say, 100 crore rupees. Okay. So how they are going to arrange that particular one? So they are arranging through the source of they can have either equity, either debt, or a combination of both. Mostly companies will go with the combination. Now, when it comes to optimal capital structure, so there is no fixed ratio for industry wise or for companies. It depends on company as well as the industry type आपका, ठीक है? So majorly two sources आपका, one is business risk, ठीक है? Another one is आपका financial risk. So what type of business risk and financial risk involved in that particular business, that will decide your optimal capital structure ratio. Okay? It can be like 50-50 or your 60-40, 40-60, 65-35 or anything else also. Okay? It totally depend on these particular sources. Okay? And even like the internal policies of the organization or the government norms or the other sources also. Okay? So optimal capital structure is referred to as the perfect mix of debt and equity financing that help in maximizing the value of company. That this can be done through debt portion in the market while at the same time minimize the cost of capital. That means you have to also consider the equities at a lower side. Okay? So that is a kind of things, and eventually it will come to the आपका financial risk and business risk आपका, ठीक है? Now next one, financial leverage. So as I earlier told you about this, ठीक है? So whenever it comes to financial leverage, leverage is basically like we used to say one statement now, derivative are highly leveraged funds. Okay? So with less investment, you are getting more value. Similarly, here also, when it comes to financial leverage, it is equal to the portion or the amount you are raising through debt. Okay? So financial leverage in case of capital structure is the portion of debt you are having in your capital structure, right? So when, as I gave you an example, ki the company's XYZ let's say there is a company, okay, to purchase asset they raise some funds आपका, and they what is the basic idea behind this, okay? Let's say there is a company whose current market value is 1000 crores, okay? They raise 100 crore rupees debt आपका, okay? Now their market value will become आपका 1100 crores, okay? Why? Because they have borrowed it at 10%, suppose that, again, and the return on investment, again, let's say the ROI on these particular investment is supposed that 15%. So they are paying back that 10% also, still they are having 5%. So this way we utilize this, and this is also known as trading on equity. Okay? So financial leverage is when companies take a debt for investing in business operation to gain profit in return. So that is called financial leverage, and this is done through the debt portion also, right? So financial leverage is defined as proportion of debt that is part of the total capital of the firm. It is also known as capital gearing. A firm having high level of debt is called highly leveraged, and low level of debt आपका low leverage, right? So, but it is suggested by number of theories कि when it comes to equity and debt, the debt portion should be higher side because we have tax benefit, we have uh, it helps to increase the market value, or like while your investment are perfectly assigned or aligned, so your ROI will be obviously higher than your overall purchase debt आपका, ठीक है? So this will give you benefit in so many ways as well, right? So that is the thing. So basically what we are doing, we have borrowed 100 crore rupees at the rate of 10%. This is people's money, ठीक है? We invested this particular one and in our business, and let's say our ROI is आपका 15%. So 10% we have to return back to the investors. Remaining 5% it's still you are in like kind of a, you are making money from others' money. Okay? So you are making you are increasing the value of your company by using others' money. So that is something which is generally part of this particular one. Okay? Now, factor affecting capital investment, or sorry, capital structure decision. Very, very important one. Okay? So this get asked for 1 marks or half marks so many times. So please go through these particular one. If you have understood the concept of capital structure, you will be able to easily relate all these particular one. But this is something which is which is kind of exam questions which get asked so many times. So you have to remember these one. Okay? So first one is आपका norms in financial system. That means the guidelines of that particular country or the industry. Okay? So like in case of India, so we have some specific guidelines. We have regulators and all. Okay? So you have to fulfill those particular one first. Okay? So lending policies of bank or financial institution restrict debt equity ratio. Excessive debt is not allowed beyond reasonable levels. Okay. Rating agencies also assess debt equity proportions. Okay. The another one is degree of control. So if you'll go with degree of control, this is something which is linked with your आपका equity. ठीक है? If you issue more equity, you will lose as a owner. You will lose ownership in that particular business. ठीक है? So promoters avoid diluting आपका voting rights by issuing more equity. Prefer debt instruments like debenture to raise the fund also. ठीक है? Trading on equity, that financial leverage that we have discussed. ठीक है? Using debt can increase return on equity if earning exceed borrowing cost. As I gave an example of 10%, we borrowed on an average 10%, and our ROI was आपका 15%. ठीक है? So this will help to increase your overall valuation by 5% also, and similarly the other areas also. ठीक है? More debt आपका higher profit per unit of equity if business perform well in this particular case आपका. ठीक है? So that is one. Apart from this, cost of debt is also important here. So as we all know, cost of equity is higher than cost of debt. ठीक है? So that's why we favor the आपका debt portion in our capital structure. ठीक है? So interest is tax deductible, but high debt increase the financial risk. अब it should not be 100%. ठीक है? That's why I told you कि like we cannot have 100% equity, 100% debt. Okay? We have to manage things. We have to find out an optimal structure for our business based on the business risk and the financial risk. Okay? So it can be like in that particular one, theories they generally support that debt portion should be higher. So that means we can have debt to equity 60 to 40 or 70 to 30. But till you can increase that debt portion till some extent. Beyond that, it will like there will be some sort of आपका high debt increase of financial risk, so that will increase your financial risk also. Okay? Beneficial only under favorable business conditions where you will be able to achieve this. Your borrowing is आपका 10% and you are gaining 15%. If it is आपका 7%, then that debt will become financial risk for your business because you have to pay from your pocket now, right? Average condition may lead to insolvency if firm cannot cover the interest cost. Okay? This is the one. Okay? Or if there is any, let's say we have taken debt, we deploy in some project and it gone like that project got a failure. Okay? So in that case, you have to pay from your pocket for the coming years, right? Size of firm and business plan also. Okay? So large firm may sustain higher equity, while smaller firms prefer debt for easier payments. A firm with a limited expansion plan may keep low equity capital. Reducing equity is difficult due to regulatory restrictions also. Okay, let's say once you have released the shares, maybe the shareholders, they do not sell back those particular one if you are planning for any sort of buyback. But in this case of debt, you have fixed time duration, fixed interest and everything. So during that particular one, you have to pay that particular. Okay. So this is something, these are some core factors which generally affect the capital structure decision. Now the next one, which is like whenever companies, they decide their capital structure. So for that sake, we have three major theories. So theories of capital structure. One, net income theory, another one is net operating theory, and the third one is आपका traditional theory. ठीक है? So now out of these three theories, the most famous one is आपका net income theory of David Durant. This is also given by David Durant. This is some lady, I just forget this name, it will come. ठीक है? So when it comes to the basic introduction of all these particular theories, what David Durant suggested in this particular theory, he said कि in a like while companies, they are planning their capital structure, means आपका the portion of equity and debt, ठीक है? So the debt portion should be higher, ठीक है? So the debt portion should be higher, ठीक है? And all those arguments like taxation or that it helped to increase the company valuation and all, those all were given by David Durant in his theory called आपका net income theory. So what he says is कि companies in their capital structure, they should have max to max portion of debt, and like if you'll have that particular things, so you'll get benefit of taxation and it will help a company to increase their valuation also. The another one is net operating income theory, which is also known as irrelevant theory, and which is again given by David Durant. Okay? In this particular theory, what he suggested? He suggested that the decision of equity versus debt is irrelevant. There is no impact of how you keep these particular things, that does not affect your company's valuation and all. Okay? The third one is traditional theory, which is aligned with your आपका net income theory. Traditional theory which generally support to net income theory, and they generally suggest कि like the portion of debt should be at higher side आपका compared to equity, but till some extent. ठीक है? There should be some limitations on debt also. ठीक है? Because if you go beyond these limitations, it will start having negative impact on your business. ठीक है? So you will start facing the business risk and all. So three theories. The core idea, आपका the debt portion should be maximum to avail the tax benefit, or it will help to improve your to increase your company valuation. Second theory, the debt and equity proportion that does not affect the business. These relations are irrelevant. Third theory, which generally support net income theory, debt portion should be higher, but till some extent. Okay? You cannot breach those particular line. If you go beyond those particular one, there will be a inverse impact of this debt. Okay? The benefit you are getting from those particular one. Okay? So one by one. So out of these three, maximum time, 90% time you will get question based on this particular one. This is one of the most famous theory of your capital structure. Okay? So net income theory, this theory is given by David Durant, who put forward the idea of increasing the proportion of debt in the overall capital structure. Okay? According to him, debt is a fund source because it has a lower interest rate. Okay? Eliminating the risk factor and playing a significant role in deducting expenses as income tax. How come? As I gave you an example now, there is a company आपका who made profit of, let's say, 100 crore rupees. They made a profit of 100 crore rupees. And tax rate in India are basically how much? 25%. Let's say 25%. So now, while let's say you have 100% debt. So suppose that your capital is let's say your capital is आपका suppose that it is 100 crores only. Okay? So suppose that your capital is also 100 crore. That means you have raised 100 crore rupees money. from the debt sources. ठीक है? So let's say we have this entire amount we have raised through debt. So how this debt will help you, how this theory will help you. ठीक है? So your profit is आपका 100 crore rupees, 100 crore rupees minus the interest you have paid on this. ठीक है? So you do not have directly pay taxes on this 100 crore rupees. ठीक है? Let's say your debt was 100 crore rupees at the rate of 10%. That means 10 crore rupees, right? So you have to minus this 10 crore rupees. So now you have to pay taxes on 90 crore. So 90 crore ka 25% you have to pay the taxes. ठीक है? But in case of equity, let's assume it is 100% equity. In that case, what will happen? You have to pay 25% taxes on this particular, because you are not paying any interest in case of equity. They are owners. So if you will have, now we are not suggesting the entire 100% debt portion. What we are suggesting कि your debt, let's say it is 70% and your equity is आपका 30%. ठीक है? We are keeping debt at maximum side. ठीक है? So out of, let's say, now this capital which we have borrowed from the market or the source of funds, it is, let's say we have debt portion आपका 70 crores and equity portion is आपका 30 crores. ठीक है? So now you have to calculate this. So let's say on this 70 इस पे we have paid 10% of taxes. ठीक है? So it will आपका 7 crore rupees. ठीक है? So 7 crore rupees taxes we have paid. ठीक है? So whatever profit you have made, so this, let's say profit is 100 crore rupees during that period. Okay? So you have to minus 7 crore, then you have to pay. If it will be, let's say if it will be 80 crores, so what will be the situation? Okay? This will be 80 crores, you have to minus 8 crore. So 1 crore other relaxation. It will be 50-50, so it will come to आपका 5 crores. So that is the relation. Okay? If it will be at lower side, you have to pay more and more taxes on your profit. If it is at higher side, you have to pay less taxes. Okay? And the another one is the trading on equity. If you are utilizing that particular money very well, if your return on investment is higher than the average borrowing, also it will help to increase the value of equity or the firm value, right? So net income theory, according to this approach, capital structure decisions are relevant. The value of a firm, to the value of firm. How come? Let's say we raise 100 crore rupees through debt, okay, on an average 10%, and our ROI, return on investment, was supposed that आपका 20%. Okay? The project where we invested that 100 crore rupees, that generated us 20% ROI. Okay? So that means after paying this 10%, still you will have 10% in your hand. So this is your profit. So it will increase the company's valuation also. Okay? So it will help to increase the company valuation. So this is the one. Okay? An increase in financial leverage, debt proportion, will lead to decline in weighted average cost of capital also. Okay? 100% true. Okay? While the value of firm as well as the market price of ordinary share will also increase. How these three will increase? The second portion, this we have discussed. Okay? So how the company share will increase? Suppose that earlier the company's current market price was 100 rupees, per share price was 100 rupees. Now they made a profit of 5%, so this will also increase. If company is making profit, so obviously if their balance sheet at a positive side or profit and loss at positive side, so this share price will also increase. The another one is weighted average cost of capital. Like, let's say how we calculate weighted average cost of capital. I told you earlier also. So weighted average cost of capital is equal to cost of equity into portion of equity. ठीक है? Portion of equity. ठीक है? So plus cost of debt into portion of debt. ठीक है? Portion of debt. Now how it will affect? Let's say there is a company who borrow, whose capital means their source, they borrow 100 crore rupees. ठीक है? Case 1 आपका, they borrow this entire money through debt, 100% through debt. ठीक है? केस 2 आपका, बी इज आपका कंपनी बी 100% थ्रू इक्विटी. ठीक है? इक्विटी. एंड केस 3 आपका, ठीक है, लेट्स से आपका डेट टू इक्विटी रेशियो. ठीक है? डेट टू इक्विटी रेशियो इज आपका 0.50. ठीक है? 0.50. ठीक है? So means 50% from debt, 50% from equity. Now let's say this they raise this 100% through debt at the rate of आपका suppose that 10%, ठीक है. The cost of equity is suppose that at the rate of 15%, ठीक है, and 10%, 15%, ठीक है. Now see for first one, for case one, what will be your cost of debt, ठीक है. So weighted average cost of capital, it is very simple, ठीक है. In case one, for case one, they are weighted for A, weighted average cost of capital, weighted average cost of capital is equal to 10%, ठीक है. For B, weighted average cost of capital is equal to 15%, ठीक है. For case C, आपका the weighted average cost of capital, how you will calculate cost of debt? Cost of debt is आपका how much? It is 10%, ठीक है, into आपका 0.5. So it become आपका 5, ठीक है. And cost of equity आपका sorry, cost of this is 15, ठीक है. Cost of equity is 15%, 0.5, so it will become 7.5, ठीक है. Cost of debt is आपका 10% into debt proportion of debt, it is 0.5, so equally, so 0.5, so it become आपका 5, ठीक है. So 7 plus 5, 12. So for case C, आपका weighted average cost of capital is 12.50%, ठीक है. Now this is the situation. So now we'll enter one situation here. So if this company C, okay, because the first two are straightforward, okay? In company C, if they change their, if company, now there is one another situation given, if they apply net income theory and if they are planning to change their debt to equity ratio, आपका debt, they are planning to increase debt to 70% and equity at 30%, ठीक है. So they are increasing the portion of debt, so it will decrease the portion of equity. So how it will impact companies weighted average cost of capital? So now weighted average cost of capital will come down, ठीक है. It will come down, it will come down too. So now cost of equity is आपका 15 into the proportion is 0.3, ठीक है. And when it comes to cost of debt, it is आपका 10 into 10 into 7, ठीक है, 0.7, ठीक है. So this is the one. So obviously your outcome will be less than that, and the outcome, the new weighted average cost of capital will be 15 into 0.3, so it is 4.5, ठीक है. So it is आपका 4.5. Earlier it was 7.5, ठीक है. And the cost of debt will be, आपका cost of debt will be it is 10 into 0.7, ठीक है. So it is 7, ठीक है. So it is 7. So it is 7. It is 7 and it is 4.7. So the outcome is 7, 11.50, ठीक है. So if they increase the portion of debt, if they are increasing the portion of debt, so their weighted average cost of capital is comes down, ठीक है. So that is the logic which is generally part of this entire theory. I hope you get this particular point clearly. We will be practicing number of question around this. You'll get exact this type of question, ठीक है. They'll give you either this is the cost of capital, cost of debt and others, ठीक है. What is the weighted average cost of capital? First question. Another question will be something like this, ठीक है. The element 2 आपका, now company is planning to increase their debt portion to from this to this. So how it will impact companies weighted average cost of capital? So if they are increasing their portion of debt, that is debt cost of debt is lower, so the weighted average cost of capital will come down. And if they are increasing the portion of equity, cost of equity is higher, so their weighted average cost of capital will also increase. That is the logic behind this one. Understood? So this is something about the net income theory. I hope you get this thing. So like here also in your book, if you open your book, so you'll see this case. So ABC Limited has capital structure comprising 50% debt, 50% equity, okay? So they have raised capital, 50% debt, 50% equity. The cost of debt is, in this case, cost of debt is आपका 10%, okay? And cost of equity is 16%. Weighted average cost of capital, how you will calculate weighted average cost of capital? So it is cost of debt into portion of debt प्लस आपका कॉस्ट ऑफ इक्विटी प्लस प्रोपोर्शन ऑफ आपका इक्विटी. सो 10 into 0.5 and 16 into 0.5, so we reach to 13%. Understood? Now if the capital structure is changed to 60%, okay, so now they are increasing the portion of debt, they are increasing the portion of debt to 60%. Earlier it was 50%, okay. And so the equity will come down to 40%. The weighted average cost of capital will change. How? So it will आपका the new weighted average cost will become 12.40%. They have increased the portion of debt. Obviously, your weighted average cost of capital will come down. So 12.40%. So this is the relation of it. Okay? So this is clear that the proportion of debt increase, weighted average cost of capital will decrease, and the value of firm enhanced. On the other hand, if there is a decrease in the debt or leverage, weighted average cost of capital will decrease, increase, sorry. So that is the logic behind this. I hope you understood this particular one clearly, because this is thing which they are definitely going to ask. Even this is like they have a dedicated subtopic for weighted average cost of capital also. Now the another one, the next theory, again which is given by David Durant. It is also known as irrelevant theory of आपका net income theory. So capital structure. They generally believe that there is no point of deciding this ratio of equity and debt. So net operating income theory, as it is known as irrelevant theory, it was also given by the proposed by the David Durant. A deficit, the company's market value is not affected by changing the capital structure. They assume that there will be no impact if you change the capital structure of your business. The overall cost of equity can remain fixed no matter the proportion of debt also. So according to this approach, capital structure decision of a firm are irrelevant. Any changes in leverage will not lead to any change in total value of the firm, and the market price of shares as well as the cost of capital is independent of the degree of leverage. So they are clearly saying that there is no relation between these two. It is like it remain fixed with the time duration. Now next one, traditional theory. So when it comes to traditional one, they are aligned with आपका net income theory, but they have like what they said कि the portion of debt should be higher, but there should be some limitation on debt. If you'll go beyond this, it will start giving you negative impact, right? So the traditional theory which is given by Ezra Solomon. Ezra Solomon was the person behind this, who generally agreed with David Durant net income theory. The assumption of this approach are quite related to the net income theory. The main principle behind this theory was to increase the proportion of debt to a certain limit in a capital structure. There should be some limits. You cannot go beyond those particular limit. If you go there, that will start having negative impact. This approach favor the result of financial leverage up to some point. Cost of capital come down and the value of firm increase. However, beyond the point, a reverse trend emerges. So if you go beyond those particular lines, you will be having some sort of losses, or that will start financial risk will start impacting your overall business. So now the next point, these three theories, maximum 90% time net income theory will be part of your examination, because that get used in real world. Now the next one, we have taxation and capital structure. So as I earlier told you, the benefit of taxation, if you go with equity, you have to pay taxes on net income. Let's say net income, let's say your income during that particular period is suppose that 100 crore rupees. If your capital structure is 100% financed through equity, so you have to pay taxes on this particular profit. But if you have a portion of debt, this is something which is linked with the theories. So if you have, this is through aapka equity. The another one is if you have debt portion aapka, let's say if it is financed 100% through debt, so the profit minus aapka interest paid, whatever interest we have paid, that you have to minus, then you have to pay the taxes. interest. Okay, that is the one. So that's why if you're having higher debt portion, let's say during this period, our profit is suppose that 50 crores. Take a profit is 50 crore. Okay. So now on debt, let's say we have paid interest of let's say 10 crore. Okay. So interest was 10 crore. So you have to minus this one. But in case of equity, you do not have any sort of after interest payments and all, so that will not be part of this particular one. Okay? So these taxes also helping you to maximize the profit or the company's valuations. Okay? So let's discuss this particular one. Okay? Taxation. Interest on debt funds is allowed. Deductions is now as it is a business expenditure. Therefore, it may increase the rate of return on owner's equity. The cost of raising debt funds is treated as revenue expenditure. So basically, expenditure for that particular period, operating expenditure. Revenue is like short term within a year. It can be claimed as deduction in computing the total income. So what we do, profit minus आपका interest, then we pay the taxes. Okay? So here I took from your book itself. When determining the firm capital structure, taxation must be taken into consideration. As we have discussed earlier, earning before interest and taxes of a firm will not be affected by the capital structure of the firm. If a firm has a bit of 100 lakhs with 100% debt and 0% equity, it will have the a bit of 1 lakh. The capital structure is 0 debt and 100% equity. So what will be the in this particular profit in this thing? Okay, there should be in this is the situation actually. That was this point. Okay. So this is the case which you have to understand. ABC having total capital 2 lakh means they have raised funds after 2 lakh rupees. And if it is 1 lakh rupees, they are आपका earning before interest and taxes is 2 lakh rupees. Sorry, 1 lakh rupees. During this period of financial year, they have made a profit of 2 lakh rupees. Income tax on the firm is 25%. Again, rate of interest on debt is आपका 12%. So now we have three scenarios. First one, we have discussed the similar type of question. I hope you remember. Again, scenario one, 100% debt and equity capital is 0. Again, another one is 50% debt, 50% equity, and third one is आपका debt is 0, 100% equity. So in case one, if you come to this particular one, scenario one, where we have 100% debt, means this 2 lakh rupees we have raised through आपका borrowings or in the form of loan and all. So 2 lakh का 12%, which is आपका 24,000. So you will minus from this 1 lakh. 1 lakh minus 24,000, 76,000, and you have to pay 25% taxes on 75%. But in case of scenario C, you have to pay taxes at the rate of 25% on 2 lakh rupees directly. So you will pay more taxes in that case. Third case, आपका medium. So here you can see capital is 1 lakh rupees. EBIT, sorry, the profit earning before interest and taxes. Debt was 2 lakh rupees. Interest is आपका 24,000. So it is 12% of your आपका 2 lakh rupees. Now, so before tax income is आपका profit before tax, it is 76,000 minus. Now you have to apply the taxes to 25%. So it is 19 this. So this is the profit. After tax, profit after tax. When it comes to आपका scenario B, first consider the scenario C. Here 1 lakh rupees is their EBIT and 2 lakh rupees is capital. 1 lakh, here you have to pay more taxes. In this case, you have to pay 19,000 taxes. Here you have to pay 25,000 because this we will adjust in case one as a operating expense. So this is the number. Third one आपका 100 like EBIT is 1 lakh and the equity and debt ratio is 50-50. That means out of this 2 lakh rupees, 1 lakh rupees we have raised through equity, 1 lakh rupees through debt. So now on debt we will not on equity we will not have that benefit of taxation, but on debt we will be having that benefit of taxation. So 1 lakh rupees आपका is your debt. So 1 lakh rupees is equity. So 12% only. So आपका 1 lakh का 12% is 12,000. So after 88,000, 22,000 is the taxes. This is the one. So this is something how taxation, they help businesses to increase the market value of their shares or to adjust that particular profit. So you are raising funds from others, you are increasing your market value, you're deploying that particular funds in the market, you are making profit, and whatever profit you are getting, okay, or whatever interest you have paid, you are minusing that particular one. So eventually it is benefiting the business itself. So this is the benefit of taxation, that is called financial leverage, and that's why every time you'll see that portion of debt is always higher than portion of equity, right? Cost of capital. Okay? So when it comes to cost of capital, it is combination of two elements. One is cost of debt. It can be in the form of term loan or bonds or debentures. Okay? And the other portion is cost of equity. So cost of equity is generally which can be in the form of common equity as well as preferred equity, right? Now the combination of these two is generally known as weighted average cost of capital. That concept is very important. Every time you'll see 1 marks for one question for 1 marks, sometime it is for 2 marks also, which will like first they'll ask you to calculate weighted average cost of capital, and then they'll ask you to they'll give some statement that company is changing their capital structure and what will be the impact of that change on the overall weighted average cost of capital, right? So when it comes to your cost of like when it comes to cost of capital, okay, so it is a long term sources of funds shown in the balance sheet and as liabilities. It consists of both debt and आपका equity. So when it comes to debt capital, it is something, it is also known as outside liability in our balance sheet, okay? And when it comes to equity capital, this is generally part of our basically the owner's money or shareholders money, where you do not have to pay any sort of interest and all, okay? This is something which is that can be recovered, or there can be a forced recovery in case of any insolvency or at the time of liquidation. The common perception is that cost of equity is higher, that is like the cost of equity is higher than the cost of debt, okay, that we have discussed also, okay, and does not involve any cost, as under no legal obligation to pay the equity holders. This also, like, they become owners of that particular company, so that's why this particular line is here, right? So now, like, when it comes to the overall one, as I told you, this is something which is very important here. Weighted average cost of capital, okay? So we have weighted average cost of capital, which include आपका weighted average cost of equity and weighted average cost of debt. ठीक है? Why it is mentioned weighted average? ठीक है? So it include different form of equity. It can be common equity, or it can be preferred equity, or any other convertible things. ठीक है? When it comes to cost of debt, it can be in the form of loan, where we have, let's say, the on an average interest rate is 10%. It can be in the form of bonds, where we are paying the coupon rate at 8%. So that's why the weighted average of those particular one. Okay? This is also known as outside liability, and this is आपका contributed through the owners itself, right? So now in previous session we discussed this particular one. Okay? So we have estimated the cost of each component of capital of a firm. Okay? Weighted average cost of capital multiplying this. So what was the formula? Hope you guys remember. Okay? So it is weighted average cost of capital is equal to your that is portion of debt, ठीक है, portion of debt into your cost of debt, ठीक है, cost of debt, so it is weighted average, ठीक है. The another one is plus portion of equity, ठीक है, portion of equity into cost of equity, right? So this is the one, ठीक है. So now this equity can have common equity and preferred. Debt can have different sources also, ठीक है. That generally you'll get a proper explanation in this one, ठीक है. So the capital structure of a firm is under equity capital is आपका 40%, preferred capital is 10%, ठीक है, debt capital is 50%, ठीक है. So these are the three components of their capital structure. So they have raised 40% through the equity, 10% through the preference shares and 50% through the debt. ठीक है? So the cost of equity, preference and debt is something this. ठीक है? So cost of equity is, let's say it is 20%. Preferred आपका capital cost is 15% and debt capital is आपका how much? It is 20%. So what is the overall amount of this particular company? ठीक है? That is not mentioned here. Okay. Okay, अच्छा, okay. So let's say then this particular case आपका, ठीक है, let's assume it is 100 rupees, ठीक है. So in this particular case, same things will get applied, ठीक है. So cost of equity 40% means 0.4, ठीक है, and the cost of the portion of equity is 40% and the cost of equity is 20%, ठीक है. So that's why it is 20 into 0.40, ठीक है, plus आपका cost of debt preference is 15, ठीक है, and portion of preference is 0.1, ठीक है, and cost of debt is 10% and portion of debt is this. So the overall cost of capital, weighted average cost of capital of this particular firm is 14.50%. So yesterday also we explained this particular concept. So today, with the help of number of numericals, we will be revising all these particular ones. Okay? So if it is given in 2 elements or 3 elements or 4 elements, that won't change the concept, right? It will remain same. The only, like, it can be proportion of debt, it can be term loan and bond also, okay? Or it can be आपका only equity or preferred equity and आपका common equity, right? So that is the case, okay? The only thing is you just have to remember this particular one, okay? Because this will help you to calculate the weighted average cost of capital. And if we'll make any changes, so accordingly your weighted average cost of capital will increase, okay, or decrease. This is something very, very important one. Okay. Again, this get asked so many times for half marks or 1 marks. Again, believe me, very important. Okay. So what are the factors which are generally affecting the weighted average cost of capital? So internal and external. Okay. So two ways. So internal factors, आपका capital structure policy of the company. Okay. The portion of equity and debt. Capital investment policy, where they are going to invest those particular one, okay, and dividend policy, are they going to deliver or distribute dividend or not? So that is the one, okay. When it comes to external आपका, okay, so means internal means these are generally, these decisions are purely made by the company's management. When it comes to external, so these are prevailing interest rate आपका. If let's say if debt rate is very low and equity rate is very high, obviously companies will raise more money through the debt, okay? So that is the one, or vice versa. Risk perception and market risk, a premium also, okay? So overall आपका business risk and the others. Rate of corporate and personal taxes also, okay? So let's say if corporate taxes right now it is 25%, suppose that in future they become 5%, okay? Let's assume this one, okay? Or 10%. So what companies will do? Now they'll not have that financial leverage, or they do have financial leverage, but they'll have very less benefit from the taxes. So they'll shift their they'll increase the portion of equity, because in equity that tax decision does not care, right? That they does not matter, right? So in case if the corporate taxes went up to 40%, so companies they'll start borrowing money in term of debt, so they can use that whatever interest they are paying to the customers, so that they can आपका adjust to that particular. So interest rate first, and the tax rate is आपका, like how you are calculating those particular one, okay? So they are also related to this. Please do remember this one, okay? Sometimes they ask which of the following is not an internal factor which affect the portion your capital structure, again. So that weighted average cost of capital. So 3 option will be this and 4th one will be this, or is आपका, then 1 option will be this and 3 option will be this. And believe me, those options will be only after these 6 point आपका, okay? So they won't go beyond this particular book. So please do remember this, correct? चलो. Now the next one, okay? So weighted average marginal cost of capital. Marginal is something which is when we add one additional debt in the company, how it is going to affect the overall cost. Okay? Whenever it comes to आपका marginal, like in future also we'll be studying marginal costing or law of marginal utility in economics. So the law of marginal utility is something if we, let's say if we are eating आपका bread, if we eat one additional bread, let's say usually we consume four bread, if we additionally consume one more, so how much utilization or how much utility it will give to us, ठीक है? Or in case of costing, if let's say if we are producing markers, if we produce one additional marker, whatever number we are producing right now, so how it will increase the overall cost. Similarly here also, if we add one additional debt in the existing portfolio, so how it is going to affect our overall weighted average cost of capital. The formula is simple, flotation, it is called flotation, we'll come to that one. So investors expectations आपका, as a firm raise more capital, so the investors trust will come down because the company is raising money from the outsiders. That means the company is in problem. That can be one kind of psychology from the investor. So investors comfort level will decrease, require rate of return increase with additional capital raise. So add the additional cost. So if you are adding additional capital, so the obviously your required rate of return will also increase by this one. So by this percentage. Breaking point आपका cost of capital does not arise continuously, but increase after adding after certain level only. Like let's say cost the debt cost maybe 10% up to 100 lakhs, but raise to 11% beyond that particular one. Each of the capital debt divided by equity has its own debt or equity has its own breaking point as well. So beyond that particular one, this percentage will start increasing. Application of weighted average cost of capital. Weighted average cost of capital can be calculated by different capital requirement considering break-even point. For firm, multiple division projects, overall weighted average capital may not apply directly. So let's say for project A, it can be differ. For project B, it can be differ. So instead, weighted average cost of capital benchmark to evaluate divisional or project level cost of capital is generally divisional cost of capital. So it can be like you can have for different debt or different project, different weighted average cost of capital, or after compiling all these, it will come to the overall. So marginal is something if you are adding one additional debt, so how it is going to impact or how it is going to increase your overall आपका cost of capital. So this is like how we generally calculate this one, revised weighted average cost of capital, which is आपका weighted average cost of capital divided by 1 minus flotation rate, or flotation cost, that will be given in your question itself. You just have to remember this particular one. Let's say the weighted average cost of capital of a company is 15%, and it is flotation rate is supposed at 7%. So it is something like this. If you solve this, so it will come to the revised weighted coverage. So cost incurred when raising capital, issue expenses in public. So if it add to the cost of capital beyond interest and dividends. So like this is the question. Weighted average cost of capital is equal to 14% and flotation cost is आपका 5%. So 14 divided by 1 minus 0.5, 5%. So it is equal to, so the revised weighted average cost of capital will be 14.75%. So that means that additional debt which you have taken, that will impact in this like by this percentage or by this much of percentage, right? So this is the one. So this is all about your concept part. Capital investment decisions, which include basic introduction, discounted cash flow methods, and non-discounted cash flow method. Then we have term loan, we have deferred payment guarantee, differences between term loan appraisals and project appraisals. Project appraisals, then we have infrastructure project, disbursement of term loan, and syndication of loan. So these are some subtopics. Again, you can expect 3 to 4 marks question based on this particular one. And this is something which is again very important one, because this is also going to help you in your CAIB ABFM paper, right, in module B itself. So in this session, we will be building our concept. And in next session, we will be practicing a set of questions. And during the live class, again, we will be practicing another set of question around this particular one. Okay, dosto? So in our previous session, where we generally discuss the capital structure, So which is a combination of equity and debt, and optimal capital structure, which generally depend on the business risk and the financial risk available in the market. So accordingly, companies, they made decision. We usually have different theories like net income theory or operating theory or traditional theory. Hope you guys remember those particular one to decide the capital structure of the business. Why every organization they keep debt at higher side? For that sake, we have taxation benefit or the debt. Through that, we generally take some sort of financial leverages and all. That is the point. Okay? So now when it comes to capital investment decisions, okay, when it comes to this particular one, so with capital structure, let's say we have raised आपका 100 crore rupees. Now we will invest that particular money in the business. So whenever it comes to the investment, so it happen into the property, plants, equipments, goodwill, patent, copyrights, and others. Okay. So these are the areas where we are generally going to invest that particular money to fuel the growth of the business. Okay. So it is as simple as that. Like let's say if you are making some investment, okay, so let's say if you are purchasing properties or shares and others, okay, similarly in businesses, they generally with that capital budget, they generally invest that money in the different projects, and they always plan that their ROI should be higher than their average borrowings and all. Okay? So a decision by business to make a capital investment is a long-term growth strategy. Because whenever it comes to the capital expenditure, that is always happen with the आपका long term growth strategy. Basically we are creating assets for the business by investing in those particular areas. ठीक है? Company plan and implement capital investment in order to ensure future growth. Okay, this is the ultimate target which we are having with that capital investment. Okay, why businesses are investing money in different projects and all? Because they want to achieve the higher growths, or they want to achieve higher they want to expand their business and all. So that generally comes under this one. Okay, so capital investment generally are made to increase the operational capacity by establishing one new plant or new office and others. Capture a larger share of market. Let's say earlier you were businesses located in India itself. Now you're expanding beyond India also, or outside India, and generate more and more revenue. So these are some areas. For that sake, we are doing the capital investment. Okay? Now, let's say if you have that much of money in your hand, so that means you'll have multiple alternates. So finding the best alternate is primary goal of this particular decisioning, right? So the term often refer to the company's acquisition of permanent fixed asset such as property, plants, equipments and all. Okay. Capital assets are reported as non-current assets in the balance sheet. Okay? Because we are having some sort of long-term benefits are associated with these particular ones. Okay? So capital investment, that means we are making investment in buildings, machinery, softwares, furnitures, plants and others. They generally comes under this one. Okay? So what are the investment decisions? Now, this is not part of your curriculum, but to make or like to sync with this particular topic or to become more comfortable with this particular topic, I have included these ones. Basically, these are from my CFP, CFE classes. So how will an investment fit into a long-term strategy of the business? Let's say if you are starting a new venture, or you're starting a new product, or you are doing expansion, so how it is aligned with the overall strategic goal of the organization? Whether a projected increased sales for which capacity is being increased. So if you are expanding our business, obviously we have some expectations that our sale will increase by this number, because your break-even numbers will also increase simultaneously. Okay? Whether projected increase in fixed assets will increase the break-even points of business, requiring the firm to generate more sale before it earn the profit itself. Okay? So this is something. Apart from this, whether the investment is required by the regulatory requirements or compliances sometime also. So sometime RBI come up with some guidelines where you have to increase the investment in some area. So that is something. Or whether the firm has sufficient funding available to pay for the assets that it wish to acquire. Okay? So that means your capital budget allow those particular investments or not. there is a relevancy with the projects or not. So these kind of things which you have to think about before making any decision. Okay. So now we will come to our core topic, that is capital investment decision. Capital investment is something where you are building the capacity of your business, okay, by investing in long-term assets, so you can generate more and more revenues and you can expand in the market, right? That is a very simple one. Now, whenever we go for capital investment, that means you are investing huge money in your business. So, and with that huge money, you have ample of opportunities. Okay? But you have to check the relevancy and you have to check the return. You have to check the liquidity or the other aspect also. Okay? So, what will happen if you'll have 100 crore rupees in your hand? Okay? So, let's say you have these alternatives. Okay? Then with this particular one, this is kind of a screening. Okay? We are finding how many options are available in the market. Okay? Then we have, let's say these two, after screening, okay, we have these two preferences areas where we can invest our money. Okay? Then here you will apply the NPV and others. Okay? So then you will come to the first one. Ki, haan, we are going with this alternate and we are going to invest that money in this particular area or in this particular product or in this particular market, or else it can be any other venture also. Okay? To make these particular decision, we have different methods. They are further categorized between discounted or आपका non-discounted. Okay? Discounted is basically whenever it comes to discounted cash flow methods. So that means we are adjusting the inflation in opportunity cost. Okay? When it comes to non-discounted, it is as simple as that. If I'm investing 1 lakh rupees today, by the end of 1 year, let's say I'm getting 100 and आपका more than 1 lakh. That is a profitable business for me as per non-discounted. Okay? But when it comes to discounted, they are very relevant and very important. Okay? So we have to adjust the inflation prices or the other circumstances around that particular one. So for that one, you have to apply the, you have to calculate the present value of future inflows, right? So capital investment appraisals team. So capital budgeting is the process by which investors determine value of potential project investment project. Okay? We have three major ones, okay? Like payback period, which is non-discounted. Okay? Then we have IRR, discounted, and the most important one is आपका NPV. Apart from this, we have one another non-discounted, that is ARR also. So we are going to discuss all these four one by one. But believe me guys, 90% time you will get question based on NPV. And you have to make your understanding around NPV very clear, because that is going to be asked in your CIB also. Okay? And whenever there is a question around NPV, it is always for 2 marks. Okay? So you have to make sure that you are okay with that one. Okay? So now NPV, net present value. So as I said, it is a discounted method. Okay? So it is a discounted method. So where we are generally like, this is as simple as that. Let's say we are investing in a project where our outflow is आपका 10 crore rupees. Okay? Let's say if you are investing on a project today worth rupees 10 crore rupees. Okay? So let's say this project is for 5 years, and first year you are getting suppose that 3 crore rupees. Okay? Second year, let's say again you are getting 3 crore rupees. Okay? Third year, let's say you are getting 2 crore rupees. Fourth year, आपका at the end of fourth year, your return is suppose that again 2 crore rupees. And a fifth year, let's say your return is आपका 1.50 crores. ठीक है? If you'll go with the non-discounted, ठीक है? So non-discounted is saying कि like if we are investing 10 crore rupees, if the outflow this is an outflow, okay? This is an inflow, okay? This is inflow, and but this is the future value, okay? This money you are going to receive at the end of first year. This is you are going to receive at the end of second year, at the end of third year, at the end of fourth year, at the end of fifth year, okay? So now the total of this is आपका how much? 11.50 crore. If you are following the non-discounted method, you should go with this particular project, because we can see the profitability आपका in the fifth year. If you'll follow that payback period, okay? Payback period is as simple as that कि how long it will take to get back my money, whatever I'm investing in this particular project. And for this project, your payback period will be fourth year, because by the end of fourth year, you will recover this 10 crore rupees. Okay? Again, that is a non-discounted. But NPV and IRR are generally based on discounted methods, and they majorly we use आपका NPV for the calculation. So the total of this is 11.50 crores. As a layman, we should go for this particular project because we are investing 10 crore rupees and we are getting आपका 1.50 crore rupees profit from this one. But this is not the game. Okay? So as per the NPV methods, what we have to do, we have to discount these future cash flows. Okay? These are the future cash flow. This 3 crore rupees I'm getting at the end of third year. This 1.5 crore I'm getting at the end of fifth year. But this outflow is today. I'm making an outflow of 100 crore rupees, 10 crore rupees today. Okay? So if your outflow is today, your future inflows should be at the आपका present value. So what you have to do, you have to calculate the present value of future inflows. Okay? You have to calculate the present value of these future inflows. Okay? And if the total is greater than this, then accept this particular project, otherwise reject. Okay? That is the logic which we generally use while we invest. Please listen carefully. Okay? Let's say now how you will calculate the present value of future inflows. So we have a formula, okay, that is inflow, okay, inflow, please do remember this, divide by 1 plus r, okay, inflow 1 plus r की power आपका n, ठीक है, और the time duration in all, ठीक है, so that is the one, ठीक है. Then the second year आपका, ठीक है, second year again inflow 1 plus r की power 2 आपका, ठीक है, second year. Then आपका third year, fourth year, fifth year minus initial investment, ठीक है, initial investment, ठीक है, so that which is your 10 crore rupees. If the number is आपका, if your NPV is your greater than 0, except if your NPV is equal to 0, go for IRR, ठीक है, and if your NPV is less than 0, reject the project. Okay? This is the answer for this one. Okay? Now, so basically how you will calculate this particular one, inflow 1 plus R. So there will be given one discount rate. Okay? So at by what we are discounting this today's 1 rupee value with आपका later 1 year, आपका after 1 year's 1 rupee. Okay? So this is simple. This is based on time value of money. Okay? So what time value of money says? Today's 1 rupee having a higher value than आपका, let's say this is 2025, this is आपका 2026. Okay? So today's 1 rupee is having higher value than rupees 1 of आपका 1 year later or 2 year later or 3 year later, just because of आपका inflation, just because of opportunity cost or the other factor. Okay? Inflation will increase, the value of rupee will decrease, or else we can invest this particular one in some other project, so we can earn something from that particular one. So that for that sake you will get one discount rate. Okay? Let's say in this case, suppose that the discount rate is आपका, that discount rate is suppose that आपका 10%. ठीक है, let's say the discount rate is 10%. ठीक है, so how you will calculate this one? So first year आपका it is like 3 crores. ठीक है, divide by 1 plus r, discount rate is 10%, 1 point this की power 1. ठीक है, second year आपका again 3 crores. ठीक है, divide by 1 plus 0.10 की power 2. थर्ड ईयर आपका, ठीक है, 2 crores, 1 plus 0.10 की पावर 3. फोर्थ ईयर आपका 1 plus 0.10 की पावर 4. ठीक है, डिवाइड बाय 2 crores, सॉरी. ठीक है, देन फिफ्थ ईयर आपका 1.50 crores डिवाइड बाय 1 plus r 0.10 की पावर 5. ठीक है, आफ्टर द calculations. ठीक है, so let's say I'll take some random numbers. ठीक है, so let's say this reaches to आपका 2.70 crores. ठीक है, let's say this is आपका 2.50 crores. Let's say this is आपका 1.50 crores. ठीक है, this is आपका suppose that 1.30 crores and this is suppose that 1 crores. ठीक है, now if the total of this, ठीक है, the total of this, if minus the total of this minus आपका initial investment which is 10 crore, if the number is in positive, if it is in positive greater than 0, so you should accept this particular project. If it is आपका equal to 0, then you have to apply the IRR method, and if it is less than 0, you have to reject this particular project. ठीक है, sorry. So please try to make your understanding. So this is something आपका when it comes to the your NPV. So NPV, which is a discounted cash flow method, where we are discounting. Why we are discounting? Because today this is based on the time value of money. As we all know, today's 1 rupee having higher value than a year later's 1 rupee. Okay, this is the prime logic behind this particular one, and which is like true also. Okay, so you are not going to make decision based on this inflow. You are going to make decision based on the present value of future inflows. Okay, so that like this is the amount which you are going to receive at the end of आपका फर्स्ट ईयर, बट द प्रेजेंट वैल्यू ऑफ दिस अमाउंट इज आपका 2.70 करोड़, ठीक है, विच इज आपका like because we are doing this expenditure or this outflow is dated today itself, so that's why you are evaluating things on today's date itself. That is the one. Okay, chalo, now let's start with this one and try to build your understanding. So NPV is a difference between the present value of cash flows, take a present value of cash inflows, and the present value of cash outflow. Take a see, present value of cash outflow after 10 crore rupees, present value of future cash inflows. The year at the end you are getting 1 crores or 2 crore, whatever it was. So that is the one. So the net present value method is a tool for analyzing the profitability of a particular project. It take into consideration the time value of money. The cash flow in future will be a lesser value than the cash flow today. So that is called time value of money. And how we adjust this particular one? With the discount rate. That discount rate will be given. So you just have to remember that formula. That is आपका NPV is equal to cash flow 1 plus R, आपका cash flow 2, 3 and 4, 5 whatever it is, ठीक है, minus initial investment. ठीक है, and if your NPV is equal to आपका, let's say if it is आपका if it is greater than 0, except if it is less than 0 आपका reject. ठीक है, if it is in positive means your inflows are higher than the outflows, the initial outflow, so you should accept this one. But if it is lower, there is no point to invest in that particular project itself. Understood? Chalo, with the help of questions, because this is something first you have to clear yourself around the concepts or fundamental. If you're able to make your only, you have to put your efforts on NPV. Others are similar to that, and you will be able to handle the other question easily. Okay? So please go through this particular one, guys. Okay, so ABC company considering an investment in project worth rupees 1 lakh. Okay. So there is a business, there is a company ABC Limited. They are planning to invest 1 lakh rupees. The project is expected to generate cash inflow of 30,000 per year for next 5 years. Okay. The discount rate of this particular project is again 10%. So NPV, you have to calculate the NPV of this particular. So how you will calculate this particular one? I hope now you will be able to solve this. So how you will calculate this one? So your outflow is how much? Your outflow is आपका 1 lakh, ठीक है, and you are getting 30,000 per year आपका, ठीक है, inflow for 5 years. So that means आपका 30,000 डिवाइड बाय 1 प्लस R 0.10 की पावर 1, ठीक है, सिमिलरली आपका प्लस 30,000, ठीक है, 1 प्लस R 0.10 की पावर 2, एवरी ईयर यू आर गेटिंग आपका 30,000 प्लस आपका थर्ड ईयर, फोर्थ ईयर, 5 years, ठीक है, minus initial investment, that is 1 lakh. Okay? If you solve this particular equation, if it is in positive, okay, so you should accept, otherwise you should reject. Okay? So it is clearly mentioned, yeah, if it is in negative, so it is no. Okay? Or if it is positive, yes. So this is the only thing which you have to calculate. It's a very simple one. Calculator is allowed and you can do these kind of solve. Okay? So this is, if you calculate this one, you will reach to these particular numbers. 27,243. Okay, see, the future value of that 30,000, okay, which you are getting at the end of first year, and the present value of that cash, future cash inflow is how much? 27,273 rupees, because we have discounted that particular one with 10%. Okay. Second year it is coming below that 24,000, then आपका 22,000, आपका 27,000. No, it should be wrong. This is wrong आपका, ठीक है. This is wrong, ठीक है. For sure it should be less than that आपका, ठीक है. And this is आपका 18,000, ठीक है. So this should be this is wrong, huh? Not 27. It cannot be 27 because as the time will pass on, this will come down, ठीक है. So the exact number is आपका 22,000. It is आपका 27, 24, then आपका 22, it is 20, ठीक है. This is आपका how much? 20, हाँ, it is, it should be, see, I told you ना, this is wrong आपका, and it will be how much? It is आपका 20,490, and then it is आपका 18,627. So the total minus initial investment 1 lakh. So the total is आपका this. So it comes to 13,722. That means your NPV in positive. That means you should accept this particular project. Okay? So since NPV is positive, like let's say if after minusing this initial investment, if it is in negative, you have to reject. If it is equal to your investment, let's say the total of this is equal to 1 lakh, then you should apply IRR in that particular case. Okay? If you're still interested in that particular project at bottom line. First question. Now, first variety of question. Maximum time, you will see this type of question, but they'll not give you till 3 year, 4 year. This will be part of in your CIB. Hardly they'll give you 2 years or 3 years. Okay? So first of all, and that calculation will be very easy for all of you, right? Now, the another one of the next type of question, which is very easy. Okay? Because here you can see the discounted factor is after 10% and they have already discounted rupee 1. Okay? So at the end of, like today's 1 rupee is equal to आपका 0.909 at the end of first year. At the end of second year it become this, आपका third year, fourth year and fifth year. So they have already discounted your आपका 1 rupee in this case. You just have to do the multiplications. How come? Company XYZ considering investing in a new project require an initial investment of 1 lakh. The project is expected to generate 30,000 per year. Similar to that, discount rate is also same. But the values here, they have given already. Okay? So what will be your correct answer? So first, now, what you have to do basically, this into 30,000, this into 30,000, this into 30,000, this into 30,000, and this into 30,000. So if you'll do this, whatever outcome it is, you just have to minus from the आपका initial investment. If it is in positive, you have to accept, otherwise you have to reject. So आपका, this is the initial investment 1 lakh rupees. These are the future values of inflows. And we have to calculate the present value of these future inflows. So for that sake, we have to apply this. How we reach to this one? This will be given in question. You do not have to calculate this, but the area is same. It is आपका inflow divided by 1 plus R की power n आपका, ठीक है, or whatever it is आपका time duration. So that is the one, ठीक है. So this is the case. So if it is आपका, so the total of NPV is आपका 13,700, ठीक है. It is in positive, then that means we should accept this particular project. Okay? One more question, guys. XYZ want to expand business, willing to invest, okay, willing to invest 10 lakh rupees. Okay? Now we have 10 lakh rupees investment. Okay? The investment is said to be an inflow of 1 lakh first year, 2 lakh 50,000 second year, 3 lakh 50,000 third year, 2 lakh 65,000 in fourth year, and fifth year आपका 4 lakh 15,000. Now sometime you'll get this type of different. Every year we have different incomes. Okay? The discount rate is 9%. So you have to calculate NPV and they'll ask you, we should accept this project or not. Okay? If it is in positive, your answer is yes. And if it is in negative, your answer is no. Simply. Okay? So how you will calculate this one? Similar to this. Okay? Inflow first year, आपका 1 lakh. Discount rate is 9%. That means 1 plus 0.09 की power 1. Second year आपका inflow. Second year inflow is how much? 2 lakh 50,000. 1 plus 0.09 की पावर 2, देन थर्ड ईयर आपका 3,50,000, ठीक है, 1 plus 0.09 की पावर 3, देन वी हैव आपका फोर्थ ईयर, फिफ्थ ईयर, थर्ड, देन वी हैव फोर्थ ईयर दिस, एंड फिफ्थ, सॉरी, फोर्थ ईयर इज आपका 2,65,000, fourth year is this, minus initial investment, that is 10 lakh. If it is in positive, accept, otherwise reject. ठीक है, so cash flow आपका this, ठीक है, so the overall value is coming in positive, so we should accept this particular, the positive value is this. ठीक है, if you please do these type of calculation, at least try once. ठीक है, so if you put some efforts na, your learning will be double triple. ठीक है, so during the live sessions also we will be solving a number of questions around this, and even I'll come up with one dedicated session around the practice of this particular one, where we will be discussing this. In your book itself there is a question, okay? So very simple question. I hope now everybody will be able to solve this particular one. Okay? So there is a आपका firm which is a toy making company. ठीक है? So there is a business which manufacture toys. Production of toys require new factory space and equipments. ठीक है? They have two options. One is either the firm construct a new factory on site, it has identified, or आपका refit a factory. ठीक है? Now they have two options. One is they should build a new construction site or to develop a new factory, or they already have one space or to renovate that particular one. Okay? So now when it comes to the initial cost, in case of refitting or that repairments, it will be, initial cost will be low, but your operating cost will be high, because that is the equipments which we are having there are old. But when you'll construct a new site, initial cost will be high, and the later on the manufacturing cost or the operating cost will be low, because these all are new products or new machineries. Same thing is mentioned here. The initial investment in constructing a factory is more, however the running cost will be low. Initial investment in renovating old factory will low, but running cost will be high. Okay? The firm is faced with choices mutually. So now it is a mutually exclusive investment opportunities. Ki what should be their decision? They should go for the renovation, or they should build a new factory. Okay? A is आपका new factory and B is आपका renovations. Okay? So now what should be their decision? In this case, or in this type of choices, it's a mutually exclusive investment opportunity. You do not coming with marker or this remote. You are coming with marker only, but to manufacture this marker you have two choices. Okay? If it is, let's say, marker and remote, if both are positive, if your capital allow, you should go with both. Okay? And or if you have to make one choice, let's say ROI of this marker is आपका 15 and this आपका 10. Obviously you go NPV of 15, higher NPV, you have to go with this one. Okay? But when we have this mutually same things, आपका we have to manufacture marker by A or way B. Okay? So A is where we are manufacturing that marker, that machine or the plant, we are setting up a new plant. And B आपका we are basically renovating the old one. Okay? So A is आपका where is a new project construction. So initial investment will be high, let's say 2000 crores, and आपका when it comes to project B, where you are doing some sort of renovation, so the inflow is आपका how much? Only 1500. It will be less, but the operating cost will be high. So now everything is done. Now NPV of project A is आपका 564.02. NPV of project B is आपका 373.33. Now I'm asking one question: which project you will opt? Okay? A or B? So what will be your correct answer? Your answer will be आपका A. Okay? Why I'm going with this one? Because it is where to manufacture this marker we have two ways. We'll go with this where we have high NPV, because this will give us more return. Okay? If it would be the individual project, okay? This is for marker and this is for this remote. So if your investment allowed or if your capital budget allowed, you can go with both the project, because in both the cases you will be having profit. And if you have to make choice, obviously, then again you will go with the higher NPV, right? So it should be in positive, and let's say if you have multiple in positive, you will go with the higher NPV things. Okay? So in on comparing NPV of the project A and B, NPV for both project is in positive. The NPV of project A is more than आपका B, hence the firm should go with the project A आपका, ठीक है? If project A and B were independent project rather than mutually exclusive investment opportunities, then firm should maximize the increase in shareholders' wealth by undertaking both the project if fund permitting. So that is the simple one. Understood, guys? So this is all about your NPV, net present value. Okay? Very, very important concept. You have to make sure that you are okay with this one, because you are going to achieve 2 marks in your upcoming examination and 2 marks in CIB and not 2 marks. There are so many concepts which are linked with this particular methods in your CIB also. Okay? Now IRR. Okay? What I told you about IRR, when your NPV becomes zero. Okay? Let's say we applied NPV on a project and NPV came to zero. Means your initial investment is 10 crore and the future inflow, the present value of future inflows is equal to zero. Aapka 10 crore. That means 10 crore, 10 crores. In that case, if you want to, if you still interested in that business, you should apply IRR. Okay? IRR will help you to go with that project or not. Okay? So IRR is a metric used in financial analysis to estimate the profitability of potential investment. IRR is a discount rate that make the net present value of all cash flows equal to zero in a discounted cash flow analysis. Okay? So present value is equal to future value wala case. Okay? How we calculate IRR? So it is similar. Cash flow. Okay? 1 plus R की power I and minus initial investment. Same. So cash flow in the time period, R is discount rate and T is आपका time period. Now you will not face any challenges. ठीक है? IRR. So let's say a company has an option to replace its machinery. So the cost आपका initial investment 5 lakh. ठीक है? Incremental increase per year is आपका 2 lakhs. ठीक है? Every year, every year you have to contribute 2 lakh rupees to maintain that machinery. Replacement value is this. Okay? So life of the asset is 3 years. So if we assume IRR is 3%, so how you will calculate? Cash flow 5 lakhs and then after discounted cash flow, which is for the first year it is after 2 lakhs. Every year we are adding this particular one. So again that same formula, that is inflow 1 plus R की power I is आपका time period in this particular case और R is आपका discount rate. ठीक है? So if the total, see the total of column discounted cash flow approximately sum of 0, making the NPV equal to 0. Hence the discount rate is the best rate of 13%. Again, as we can see in the above, using the rate of 13%, the cash flow both positive and negative become minimum. So it is the best rate of return on investment. The cost of capital of company is 10% since the IRR higher than the cost of capital. That means this project can be selected. Okay? So that means you will be having 3% rate of return after adjusting all these particular things from that one. Okay? And if it cost of capital will increase to 11 or 12%, accordingly your profit margin will decrease. Or if it will go beyond the 13%, so you should reject that particular project. Okay? Payback period, now this is आपका non-discounted. Okay? So now here payback period is very simple. Okay? Let's say if I'm investing 10 lakh rupees in a project today, by the and I'm recovering that 10 lakh rupees in 1.5 years. So 1.5 year is my payback period for that particular project. After that, that will generate for profit for me. Okay? We do not discount the आपका we do not apply the cash time value of money or the inflation things and others. Okay? So payback period, time taken for an investment to recover its initial cost आपका, ठीक है, from आपका net cash inflows. So it is आपका payback period is amount initially invested. Let's say it is आपका 10 lakh. Estimated annual net cash flow. So the whatever it is, if you divide by that particular one, so you will get to know about your cash flow. Let's say आपका initially amount is 10 lakh. Estimated annual cash flow is suppose that 2 lakhs. So 5 year is your आपका payback period in this one, because in 5 years we will recover this 10 lakh rupees. After that, it will start giving profit to us. Okay? Return on investment, net cash flow from the yearly operations. When cumulative cash flow inflow is there, initial investment, the investment is considered recovered. Okay? Both positive and negative cash flow are counted until recovery. So whatever you are having on yearly basis, it represents the cumulative time period for the investment payback period, as in our case it is 5 years. Okay? So there is one example also. Okay? So let's say these are the investments. These are the written investment is आपका how much 20 lakh. Okay? Suppose a project costs 20 lakhs, yield annually आपका profit of 3 lakhs. Okay? After a depreciation of 10%, before tax of 50%. Okay? The first step to calculate the inflow is cash flow. Okay? So first is आपका, let's say profit after tax is how much 3 lakhs, and your taxes is 50%, 1.5 lakhs. Profit after tax is 1.5 lakhs, and depreciation is 2 lakhs. Okay? So 3 lakh 50,000 total. 3 lakh 50,000 is total annual cash flow. Okay? So now initial investment is 20 lakh. So 20 lakh divided by 3 lakh 50,000. So this is the one. So the cash flow is आपका how much 5.71 years. So it will take 5.71 years to recover the initial cash outflows on that particular project. That is the basic uses of this one. Okay? This is based on non-discount. Basically, you are not doing any sort of future inflows. You are not converting the present value of future inflows and all. That happen in case of only in case of your आपका NPV and IRR. Okay? And this is the one which we have used. Okay? Then we have ARR. Okay? Accounting rate of return also. Okay? ARR is a method of evaluating an investment profitability by comparing the average accounting profit. Average accounting profit means every year's average आपका profit. Okay? To the initial investment or average investment. Okay? Unlike other method, ARR focus on accounting data rather than the cash flow, and widely used due to simplicity and accessibility. How we calculate ARR is equal to, you please do remember these one while we will solve the questions. These formulas will require. Okay? So ARR आपका average annual accounting profit divided by initial investment into 100 simply, or else it can be average annual accounting profit divided by average investment आपका. ठीक है? If like let's say if you have investment done on monthly or yearly basis and all. ठीक है? So average investment is equal to initial investment plus salvage value divided by 2. Okay? So like let's say project X आपका initial investment is 2 lakh, life is 4 years, the estimated profit is आपका for 4 years आपका 20,000, 40,000, 50,000, 30,000. So how we will calculate this one? Okay? So average annual profit. So that 40,000, 20,000, whatever it is, divide by आपका initial investment, that is how much 2 lakhs into 100 for project A. Similarly for project Y, this plus this plus this plus this divide by आपका 2 lakhs. ठीक है? Into 100. ठीक है? So if you go with this one, yes, so we have average annual profit and average annual profit for X and Y. ठीक है? Then the step 2 where we have to calculate X. ठीक है? The average annual profit. ठीक है? So average annual profit, sorry. ठीक है? These divide by, this is for how many years? 4 years. These divide by, this is for how many years? 4 years. Okay? So this is your average annual profit for 4 years. This is the average annual profit for 4 years. So this, whatever outcome it is, divide by आपका 2 lakhs, and this average divide by 2 lakhs into 100. So it is 35,000, it is 30,000. So in case of project X, it is आपका 17.5 and project Y is आपका 15%. So we will go with project X आपका. ठीक है? Now this is all about your all these particular 4 methods. ठीक है? So the only things which will be requiring a basic understanding, the uses and all. The another thing is formulas. Okay? Formulas like in case of ARR, basically you will be requiring, and that is very simple. Okay? Just write it down somewhere while you solve the question. Do the open cheating. Initially, if you follow things twice, thrice, and you will be able to remember and recall all these particular formulas as well. Okay? Apart from this, we have term loan also. Okay? So term loan is basically, these are the loan which are generally provided by banks or any other financial institution for the long term. Okay? For the आपका to finance the capital investment of a business, ठीक है. But before financing or before doing any sort of these kind of lending, bank they generally do the project appraisal, ठीक है. Let's say you are running with you are running some business, you are planning to launch a new project, okay? So you will go with that plan, and that plan you have to submit with bank, then they'll evaluate. If they need to visit site, they'll visit site also, okay? And they'll check the profitability on that particular project, cash flows, how you are going to generate cash flows from that particular project. If they found ki they'll also apply NPV and everything, same, what are the future cash inflows, and then they'll do ki this is, let's say, after 1 year only you will be generating profit for next 15 years. So their term loan period will be less than 15 years. It should be within that particular one, because during that period only you are going to earn money from that particular project or the other decision also. So this is a simple loan which is taken by companies to finance their long-term project. Okay. For the working purpose, we have working capital term loans. Okay. That is for the operation or day-to-day requirement. But for this one, this is generally for the long-term period. Okay. Term loan are mainly provide acquiring fixed asset like land, building and others. Okay. Working capital loan are for the current assets or the day-to-day activities of that business. Include the personal loan, and this is generally part of this one. Working capital loans आपका in special cases bank may give term loan for current asset also. It depend on the case to case. But usually the motive is आपका term for long term period, and this working is for the short term period. Business must maintain a certain level of current assets for the long term funds, net working capital आपका, ठीक है. If unable to meet net working capital requirements, liquidity issues arise, and that is आपका as per the Tandon committee, it should be around 25%, ठीक है. So minimum 25% contribution should be from the organization itself. Duration and classification आपका, ठीक है. So working capital loan normally for 1 year, repayable on demand, short term. Term loan are repaid over time, considered for long term asset. Repayment sources आपका, ठीक है. Term loan rapid repaid from future cash inflows for borrowers, ठीक है. So debt service coverage ratio is important. Working capital आपका liquidity ratios, ठीक है. Basically ratios you are using to analyze or to appraise that particular project. Repayment schedule, ठीक है. So basically in term loan we have EMIs, or in case of working capital loan it can be like, let's say if it is in the form of cash credit or others, it is one time, ठीक है. No uniform schedule, ठीक है. Depend on the borrower's income or cash surplus, ठीक है. Salaried person आपका EMIs, farmers या others, that is the case. Deferred payment guarantee, ठीक है. So this is something आपका deferred payment guarantee is something which is majorly it can be issued by the bank up to 25 crores. If it is beyond that, if it is routing through some exim bank and all, take 25 to 100 crores. If it is more than 100 crores, there is a dedicated groups आपका which is led by the RBI, exim or the other parties or bank members also, ठीक है. So when a purchaser of fixed asset pay the supplier in installments, not immediately, the bank guarantee this payment, which is called deferred payment guarantee. Nature, it is non-fund based financing method for purchasing fixed asset. If purchaser default, the bank pay the suppliers and later recover from the clients. We are generally providing some sort of guarantee कि this person will make you payments to the suppliers or sellers. Risk आपका, risk in DPC are similar to term loans. Appraisal for DPC is the same as for the term loan also. Okay? Syndication of loan, this is generally happen with the where the project size is very big. Let's say there is a company, construction company, who is constructing airport, highways and others. Okay? Let's say the project is for 3,000 crores or 5,000 crores. So if only one bank will get involved, and if that particular project got defaulted, there will be a huge loss for the bank, or it may collapse, right? So for that one, we have syndication of loan. Okay? So where we have one lead bank who act as a arranger for the borrowers, and they generally mostly pay the maximum portion in that particular loan, and rest they generally arrange from the other bank or institutions. So syndication means sharing a long-term loan among two or more banks, used mainly for larger loans help bank to share the lending risk. Process, borrower authorized as a lead bank to arrange the total loan. Lead bank approach other banks, share details, and they appraise uh, as per their policies and risk appetite. Again, term and conditions are finalized in a joint meeting of participating bank. Role of lead bank is to act coordinator and liaison. It means information. Who liaison is something who is working as a mediator or chain between आपका borrower and lenders. ठीक है? So charge borrower a syndication fee for the services also. If you are taking that much of headache, obviously you will charge something that is called syndication fee in this particular case, right? So this is the lease, equipment leasing and lease finance, and the with reference to accountancy aspects and accounting aspect and all together. So we have what is lease, features of lease, type of lease, finance lease, operating lease, rationale of lease. Then we have content of a lease agreement, legal aspect of lease, GST and GST on lease transaction, income tax implications, accounting of lease transactions, accounting of lease transaction in आपका lessee, and lease as a financial decision, right? So when it comes to these particular one, there are some important subtopic. One is आपका most of the time, you will get one question for 1 marks based on the differences between finance lease and operating lease. Reason being why this get asked every time, because when it comes to lease agreement, accounting standard 19 and Indian accounting standard 116, which generally about the lease agreements. And as per these particular accounting standards, there are two type of lease agreement. One is finance, another one is आपका operating. Operating lease usually for short term period and finance lease is for the long term period. Okay? Then when it comes to the other areas, like these 3 or 4 subtopics are very important from the for AFM subject. Okay? Like the GST related things, or how like the lease expense is treated in the book of lessee. Lessee is who is going to take that particular machinery or the asset on the rent, and paying some amount for that particular uses, and lesser is आपका owner of the asset. So there are two parties involved in lease agreement. One is lesser, owner of the asset. It is as simple as that. Let's say if you are living on a rent, so the house owner is lesser and we as a rentee there, so we are categorized as lessee, and that like in replacement, after using, like for the uses of that particular building, we are paying monthly basis rent to the आपका owner, which is lesser, right? So that is the case. So this is an alternative source of finance, and there are so many businesses who generally get involved in this entire process and all together. So they generally like they generally give their assets on lease. And even for businesses also, let's say if we talk about the banking business, so it is not feasible for bank to purchase every building wherever we are having our branches or ATMs. So what we usually do, we generally enter into a lease agreement with the owner of those particular premises or building, or the places wherever our offices are located, right? So the owner of that building is lesser, and as a bank, we are lessee in that particular case. In our book, it is operating expense, and in case of the like in case of the owner or the lessor, it is आपका, they generally show the depreciation expense, and it is an asset for their balance sheet. So there are so many different type of lease also. Apart from this particular one, we have some other type of lease. So that is something which is generally part of this one. So that we are going to discuss in this particular case. So we will be talking around those areas also. So first, the basic thing. So lease agreement is basically, as I gave you an example, let's say this is the premises which we have taken on rent for our office or for our bank layout. So this is owned by Mr. X आपका. So X as a owner is generally known as lessor, and we are using as a bank XYZ Bank Limited. Again, let's say if we are using this particular property, so we are lessee in this particular case. So your bank, let's say it is SBI. So SBI is a lessee and X is a आपका lessor. Okay? So it is an agreement between two parties where another party is using the assets of some like they say bank is using the asset of X आपका, and they are in return they are paying some sort of money that is in the form of rent, okay, right? So it can be in some other cases also. Let's say if you need some machinery for 6 to 8 months only, right? So in that particular case, let's if you need that machinery for like there is no use after that particular one, so instead of buying that particular lease, that particular asset, you can take that particular one from someone else on lease for that specified period, because after that you do not have any uses of that one. That is a kind of lease agreement between parties. So lease financing is popular medium to long term financing option in which owner of an asset grant another person the right to use the asset in exchange for a periodic payment. Okay, like this is the example. Okay. Apart from this, the asset owner is known as lessor. So an owner of the asset is generally known as lessor, and the user, which is आपका, like in our example, we are the user, so we will be known as आपका lessee, and the Mr. X was a lessor. Okay. A contract is to be made between the lessor and lessee regarding the term and condition of the lease. After the lease period over, the asset goes back to the lessor. Okay, let's say that contract was for 11 months, that rent agreements. Okay, so then after 11 months, okay, so again that ownership or that premises will belongs to that lessor itself. Let's say we purchase or we lease out that machinery for 6 months. Okay, so lessor is passing you right to you can use that particular machinery for 6 months. After that one, this right will get over, right? So that is the things which is an early part of this. Very simple one. Okay. So now, as per the accounting definitions, okay, so as I told you, okay, accounting standard 19. That's why accounting standard get asked so many times, because you have to remember this one. Anything which is part of the curriculum that get asked so many times. So accounting standard 19, which deal with the lease agreement. Okay. And when it comes to Indian accounting standard, it is 116. So as per Indian accounting standard 116, a lessor shall classify each of its lease as either an operating or a finance lease. That means as per the accounting purposes, we have only two type of lease. Okay? Like if you'll go for the other type, we have so many types. We will be discussing those one. Okay? But for the accounting purpose, we have only two type of lease. One is operating, which is also known as short-term lease, and the another one is finance lease, which is also known as long-term lease. Okay? When it comes to short-term and long-term, operating lease, which is cancelable in nature, you have to remember these statements. Now, they are very, very important one, because one question maximum time you'll see based on the distinction between operating and finance lease. Okay? So operating lease are short term in nature, cancelable in nature, okay? And the maintenance of in case of operating lease belongs to lessor, owner of that particular asset. When it comes to finance lease are long term in nature, okay? And at the end of lease period, the lessee has right to purchase that particular machinery, okay? And the maintenance is taken care by the lessee itself. So these are some basic things. Okay? So it means that from accounting perspective, lease can be only two type. One is operating, another is finance. Okay? So based on other criteria, we have commercial lease can be based on other criteria, commercial lease can be categorized into leverage lease after. Yeah. So where basically it is debt bound. Okay, so we are providing money and then we are selling the assets. We will be discussing these in detail. Domestic, boundary wise, international. Okay. Cancelable आपका, which can be cancelled during the lease period. Okay. Non-cancelable, usually this is operating and this is आपका financing. Okay. Sale and lease back. Okay. This sale and leaseback that's usually happen in case of real estate businesses. Let's say as a real estate builder, you develop one this society, ठीक है? You develop this premises as a buildings, ठीक है? Now what you did, you sell, let's say there is a company called X who manufacture this or who build this entire premises, ठीक है? And they sell this particular one to Y, ठीक है? Later on they took this particular place आपका or this particular flat from Y. So where, like, what is doing? The X is taking this particular place for their office purposes, okay, for their office purposes from the Y. So first they sold the entire building to Y. Now from the like what they are doing, they are taking this particular premises on lease आपका, ठीक है? That this is sale and lease back, ठीक है? It happen in so many businesses, especially where the equipment cost is very high, ठीक है? In that those type of businesses, this is the one. So please do remember this one, accounting standard 116, and we can have two type, operating and finance, ठीक है? This is the one. Rest आपका we will be discussing one by one, ठीक है? So lease financing. So based on nature, we can have operating and आपका finance as per the आपका accounting standard 19 as well as your Indian accounting standard 116, ठीक है? So do remember these one, ठीक है? So accounting standard 19 and Indian accounting standard आपका 116, ठीक है? So we have two type of lease, operating lease which is short term in nature, which is cancelable, ठीक है? And maintenance is done by the lessee, lessor, ठीक है? Owner of the asset. In case of finance lease, long term in nature, ठीक है? And at the end of the lease period, lessee have right to purchase that particular asset. And the third one is maintenance, in that case is done by the lessee itself, okay? Because it is for the long term period. The another one we can have like the another methods, okay? We can have direct lease, sale back and others. So first we will be discussing these two, then we'll come to this one, okay? Okay, so first we have operating lease, and operating lease is cancelable contractual agreement whereby the lessee agree to make periodic payment to lessor. Often आपका it can be for 1 year, 2 years, 3 years and all. Usually for short to medium term आपका that is the case. They are cancelable in nature, and the maintenance is done by the lessor आपका, ठीक है? So the in case of finance lease, ठीक है? Finance lease or finance आपका, or which is also known as capital lease or long term lease, then the operating lease, and non cancelable in nature, ठीक है? Non cancelable means it can be it can be cancelled during that period, but the lessee have to pay amounts or the remaining amount to the, or whatever the compensation to the your lessor, ठीक है? Let's say there is a aircraft manufacturing company like Boeing and all, ठीक है? So Boeing, they generally give one aircraft to Air India, suppose that, and the lease period is for 10 years, ठीक है? Now first of all, this is the kind of आपका finance lease which is for a long term period, and at the end of 10th year, Air India will have right to purchase this, and maintenance will done by Air India itself, okay? But if Air India want to cancel this particular one at the end of 3rd year or 5th year or 7th year within that period, so for the agreement from the lessor is very important. If they are paying compensation to Boeing for the remaining period, and if Boeing agree, so in that case it can be cancelled. In general, they are non-cancelable in nature, okay? And obligate the lessee to make payment for the use of an asset over a predetermined period. That is the another part is similar, okay? So finance lease, now this is something which is very, very important, guys. This get asked so many times, so please do remember this, okay? So when it comes to finance lease, a situation under which lease is normally classified as finance lease. So we have 7 statements. All 7 statements are important, so you have to build your understanding. The ownership of assets is transferred to the lessee by the end of the lease. Okay? As I gave you an example of Boeing. So usually we design these type of things कि by the end of the lease period, the ownership will get transferred, or the lessee will have first right to purchase those particular asset at a lower price than the market price. Okay? So this is the one. The lessee has the option to purchase the asset at a price which is substantially lower than the fair value or book value, and reasonably ascertain that the option will be exercised. So this is totally in the आपका when lessee want to purchase this, so they do have the first right. The lease term is for a major part of economic life of the asset, or it can be for the whole economic life of the asset. That means, let's say this aircraft, the useful life of this aircraft was supposed at 15 years. Okay? So usually in this particular case or lease finance, there is only a single user or single lessee who is entering into an agreement for the entire period. Okay? So this lease period is like mostly will be for 15 years. Okay? And the after that, the whatever the uses, so that will be go to the lessee itself. Okay? So this is something which is aapka in finance lease. In operating lease, there are multiple lessees. Okay? So one who use for 6 months, then it give to another, then another, like in case of rent and others, it can be. Okay? So the present value of minimum lease payment at the inception of lease amount is substantial to fair value of the leased asset or more. Let's say the aircraft value is supposed at 50 crores. So during this 50 crore 15 years, the lessee is paying 50 crore and above than that. Simply, so lesser can benefit it from that particular one. The lease asset is more such as specialized nature that can used by only one lessee, like as I gave you. Okay, like after this 15 years, this aircraft is not in use. So that's why there is only one user of this or one lessee. The lessee has right to cancel to the leasee. Now, this statement will create some sort of contradict, as I told you earlier. It is non-cancelable. It can be cancelled by the lessee. See, read carefully. Has right to cancel the lease, and the lesser losses due to the cancellation are borne by the lessee. If you are cancelling this particular lease agreement, like let's say it was for 15 years, by the end of 10th year, if you are cancelling, so remaining 5 years, whatever the losses of the lesser, you have to compensate. That is the only conditions. The lessee has the right to continue the lease for a secondary period at a rent which is substantially lower than this one. Okay? So even like let's say in case of let's say we have given the useful life is supposed at 15 years, we have given for 5 years. Now the next time if they want to use, they do have that right first. So that at a fair value or lower than that. Okay? So this is the one. So these are the 7 statements which you have to remember. They get asked so many times. Which of the following statement is correct or incorrect about the finance lease? And you will get exact these lines in your examination. So the good thing about this examination is if you stick to this content, you are going to face these statements in the examination. Okay? Now next one is direct lease. Direct lease is something aapka, it is capital lease aapka here. Like a normal lease, where asset is given to a person, that is not. Under direct leasing, the firm acquired the right to use an asset from the manufacturer directly. So let's say there is a manufacturer of some equipments or others, and the company who is going to use that particular one, they directly took that particular from the manufacturer itself. So usually what happened in some cases, manufacturer, then this sold asset to someone else, that someone else is giving that asset into lease. But in this case, aapka manufacturer is directly giving that as a lessor, they are giving that asset on lease to a other party. The ownership of the asset lease out remain with the manufacturer itself. So this is the case. Small definition. Please do remember this one. Sometimes they ask, like we will be practicing a set of question also. Sale and lease back, as I gave you an example of that property, let's say there is a real estate builder, they manufacture this or they construct this property. X is a real estate business, they manufacture this or they construct this building and they sell this particular one to Y. Later on, X entered into a lease agreement with Y for this particular premises where they generally set up their office. So this is aapka sale. First you are selling that particular one, then you are taking that particular place or machinery on lease from the whoever you have sold that particular machine. Okay? So under sale and leaseback arrangement, the firm sell an asset that it own and then lease to the same asset back from the buyers. This way, the lessee get the asset for use, and at the same time, they also get the cash. Okay? So after selling this, let's say you get 100 crore rupees. Now you are paying monthly rent of suppose that 50 आपका 5 lakh per month आपका to this one. ठीक है? So you are managing that cash business or cash flows in your business. ठीक है? Leverage lease आपका, it is also known as आपका kind of similar to direct lease आपका. ठीक है? So leverage is something where leverage is something linked with the debt finance आपका. ठीक है? So where financing and then taking it on lease. ठीक है? So leverage lease is the same as direct lease, except that third party, the lender, is involved in addition to the lessee and lessor. The lender partly finance the purchase of assets to be leased, and the lesser turn to be borrowers. ठीक है? Let's say there is a, let's say this is SBI, ठीक है, who give loan to this manufacturer और आपका lesser, ठीक है, to construct this machinery or to building. ठीक है? Now let's say they are charging, they have given 10 crore rupees loan and their EMI is suppose that आपका 10 lakh per month. ठीक है? So there is a आपका construction company called X who manufacture or who construct this building. ठीक है? For this, for the construction purpose, they have taken a loan from the SBI, which is 10 crore rupees, and where the yearly rent is yearly or monthly EMI is 10 lakh. And now X have given this portion to different borrowers, let's say Y, and they are charging a lease आपका, let's say X have given this entire building to Y and they are charging a lease for आपका 15 lakh, suppose that. ठीक है? So this is the something how they are managing things. ठीक है? So this is leverage lease आपका. So where we have taken as a X, as a lessor, we have taken some sort of financial leverage or debt from the market to construct or to kind of manufacture that machinery and all, right? So that is the one. Next one. Still, now next few slide, this will be not part of your IN IFS, but they are very important for AFM subject. So please pay your attention. First one is legal aspect of leasing. Okay? So legal aspect आपका, ठीक है? So basically we have two. One is lease under law. So the Transfer of Property Act and the Indian Registration Act define the lease only for property, not for the equipments. Okay? When it comes to the आपका equipment leasing, okay? So since no separate law exists, so in this particular case, provision for bailment under the Indian Contract Act will apply. Okay? So when it comes to the legal aspect of that contract between lessor and lessee, so that is governed under this. Okay? So in case of आपका property, basically in case of property we have to follow this. ठीक है? But in case of equipments आपका, ठीक है, like machinery and all, we do not have any dedicated act, so we have to follow Indian Contract Act. Okay? So obligation, duties of lessor and lessee are similar to those the bailor and bailee in this particular case, in case of Indian Contract Act, okay? Unless stated otherwise in the lease contract. I hope you know the bailor and bailee. If you are going through that PPB classes, so they are already get covered in that particular one. Okay? So this is something that is आपका the legal aspect of this one. Okay? Apart from this, GST, this get asked so many times. Okay? So when it comes to GST, so now again for the lease we have, let's say if it is आपका, it is similar to your goods and services. Okay? So goods and services, let's say if we are giving a car on lease, so whatever goods GST is applicable on car, that will be applicable here. Okay? If we are giving properties on rent or lease, so whatever GST is applicable on properties, that will be get covered under this one, because it's a sale agreement between these two. Okay? So GST Act 2017 defines supply to include all form like sale, transfer, barter, exchange, rental, lease, etc. Okay? So here we have this one. If done for the consideration in business. Okay? So leasing under GST, lease is treated as supply and hence taxable नो डिस्टिंक्शन बिटवीन फाइनेंस लीज एंड ऑपरेटिंग लीज, ठीक है। सो जीएसटी आपका नील रेट इफ इट इज नील, ठीक है। Lease of industrial plot by the state government industrial development corporation or undertakings, lease of agro machinery and vacant lands, ठीक है। so these are the exempted from the आपका जीएसटी, ठीक है। two things, one is आपका industrial plot which is sponsored by आपका state like industrial areas, you know, ठीक है, and the another one is agro machinery and आपका vacant lands, ठीक है। the other आपका in other cases, ठीक है, GST applicable under supply of goods or supply of services at the same rate as similar to goods and services. As I told you, like let's say in case of car, if it is aapka 18%, so on that agreement also it will be applicable 18%. If something else is there where the GST is 5%, so it will be while you design that contract, so GST will be 5%. Okay, so these two things are very, very important. They get asked so many times. So please do remember these things, the exemptions and as well as the other cases. Okay. Now, income tax implication of lease, how lessor and lessee is going to use these particular one in their or show these particular expenses or income in their book. Okay. So in a lease transaction, lessor can claim depreciation, ठीक है। Please do remember this, ठीक है। Lessor as the owner, they can claim depreciation on the asset as a owner, ठीक है, while lessee cannot, ठीक है। So you will get statement based on this कि they'll tweak the statement कि lessee can claim a depreciation, no, ठीक है, lessee cannot claim. For lessee it is an operating expense, but for lessor, he's the owner of that asset, so it will be part of the asset side in their long-term assets, in their non-current asset in their balance sheet, and the reduction is value will be adjusted through the depreciation. Okay? In sale and leaseback transaction, depreciation is based on the asset depreciated value, not based on the sale value. Okay? The entire lease rental are taxed as income for the lessor. Okay? So entire lease rental is आपका taxed as income for the, let's say during that period you generated income of 50 lakhs. So that 50 lakh will be subject matter of taxation, and that will be considered your income, and accordingly you have to pay the taxes. That asset has generated 50 lakhs, that is the meaning. The lessee can treat the rental as an operating expense आपका. So this is the one, right? So accounting of lease transactions in a book of lessee. This is again very important. Please do remember this. So when it comes to आपका the distinction between finance and operating lease, as far accounting treatment in the book of lease is आपका has been removed from accounting standard 16, and accounting standard 16 116 prescribe the following in respect of accounting of lease transaction in book of lessee. So at the commencement date, a lessee shall recognize right of use asset and lease liability, whatever they have paid. At the commencement date, a lessee shall measure the right of use asset at a cost. Like it can be apart from that rental, there can be some other cost also. The cost of right of use asset shall comprise these one. The amount of initial measurement of lease liability, any lease payment made or at or before the commencement date or in term of advances, less any increment received आपका, sorry, incentive received, any initial direct cost incurred by the lessee, ठीक है, while we move that asset from lesser property to lessee. Let's say there is a freight of 5,000, so that you have to minus, ठीक है, you have to add, sorry, ठीक है, and estimate of cost to be incurred by the lessee in dismantling and removing the underlying asset. Okay? In future, if we dismantle that particular one, so let's say it will cost us 30,000. So that also get included in that particular cost. Okay? Restoring the site on which it is located or restoring underlying assets to the condition required by the item and condition of lease unless those costs are incurred to produce inventory. So this is something or similar to your property plants equipments while we acquire an asset. Okay? apart from that purchase cost, there are some directly attributable costs that is also applicable in this case. So you can also show those particular things as an expense of that particular lease agreement in your lessee book. Okay. So this is all about your आपका lease agreement. Now with this set of practice is very important for these kind of static topic. If you practice more and more, you will be able to secure your marks. Okay. So working capital management. When it comes to working capital management, it includes topics like basic introduction and working capital cycle, which is also known as cash to cash cycle. We have current assets of the firm and sources of current affairs finance, or we can say working capital finance. Okay. Then we have working capital assessment by the bank and comparison of three method of the assessment, right? So these are the subtopic which are generally part of this one. So first we will be discussing the fundamental aspect of this particular topic, right? So guys, when it comes to working capital, it is all about, like, this is also known as the runway which companies require to manage their short-term liabilities. Short-term liabilities or current liabilities, that means your rent, salary, purchase of raw material and others. Okay. So sometimes it is also known as cash to cash cycle. Okay. Basically, how we generally do the business, we purchase or we procure the raw material on credit. Okay. Then we convert that raw material into finished good, then we sell that particular those particular finished goods on credit, then we receive the money. So this entire cycle is generally known as your working capital. So there are so many factors which generally affect the overall working capital. So it can be based on like the size of the business. If it is big, so a larger amount of working capital will be required, or else like if you are running some sort of kind of seasonal business, so accordingly you have to manage. Or there are some businesses which have like current their receivables are kind of on at the time of they generally known as demand, or like we can say like we can have an example of transportation industry like railways or airlines and all. Okay. So whenever they are, if they are delivering any services, they are first getting the payment, then they are delivering the services like utility bills and all, they get instant working capital or the money. Okay. So this is a very important component of any business, because you have to manage this particular one properly. A working capital ratio, which is also known as current ratio, it should be in between 1 is to 1.2 to आपका 2. If you are managing in this particular one, you are having proper utilization of money, as well as you will be able to manage that cycle properly, right? So in this session we will be discussing the entire things. So as I said, like this is something aapka, let's say a cash to cash cycle means we have some cash, or we purchase raw material or inventory from this, then we convert those particular raw material into the finished goods, then we have account receivables, and then again it get converted into cash. So how basically this things generally work? Let's say we have we have procured some goods आपका, ठीक है? So suppose that we purchase raw material on credit. Suppose that the period is आपका 3 months, ठीक है? So we made a commitments कि we will pay you back in 3 months. That means you have to convert this particular one in finished good. Let's say you have a period of like within 15 days, you are converting those particular one into finished good. Then finished good, you have 15 days to sell that particular finished good in the market. 1 month gone. Then let's say when it comes to the account receivables, so your account receivable policy should be आपका less than 2 months. ठीक है? Let's say we kept a policy of 1 month. ठीक है? So basically we are giving our goods to the retailers or the other wholesalers and all. ठीक है? At a आपका 1 month period and all. ठीक है? At a credit on a credit of 1 month period आपका. ठीक है? So we are keeping 1 month buffer. So if there is any like lapse in any stages, so we can deal with that one. Okay? So within 1 month you are getting that money, then you can hold for that money for 1 month. Again you are making payments in this. So this is entire things which is generally comes under your आपका working capital management. ठीक है, I'll reduce the volume. I guess it is very high, right? Yes, हाँ, ठीक है. तो working capital basically companies, how companies they generally manage their day-to-day activities, how they are financing their current affairs. Okay? What are the sources of their current affairs, current assets which include like cash or equivalents, inventory, or all these kind of things, and we are using these particular one for the payments of current liabilities, right? So working capital management require monitoring companies' assets and liabilities to maintain sufficient cash flows to meet its short-term operating cost and short-term debt obligations. ठीक है? So basically, the general purpose is आपका ठीक है. Working capital management can improve a company's cash flow management and earning quality by using resources efficiently, right? So I hope you guys also watch the Shark Tank and all these kind of things. ठीक है? So sometimes they used to like one word that is called runway and all. Na? So let's say you have runway for how many months? That if somebody is thinking we have runway only for 6 months, that means their working capital ratio is 0.5. That means let's say if their expenses are 1 crores, they have only 50 lakh with them. Okay? So that means they are in danger, right? So because they do not have, if they do not work around the cost or around the building of these current assets and all, so after 6 months, that business is going to face some sort of crisis, right? So when it comes to working capital management, it generally include liquidity management, okay, how effectively we are able to convert our assets into cash, okay, like inventories and all. Okay. Then we have account receivables, okay, as I gave you an example. Okay. So let's say your payables are 3 months, you are entering into a cycle of 3 months, and you decided 1 month receivables. Okay. These kind of calculations you have to do in your business. Okay. Then आपका inventory management, this is again very important. Okay. So your inventory is not like they are not the ideal period should be minimum आपका, and there should be a proper inventory management. Okay. Like we use different method, like car industry nowadays they use JIT, just in time, right? So what they generally do, they come up with their product, they launch in the market, then they take the demands, then accordingly as per the demand they manufacture. Even some mobile phone manufacturing companies and all other also. Okay. So account payables आपका ठीक है, obviously. So payables आपका to the vendors and all, ठीक है, from where we have purchased the raw material, and आपका receivable is something where from where we are going to receive that particular, those wholesaler and all, those who are selling our product in the market. ठीक है. Short term debt management is also आपका ठीक है, so we can properly meet the obligations without any default. ठीक है. So it can be loan or it can be other आपका corporate requirements like rent, salaries, utility expenses and all. So you have to consider all these particular things, right? So component of working capital management. Okay? So what comes under this one? I hope now you're getting some idea around this one. Okay? So working capital cycle, as I said, it is a cash to cash cycle which include purchase of raw material which we generally purchase on credit. ठीक है. Then आपका conversion into आपका finished good. ठीक है. Then sale of आपका good mostly on credit. ठीक है. So receipt of cash from the sale and reinvestment into raw material. So this is the entire cycle, how effectively you are managing that particular cycle. That is your working capital cycle. Okay? So length of cycle which depend on so many areas like quantity of raw material held, time taken to convert work in progress into finished good, and credit period given to the customers or the wholesalers. Okay? So this is something basic areas आपका. ठीक है. Longer the working capital cycle, higher the working capital will require. ठीक है. So more current asset needed to be mentioned. Okay. Then when it comes to accurate assessment of this cycle is crucial for efficient working capital management. So whatever we have discussed so far, this is the kind of a आपका summary for that particular one. All right, is this clear? Any doubt on this? So you can mention or you can approach me on the like chat section and all. Okay. So when it comes to current asset, okay, so current assets which usually include these many things. Okay, these are the basically like with the help of these particular one, we are going to meet our current liabilities or our debt obligations, short-term debt obligations. The major component is cash and equivalents, account receivables. ठीक है? Then we have if any prepaid expenses are there like prepaid rent, prepaid salaries and all. ठीक है? For that particular period, raw material आपका ठीक है? Inventory and short term investments also. ठीक है? So these are the kind of a source or the form of current assets, ठीक है? Which will help you to meet your current liabilities and all, right? So factors which influencing the need of working capital. This get asked so many times. So you have to be very careful around this particular one. Okay? So this is something which get repeatedly in your examination. Okay? It can be for half marks or 1 marks, but they'll definitely ask one question around this. So first one is nature of business. Okay? Like if it is a service based, as I gave an example of railways, electricity, transportation and all. Okay? So the low working capital is required because like let's say in case of utility bill, every month you have to pay this. That means company is receiving that amount on monthly basis. Okay? If it is आपका railways or आपका transport, so first you are making the payment, then you are using that particular services. Okay? So their cash flows or cash inflows are very high, or even prior to the delivery of services. So in that case, it is so simple कि their working capital requirement will be आपका low. ठीक है? Trading and financing firms, ठीक है? Where they are investing for this one, ठीक है? So high working capital आपका large receivables or inventories in that case. Size of business, if higher the larger the size, ठीक है? Higher the working capital will require, ठीक है? Or the smaller the size, less amount of working capital will require. ठीक है? Production policy, if it is continuous steady production, inventory build up in off seasons, needing more working capital. Average production policy help manage the seasonal demand also. See, seasonal variations, busy seasons higher working capital will require, slack seasons आपका lower working capital will require. Operating and working capital cycle, so longer cycle higher working capital means that cash to cash cycle is, if it is longer, so higher working capital will require, or vice versa. Okay? Influenced by the supply disruption, import needs, or industry credit practices. Okay? So like month of credit to customers and all. So these are the areas. So these are some major this is something like apart from this also we have so many reasons, but these are the exact pointers which are part of your curriculum, and you have to limit yourself toward that particular content and all. Okay? So this is something, these are the major factors which generally affect the working capital requirement of a business. Okay? And please do remember this, they get asked so many times. Okay? Now sources. Okay? So when it comes to sources of finance for current assets or means your working capital, okay? Because through these current assets you are going to like pay off your current liabilities or your debt obligations. Okay? So we can have these particular one like firm own working capital आपका, ठीक है? Accruals from past receivables, any trade credits आपका, ठीक है? Let's say when you are buying goods on inventories and all, ठीक है? So you are buying raw material for on a credit for a 3 months, 6 months, as I gave you example. Okay? So for 3 months you are having a period of 3 months so that you can meet with the requirements and all. Okay? So as I gave you an example, let's say we purchase raw material on a 3-month credit. Okay? Within 1 month, we are converting that raw material into finished good and we are selling to the customer. Now we are giving 1 month period to the wholesalers. So still we are having 1 month in our hand. So this cycle, if you properly managing that particular one, there is a proper sync and coordination among all the tool of this cycle, you are effectively managing everything or your working capital, right? So working capital advances by commercial bank and financial institutions also. So companies or banks, they do provide the working capital loans, working capital term loans, or else the most favorite is like cash credit or your overdraft facilities and all, they also help. Public deposits आपका intercorporate deposit, right debentures for working capital, commercial paper आपका companies, they generally issue these particular instrument for short term period. Factoring and forfeiting, this is something which is part of the आपका bill discounting. Let's say you have done some export आपका, and you are going to receive, let's say you have a bill of exchange who is with the date of आपका suppose that 3 months later, that means you are going to receive that money after 3 months, but you need immediate funds. So what you can do, you can discount this particular one with any financial institution, and you'll get you will be able to fulfill your आपका immediate requirements. ठीक है, so that is something also. ठीक है, factoring, when it comes to factoring, so all the transactions which is generally routed through the one bank, and which is called factor. ठीक है, in case of forfeiting, we are routing different transactions with multiple banks आपका. ठीक है, so majorly it is used in international transactions, ठीक है, or exports. This can be for आपका domestic as well as international, right? So this is the one by one we will be quickly discussing these particular one. ठीक है, so first one is firm own working capital. So the amount they have, basically they are putting in their business, or the owner's money, or their reserve and surplus, they can utilize that particular one. Okay. So brought in from the long-term sources like equity and others. Okay. Prevent liquidity crisis by financing part of the current assets with long-term funds. Minimum 25% of current asset in India must be financed through the long-term funds as per the Tandon Committee recommendation. This is something which is very important one. Okay? So when it comes to working capital financing, so at least after 25% it should be funded through the long-term funds, so which is called आपका net working capital. So provide financial stability and reduce over reliance on short-term funds. No one knows. Like sometimes what happens, let's say you have dependency on your sale itself. If there is a recession or there is some problem in the economy and suddenly the demand is wiped out again, or there is a very less demand, economy is facing some sort of challenges, less money supply in the economy, so that will suddenly impact the overall business. So in that case, for your kind of, you can meet up with your short-term debt and all these kind of fundings which generally help us, right? Like if total current asset is 100 lakh, your current liabilities are 75 lakh, that means your net working capital is आपका 25 lakhs. ठीक है, current asset minus current liabilities, that is the very simple formula. ठीक है, so current ratio आपका, which is current asset divided by current liabilities, and that is आपका 1.33, and which is a suitable one. ठीक है, as I told you earlier also, current ratio in between 1.2 is to 1 is आपका suitable. ठीक है, और 1.2 is to 2 आपका, that is the suitable range for the businesses आपका. ठीक है, so working capital ratio आपका, that we have discussed, current asset divided by current liabilities. This is the same ratio which we use for the current ratio also. These we have discussed in our ratio analysis also. A higher ratio means there is more cash on hand, which is generally good things. A lower ratio means cash is tighter. So slowdown in sales could cause a cash flow issues also. But this higher ratio means आपका, it should not be 10, 15 and all. There is no logic behind holding that much of money in your business. So generally आपका ratio less than 1 indicate future liquidity problems. A ratio between 1.2 to 2 considered ideal. So if it is आपका higher than this, the company is holding much cash. So like let's say there is a company whose current ratio is 10:1. That there is no required of holding that additional money. You can have 2:1. This remaining 8 rupee, what you can do, you can invest in the market, or you can generate some sort of income from that particular one. So if this is something, that is also a problem. That is problem with your fundamentals of your business itself, right? So working capital आपका. Then we have accruals आपका, expenses recognized but not yet paid आपका, like salaries, electricity bills and all. We have represent a source of short-term finance until a payment is made. Amount depend on activity level, nature of operation, industry practices and government rules. Consider a spontaneous and cost-free source of finance. Like let's say we have some sort of prepaid आपका, or the anything आपका, like that is something which going to be executed in the future itself. So they generally comes under this particular category. Trade credits आपका, we can take loan from the like we can take credit आपका pre-shipment and post-shipments, like in case of export business. So there is a term called export finance, which is आपका buyers और सप्लायर्स क्रेडिट, ठीक है, एंड वी हैव पैकेजिंग लोन देयर, ठीक है, विच इज आपका लास्ट up to 180 days, ठीक है. So if you require money for the working capital purpose, so you can take that particular, or else we do have so many facilities under this, ठीक है. So credit received from the supplier for goods and services, ठीक है, depend on the industry practice, firm reputation, liquidity, and past performances, ठीक है. Factor affecting trade credit which include industry norms, ठीक है, फर्म रेपुटेशंस, पेमेंट हिस्ट्री आपका, ठीक है, लिक्विडिटी पोजीशन एंड द प्रॉफिटेबिलिटी, कॉस्ट इन्वॉल्व, ठीक है, हिडन कॉस्ट since supplier pricing often include the risk credit or cost, ठीक है, discount may be offered by for the early payments and all, ठीक है. This is something buyer's credit and supplier's credit. One option you have buyer's credit, ठीक है, that is means while you purchasing the raw material you can take the loan. Another one is being an exporter. So basically, like sometime what happened again. So you can that supplier is arranging loan for your business. What they are telling, let's say you are a manufacturer of this marker again. So what you are doing, ki you want to let's say this marker making companies from China or from US, they want to sell their product in Indian market. They find a आपका supplier, ठीक है, or a kind of a buyer from Indian market again, who have a good network, but who like let's say they does not have that much of money to take आपका 1 lakh or 10 lakh orders and all, ठीक है. So what supplier is doing, they are generally financing to your business, ठीक है, they are providing loan to your firm to procure those particular goods आपका, and then they are giving you 3 months to sell those particular product in the market, but it is generally depend on these particular areas also, ठीक है. So this usually happen in आपका इंटरनेशनल ट्रेड, और इट कैन बी डन इन आपका लोकल मार्केट ऑल्सो, ठीक है, और विद इन द कंट्री ऑल्सो, ठीक है, वेयर बिग बिजनेसेस दे आर सपोर्टिंग दीज स्मॉल फर्म्स इन ऑल, राइट. Then we have आपका so working capital advance by commercial bank, the loan which is provided by bank. So majorly companies they go for cash credit and overdraft, and sometimes they also take the आपका working capital term loan, right. So major sources which is sources of external short term finance. One is fund based, ठीक है, like cash credit, overdraft, loan or bill discounting. So cash credit is where we have to submit some sort of security. Basically, it is pledged by the inventory itself. Okay. Overdraft is as per the reputation of that particular business. Okay. Or it can be any form of loan or any sort of bill discounting based on the receivables and all. Right. Non-fund based services, like they are issuing some sort of letter of credit again, or any sort of guarantee and co-acceptance आपका, ठीक है, letter of credit which we generally or usually use in the international finance and all, ठीक है, or that is आपका guarantee is also in that same case, or it can be in domestic market also, right. So these are the tools. So where basically opening bank of letter of credit, they are generally providing some set of guarantee to the overseas seller कि if this person will make any sort of default, we give you some sort of financial guarantee कि we will make those particular payments on timely basis and adequate credit, right. So whatever it is the value and all, if you serve the contract conditions and all. So that is something again one part of this one. Cash credit most common with sanctioned limit for withdrawals, and it is pledged by the your kind of inventories, ठीक है. Overdraft allow withdraw beyond the balances. Bill discounting आपका bank buy trade bills before maturity, as I gave you an example of, like let's say there's an exporter who did some exports, and the invoice which is आपका, let's say is going to receive that particular money after the shipment, and let's say it is for 90 days, ठीक है. So he is going to receive that money, but the period is 90 days. So in that case, what they are doing, they are uploading those particular bill on trades platform, or else they can directly approach a bank and they are discounting that particular one on immediate basis, ठीक है. Regulated by RBI norms regarding margin, inventory, receivables and working capital limits also, ठीक है. Commercial paper, this is also one of the most common instruments, ठीक है. So which is majorly issued by the आपका companies who rated A, ठीक है. So basically like they having some sort of good reputation in the market itself, ठीक है. So it is similar to your treasury bills or certificate of deposit, but it is get issued by the आपका companies. ठीक है, companies with good reputation. ठीक है, so it's a money market instrument. So the period is 7 days to 364 days or less than 1 year, and the denomination is 5 lakh and multiple, right? And it is one of the highest or highly risky instrument of money market when it comes to only money market instruments. Okay? So companies, they also using these type of instruments. They are raising funds for, like, let's say 120 days or आपका 200 days or less than 1 year period, and they are fulfilling their requirements. They are doing those, they are successfully executing the sales and all, and then they are paying back that money, right? So unsecured money market instrument introduced in India in 1990s to help the corporate borrowers to access short-term funds. Okay. Provide an additional borrowing source apart from the bank finance. Okay. Cost of borrowings by CP is lower than other short-term finance, okay, but the reputation should be good. Okay. Widely used in working capital management. Eligibility for issuing commercial paper, though you will be discussing, we will be discussing all these in your module D of IE and IFS, but still companies, NBFCs, आपका alternative investment funds, financial institutions with the standard fund based facilities, corporate with net worth of 100 crore or higher. Then we have entities permitted by RBI, cooperative societies, union, LLPs with net worth of 100 crores or more. They are eligible for issuing the आपका CP, commercial paper. So basically, okay, sorry, this is a repeat one. Here we have discussed the entire same thing. Next one we have working capital assessment by bank. Okay, this is also very important and this get asked so many times. Okay. So when we have turnover level, so the first and most important factor in assessing working capital, that means like this is also known as working capital appraisals. Take, let's say there is a business or there is a company who is approaching your bank for the working capital loan. So how you will do that entire assessment? First one is आपका turnover level. So what is the overall turnover and their cash to cash cycle, their inflows, outflows and all. The existing enterprise, past performances is used for this particular one. For new enterprise, factor like production capacity, market share, availability of raw material, industry norms are considered in this case. So how you will assess the turnover level? One, if it is there is a business who is well established from last 15 to 20 years, you can go with their past sales and all. When it is a new company, in that case, you have to consider these particular factors. Disagreement may be arise between bank and borrowers about the turnover projection also. So both the parties should be justified, especially bank. So the another one is आपका holding norms based methods. So where assessment of gross and total working capital is required. So refer to assessment of all component of working capital like inventory, label of raw material, work in progress, finished goods. Depend on the factors like lead time, how much time it is taking to convert that inventory into cash. Order size आपका, how they are getting, suppliers and imported material percentage. Then we have production process. Industry norms serve as a guide. Receivables आपका bills easier to access, depend on business practice in the industry or location. Other current asset include cash balances, advances to suppliers, advanced tax payments to prevent under financing. So these are the factors which we generally consider at the time of while we assess or while we do some sort of working capital financing. Sources of meeting working capital आपका. So we can have own sources. This we have discussed earlier also. So based on last accounting year's balance sheet or internal accruals आपका, or bank may demand additional net working capital to maintain the required current ratio. So that is the one. It should be means आपका above than 25% should be from the long-term sources, or else like if it is required, if you are in doubtful, so you can ask for the additional current asset ratio also. Supplier credit आपका depend on prevailing market practices. The business, it depend on business to business. So as a banker, we have to kind of verify their relation with their suppliers. Other current liabilities like salaries, expenses payable, rent, utility expenses, advances to customer, etc. Again, bank finance आपका, the remaining requirement not met from other sources is covered by the bank finances आपका, ठीक है. Calculation of bank finance. So again, one logically, the need for working capital finance from the bank is equal to the gap between working capital and availability of funds आपका, ठीक है. Let's say working capital requirement is suppose that 1 crores and the availability of fund is suppose that आपका 50 lakhs. That means that business need 50 lakh rupees as a working capital, right? So the enterprise or the bank may not have much control on the supplier's credit or other current liabilities, as these are driven by the market conditions or business need. Yeah. But bank can prescribe the amount to the brought in by the enterprise through the own long-term आपका sources, ठीक है, that is net working capital, ठीक है. So this was at the core of the recommendations of the Eastwell Tandon committee, ठीक है. So this is आपका you have to contribute at least 25% of your net working capital from your आपका long term sources, ठीक है, और 25% of your working capital requirement through your आपका net working capital. So though bank are now free to formulate their own policies in the in this regard, the method of lending first, second, third, we'll come to that one. Mention three there still find place in the calculation followed by the bank. The method of calculation is like this. We can use first method of lending, second method of lending, and third method of lending. In case of first method of lending, so it is under this, the enterprise was required to bring in net working capital at least 25% of working capital gap. Okay, let's say, as I gave you an example, their आपका working capital in our case was 50 lakhs. So 50 lakh का 25% should be financed through the आपका net working capital. That means from the long-term sources. ठीक है? So total current assets minus total this. Second method आपका, this is आपका first one. ठीक है? Second, under this, the enterprise was required to bring net working capital at least 25% of the total current asset. ठीक है? So now it is आपका first one is the gap. Current asset minus current liabilities, like let's say liabilities are 1 crores, assets are 50 lakh. 50 lakh ka 25%. In this case, at least 25% of your current assets. Suppose that your current assets are 1 crores, 1 crore ka 25%, that is 20 lakh rupees from the institution. Third method, under this method, the enterprise was required to bring in as a net working capital 100% of those current assets आपका which are considered core assets and at least 25% of remaining current asset. So this is something आपका वहां पे what we have to do, like 100% of current asset means 1 crore rupees आपका current assets through the net working capital long term source of funds and 25% of current remaining current assets आपका. So that is, these are the three methods आपका which bank they generally use while they consider these particular project. ठीक है. So please do remember this, and this was the last subtopic. Okay. So this get asked so many time again. The exact line आपका, so you have to go through these particular one once and twice. You will be able to remember, and with the help of practice also, you will be able to analyze these particular things. Okay. Very interesting one, derivatives. So where we have the basic introduction to derivatives, derivative market, regulators of derivative, type of derivative. This is something which is very, very important one. So where we have future, forward, options and swap. Then we have importance of derivative product in Indian financial market, uses of credit derivative for risk management. This last subtopic is also very, very important. So in this particular session, we will be discussing the core concepts which is required to build your understanding. Once you're done with the understanding part, you can easily tackle the questions also, right? So let's start the discussion. So when it comes to derivative, so I hope you have seen a same definition in everywhere, like books, Google and everywhere. It is derivative are financial instruments whose value is derived from or dependent upon an underlying asset. Underlying asset could be, in case of financial derivative, it can be your equity, commodity, or it can be interest rate or indices or any आपका foreign currency. So these are generally part of the your basically called underlying asset. So when it comes to the derivative आपका, so as like if you go through this particular definition, so derivatives are financial instrument whose value is derived from. Let's say there is a XYZ company, TM. So in exchange itself, if you open NSE website or BSE website and all, or MCX for commodities derivative, or for the आपका currencies, ठीक है. So let's say this XYZ company whose current market price is suppose that आपका 100 rupees, ठीक है. So this is the current market. This is an underlying asset, ठीक है. Underlying asset could be your stock or equity or any indices or commodity, currency, and interest rate and others. Okay, so this is an underlying asset. So based on this, and this is the current market prices. What we usually do with the help of derivative, we try to discover the market prices in the future itself, right? So based on this current market prices, let's say right now it is September, okay? So September, let's say the आपका October, there are three contract, okay? October, November, okay? And September, okay? September contract will end by the last Thursday of this particular month, okay? So now these are the आपका future prices you will see in the market. Let's say it is 105, it is आपका 112, and it is आपका suppose that 119, okay? So these future prices, let's say this is a future contract, this is a future which is a type of derivatives, okay? So the future prices of this particular underlying, we generally, or these particular prices, which are generally derived from or dependent upon an underlying asset. Okay? To calculate these particular one, we do have different methods, like usually there is a Black-Scholes model, or the other one also. Okay? So like there is one formula which we use to calculate this, that is SERT. Okay? So where S is equal to आपका spot price, which is let's say 100 rupees. E is exponent, which is आपका 2.71828, and R is आपका rate of interest, and time is आपका if it is 1 month or 2 months or 3 months. So 3 divided by 12. So now why we always used to say this, कि the value is depend upon or आपका depend upon or आपका derive from the underlying asset. If there will be any movement, upward movements in this particular one, so the prices of these derivative will also go up, because while we are calculating based on current market prices. If this will come down, so these will also come down. So it is as simple as that. Like we have curd, the relation between milk and curd. So basically, milk is kind of a underlying asset for curd. So if prices of milk will increase, the prices of curd will also increase. If prices of milk will decrease, the prices of curd will also decrease. So that is something like this. So derivatives, this is a derivative. It can be option also. If it in case of exchange traded derivative, we have two type of derivatives. Or it can be, if it is a private agreements, it can be forward or swap. So we have four type of derivatives. So derivatives are, means this future options are financial contract whose value is derived from or dependent upon an underlying asset. The performance of underlying asset will decide the pricing of your आपका future or options. Or the simply saying it is आपका derivatives, right? So now the primary purpose of derivative is hedging. So initially when we introduced a derivative as a financial product, the purpose was hedging. Especially these OTC, especially the forward contract, which get used by the exporter importers to hedge their position. But later on, when this market start getting attraction from the investors and all, nowadays people, they generally use derivative market for trading purpose also, right? So you can make your position in let's say if you have some equity, let's say you own XYZ company, XYZ company, let's say you have a long position in this particular one. Long position means you, let's say you have let's say 50 crore rupees of shares of this particular company. You have a buy position or long position in XYZ company shares. Now you are very bullish about this, that's why you have purchased it. That is a simple meaning. And you are expecting the prices will go up. So let's say the current market price of this company share is 1050, and you have expectations that it will go beyond 2000 after 2-3 years. So now sometime what happened, let's say in 3 months you are expecting the prices will go आपका 1500, but there is some uncertainty also, that is the pricing that is totally depend on the market factors, demand and supply. Okay, so sometime let's say if there is the market is behaving in an adverse manner of your position, okay, so there is a market risk, so there is some sort of speculation in the market or some fundamentals errors in that particular company, okay. So like there is some news or aapka there is some kind of activity that going to be happen, and that activity can make a negative impact on this particular one. So for that sake, what you will do, you can aapka, let's say you own the 50 crore rupees shares of XYZ company. Let's say the number of shares is suppose that 10,000, okay? 10,000 shares are okay. So what you can do in this particular case to protect any downfall, you can enter into future or option contract of this particular derivative, and you can sell these particular one worth rupees 50 crore to these particular shares, okay? So now let's say for the 3 months contract, let's say there is a kind of dilemma in the market, okay? So you can sell the future of that XYZ company shares or the contract, okay? So if the prices will go up, this will give you benefit. If prices will go down, this will give you benefit, okay? So and if it happens simultaneously, okay, so obviously it will happen simultaneously, okay? Either it will go up or go down, okay? So if it go, let's say if it come down till for a like that news come in the market, and there will be sudden impact on this one, okay? So you can hold this particular position, but once it reaches to a bottom, then will start coming up, so you can sell, exit here, you can buy here, and you can still remain in this contract. So it help companies after entering in this particular contract, you will not have a single rupee loss आपका, and कहीं ना कहीं like this will help you to protect from any sort of market risk, okay? Even the exporter also do, let's say their export invoice is quoted in foreign currency, okay? Let's say there is an exporter who did one export of worth rupees 10 million, okay? So $10 million, suppose that, okay? So there is an exporter who did an export of 10 million USD, the invoice is in dollar, okay? That means let's say he is going to receive this money after 6 months, okay? So after 6 months from the date of shipment. So now there is a chances, let's say the right now the currency rate is 80, like for $1 it is aapka, let's say 88 rupees, okay? So this is the current market rate, okay? So now there is a kind of a speculation that after some time India-US relation will get improved, and the dollar Indian rupee will get a strength and will have more market exploration in all, okay? So in that case, there is a chance the currency can move in an adverse direction, okay? For for that exporter, if currency or if this dollar get weakened, so they'll have some sort of losses. Reason being, so now right now the conversion will be आपका 10 million USD into 88. So later on there is a chance कि it come down to 80 आपका, 80. So what they can do, they can sell the आपका future of dollars in the market itself, so they can prevent themselves from any sort of losses, because they have open position आपका buy position in dollar already, because they have a contract, and if they'll sell, they'll not have any losses. So this was the primary motive of derivatives. But nowadays investors or traders, they use derivative, especially future and options, for the trading purpose, right? So derivatives stand for the contract whose value or price derived from the derived or dependent upon an underlying asset. Underlying asset could be आपका currency, stock market, indices, interest bearing security, or any physical commodity also, okay? That we have discussed earlier also, okay? Now when it comes to derivative regulators, okay? So regulators of derivative, we have two regulators. One is SEBI, Securities and Exchange Board of India, and another one is RBI, okay? RBI, which regulate आपका swap contract, and only 3 swap contract which you have to remember. Rest all is generally done by the SEBI itself, right? So in India, different derivative instruments are permitted and regulated by various regulators like RBI, आपका SEBI. Earlier there was FMC also, Forward Market Commission, but since 2015 when it get merged with SEBI, so now we have only two, okay? So RBI empowered to regulate interest rate derivative, foreign currency derivative, and credit derivatives. These 3 type of derivative, interest rate, आपका foreign currency, and credit derivatives, these get regulated by RBI. Rest आपका SEBI, which regulate capital market, and FMC regulate the commodities future. ठीक है? So FMC, हाँ, it is mentioned here also. ठीक है? Have been merged with SEBI आपका. ठीक है? Merged with SEBI with effective from September 28, 2015. So after that, this आपका commodities future market is also get regulated by SEBI itself. Please do remember this and these three derivatives. Rest you know, it is all done by the RBI itself. Okay. So now derivative market. Okay. So when it comes to derivative market, we have four type of derivatives and these get traded in two ways. Okay. One is OTC, over the counter. Another one is आपका exchange traded derivative. Okay. Let's build an understanding around this particular one. Okay. So like when it comes to like we have four derivatives आपका two major categorization, OTC, over the counter, versus आपका exchange traded derivative. ठीक है? If you understood this, it is आपका, it will become very easy to make your like differences between the different type, and this will also help you in IE and IFS also or any other examination. ठीक है? So when it comes to आपका exchange traded derivatives, it आपका sorry OTC, ठीक है? It include derivatives like forward and your आपका swap. ठीक है? So forward and swap are majorly OTC derivatives. ठीक है? And when it comes to exchange traded derivative, it include your options. ठीक है? Options and future. ठीक है? Options and future. We have four type of derivatives and this is the further categorization. ठीक है? Now when it comes to the overall आपका dealings. ठीक है? So now with this exchange versus OTC, ठीक है? So you can also compare forward versus future, forward versus options, आपका swap versus option, swap versus future. So means with this concept you can deal with आपका these six type of differentiation, right? So that's why this is very important. Now when it comes to OTC, over the counter, these are the private agreements. ठीक है? These are the private agreements आपका between buyers and sellers. ठीक है? So private agreements means आपका there are only two parties get involved in these kind of derivative. Mostly it is आपका your exchange or sorry bank and exporters or any enterprise. ठीक है? Let's say this is the one. So these are private contract. That means parties involved in these kind of contract, they can customize according to their need आपका. ठीक है? So parties involved in these type of derivatives, so they can design the product or agreements according to their need, like the expiry date they can decide by as per their requirements, the lot size, or there is no margin is required in this case and all. So these are kind of customizable. And when it comes to exchange traded, these are generally get traded in recognized stock exchange like BSE or NSE in India. So Bombay Stock Exchange in NSE. These are standardized contract, standardized by the exchange. These are kind of the product or the product designing is done by the exchange itself, about the आपका expiry date, about the trading hours, about the your kind of that the lot size, or आपका the initial margin is required in this particular case. So now when it comes to risk आपका, ठीक है, these are least risky आपका. ठीक है? So when it comes to the risk आपका, ठीक है, they are low risky instrument. Reason being the exchange stand the guarantee in this particular case. ठीक है? Participants आपका they need to pay आपका margin, ठीक है, to purchase these type of derivatives, and they need to maintain this margin on M2M basis, mark to mark basis. ठीक है? Let's say you have purchased some contract आपका and you have paid 7% of margin. If the value come down, you have to deposit margin with exchange आपका. ठीक है? So that's why these are least risky, because exchange stand guarantee in this particular case. But when it comes to आपका यहाँ पे that is high risky instrument, these are the high risky आपका because of there is no like there is a counterparty risk involved in this case, and there is no intermediary in between आपका buyer and seller of these particular contract. They can have some sort of agreements which is bounded by act and all, but in this case आपका there is a no counterparty risk because exchange work as a mediator, right? When it comes to transparency, ठीक है, these are least transparent, these are highly transparent, ठीक है, you can open NSE BSE website, you can see the top 5 buyer, top 5 sellers, or overall buyers, overall seller, but that option is not available here, right? Apart from this, when it comes to your liquidity, yeah, so these are less liquid, OTC are less liquid because we have only two parties. When it comes to OTC, sorry, exchange traded, these are highly liquid because it is like buyer sellers, they can meet with their price equilibrium and they can trade in this one, right? So that is the case. So the pointers which I have told you, that will help you to create a differentiation between OTC versus exchange traded. Okay? OTC, private contract, customizable, आपका काउंटर पार्टी रिस्क इज देयर, ठीक है, लीस्ट ट्रांसपेरेंट, हाई रिस्की. एक्सचेंज ट्रेडेड आपका एक्सचेंज स्टैंड द गारंटी, नो काउंटर पार्टी रिस्क, initial margin is required, here margin is not required. Another case, they get traded on recognized stock exchange, highly liquid, transparent, and when it comes to the other one also which we have discussed. Similarly, if you compare forward and future, same distinction, आपका forward and option same distinction. So that is the case. I hope you get this particular thing clearly, because this is something which will help you to summarize this one. Okay, let's go through this particular one once. So OTC, over the counter derivative contract that are traded directly between two eligible parties with or without use of intermediary, and without going through an exchange. The parameter of the contract like size, maturity, etc. are not standardized, sorry, means customized, and are mutually agreed to between parties of the contract. When it comes to exchange traded derivatives product that are traded on exchange, the maturity and size of these contracts are standardized by the exchange. Trade in these derivative product can be done only through the member of the exchange by paying the initial margin and maintaining a variable in margin account. So you have to maintain these particular one on M2M basis and all, right? So that is the case. I hope this is clear to everyone, right? Chalo, next one. Here we have a differentiation. Exchange versus आपका OTC. ठीक है? This part is more like we can say, if you open your IN IFS wala area, ठीक है, module D. So that is get explained in your IN IFS. But in when it comes to AFM, they have put more emphasis on the types of derivatives, especially that आपका swap contract and their uses also. ठीक है? So these are standard. ठीक है? Exchange traded means the contract which get traded in regulated stock exchanges like BSE and SE. So these are standardized product by the exchange. ठीक है? We have sent these are आपका bespoke, ठीक है, by the parties itself. ठीक है? So centrally cleared by the stock exchange. It is आपका cleared by the counterparty clearing houses. More liquid आपका, less liquid, because here we have only two parties. Here we have number of buyers, number of sellers. More transparent, less transparent, because these get traded on open platform. They are closed system. Minimal contractual obligation risk आपका, here counterparty risk is available. Automated आपका phone based it can be. Exchange are like in India, let's say we have 9:15 to 3:30, so that is the time. It can be आपका 24/7. Set rule and procedures आपका, and here we have flexibility also. So that is like whatever we have discussed, that is the kind of a summary here itself, right? Chalo, let's move forward, guys. Now characteristics of derivatives. I hope if you have understood things which we have discussed so far, you can easily relate these particular. That's why I always used to say, if you have conceptual clarity, you can easily relate things. You can answer straightforward question, application based question, as well as statement based question. So there are three major characteristics which is given. One is आपका their value change in response to change in specific underlying asset. As I gave you an example of company XYZ Limited. ठीक है? Derivatives आपका, or you can take an example of gold also. Like let's say if you have the current gold prices are increasing. Let's say the current prices are 1,20,000 per 10 gram. If you, let's say if you are bullish about gold, after some time gold will increase, it will go up to 1,50,000 within 6 months. So what you can do, you can buy the आपका 6 month contract of gold. Okay? We have available 1 year contract in case of commodity and currency. In case of equity, there are only 3 months contract are available. Okay? So you can buy the gold of 6 month contract आपका. If the current market prices will increase, that price will also go up. Okay? So derivatives have the characteristics of high leverage. That means you do have, like in case of OTC, you do not have to pay any sort of initial amount. In case of exchange traded derivative, you have to pay initial minimum amount, that is called margin. Okay, let's say there is a gold contract whose value is 1 crore. You do not have to initially invest 1 crore rupees. You just have to pay the margin money. Let's say it is 10%. That means you just have to pay 10 lakh rupees. So by paying 10 lakh rupees, you can enter into a contract worth rupees 1 crore, and your benefits or losses will be accordingly to the overall contract value, not your money contributed. So that is the things. Okay? So and being complex in their pricing and trading mechanism, they require no or little initial net investment. As I told you, to own 1 crore contract, you are just paying 10 lakh rupees. Okay? When compared to other type of contract having similar response to change, it is settled in future date. Okay? So it can, as I told you, like for equity derivatives, we have 3 months. For commodity and currency exchange traded, I'm talking about here. So it is आपका 1 year. 1 year contract are available. OTC, it can be as per the requirements of the parties itself. Okay? So I hope this is clear. Functions of derivative, again, believe me, if you have understood well, you will be able to make your understanding around these particular statement without my explanation. Derivative shift the risk from buyer of the derivative product to seller, and such as very effective in risk management. As I gave you an example of hedging of that XYZ company. Derivative improve liquidity of the underlying instrument. Yeah? If there is, like, let's say that XYZ company is favorite for all, they are investing in the future, that means there is a high, that underlying company have some solid backgrounds, or that is generally increasing the overall liquidity in the underlying also. Derivative perform an important economic function, which is price discovery. We are check, like what we are doing usually with the help of derivative, like current market price is 100 rupees, 6 months after it will become 120. So what we are doing eventually, price discovery, right? By they provide better avenue for raising money. They contribute substantially to increasing the depth of market also, right? So this is the one. Now the next part, or the most important part, which is aapka types of derivatives. So as I have explained you, like we have 4 type of derivative: future, forward, options, and swap. So when it comes to these different type of derivatives, so we do have one another classification. So future and options, these are exchange traded derivatives, ETD. And when it comes to forward and swap, these two are basically your aapka OTC. They are generally categorized under over the counter. Now you know the differences. So now when you study these particular ones, they become very easy. Future contracts. So basically, these are the future is a derivative part of derivative contract. So or a type of derivative whose value or the settlement take in future things, they exchange traded, these kind of thing. Forward, आपका out of OTC derivatives, आपका they get traded between two parties and get settled in future date. Options आपका which give right an option or a right to buy or sell. In case of call option, right to buy. In case of put option, right to sell to the aapka holder of the option, but not an obligation. When it comes to swap, it is kind of exchange of currency or flip of position, like fixed rate versus floating rate. If a person having position in fixed rate and they have some sort of expectation from market that the floating rate will be more helpful, so they can find out a company or person who is having floating rate, and they can exchange the position, and whatever the differences, they can exchange them. So that is the one. So in let's quickly discuss these particular one by one. Okay? So first one is future. So when it comes to future, a future contract, an agreement between two parties to buy or sell an asset at a certain time in a future at a certain price. Okay? Let's say like there is a let's say in case of gold. Okay? So two parties, party A and party B. Party B, they have expectations ki gold prices in next 3 months, gold prices will come down and party A which is bullish and party B which is bearish. ठीक है. So party A have thought process कि gold prices will go up, and party B have a thought process gold prices will go down in 3 months. ठीक है. So let's say they enter into a contract like at 1.40 lakh आपका 3 months later. ठीक है. So basically party A is saying कि prices will go up above this particular one. Party B is saying आपका prices will come down or it will remain below the 1,40,000. So they enter into a contract on this particular one. At the time of expiry, let's say the prices are supposed at 1,50,000. That means this party won in this particular their analysis. Okay. So party A will pay the 40,000 rupees to 10,000 rupees. The gap आपका 1,50,000, so 10,000 to B आपका. That is B will pay to the A आपका in this particular case. That is the kind of things. Okay. The exchange, these are the exchange traded standardized contract. The exchange stand guarantee, because now we know the to all transaction and counterparty risk is largely eliminated because these are get traded on stock exchanges. ठीक है. Forward contract आपका, this is similar to आपका this future contract, ठीक है. But this contract between A and B happen over the counter. ठीक है. So in this case, this contract happened on a regulated stock exchange, NSE, BSE, they purchased this. And in case of the forward contract, the contract between A and B happened over the counter. Like they, this is also known as dabba trading. ठीक है. So earlier it used to be, nowadays like it is completely eliminated. ठीक है. So it is like party A and B meeting. ठीक है. They are making some sort of agreements. If gold prices will go above this, you will pay me, or if it will come down below, or if it will remain below this, I'll pay you. Okay? That kind of things. Okay? So that happened in this. So these are financial contract that obligate the contract buyers to purchase an asset at pre-agreed price on a specified future date. Okay? However, forward are more flexible contract because they are customizable in nature. Okay? Parties can customize the underlying commodity as well as quantity of the commodity. In case of, let's say, when you purchase the gold or any currency future or gold future or commodity future or आपका equity future, there is a predefined or standardized contract. Like let's say the current market price is suppose that आपका 1,000 rupees, ठीक है, into the lot size. This lot size can be, lot means a bunches of shares. Let's say if it is आपका 500, so your overall contract size will be आपका this, ठीक है, 1,000 which is the price into आपका lot size, so that is your contract size. But here we parties, those who are part of the forward contract, as per their requirements, they can basically customize things and all. That is the benefit of OTC. ठीक है. Now we have options. ठीक है. When it comes to options, so options give the buyer or holder right but not an obligation to buy or sell an option at a future date. Yeah. Buy आपका option give the buyer a right but not an obligation to buy an asset in future date, that is call option. ठीक है. And आपका in case of sell, in case of put option. ठीक है. So we have two type of option. One is call, another one is put option. ठीक है. I'll just explain this particular one. ठीक है. So let's say when it comes to options, okay, so we have two type of options in the market. One is आपका call option, okay, another one is आपका put option. So call option and put option. Okay, so option which give buyer right to buy or right to sell. Okay, in case of call option, that generally give right to buy. Okay, right to buy but not an obligation. Okay. In case of put option, the buyer of put option, they generally get right to sell. Right to sell but not an obligation. Now the question is, when we buy call option, when we are bullish about the security. So when an investor purchase the call options, so when you are bullish about the security, let's say there is a security called XYZ Limited. So let's say A is bullish about this particular one. A is bullish about this XYZ Limited. So he'll buy the call option. They'll buy the call option. So when we have expectations from that particular security that prices will go up, let's say the current market price of XYZ is supposed at 120, and this A have some expectation the prices of this XYZ limited will go आपका beyond suppose that 130 by the end of October आपका, ठीक है. So what he'll do, he'll buy the call option of October months आपका at a strike price of 130, ठीक है. Or you can take an example of gold also, ठीक है, the most favorite right now nowadays, ठीक है. So let's say the gold current market price is 1.20 lakh, ठीक है. So if A have expectations ki now the prices will go beyond that, ठीक है, after some time, let's say after 6 months the gold prices will become suppose that 1.50 lakh, ठीक है, after 6 months. So what he'll do, he'll buy the आपका call option of gold, ठीक है, at a strike price of 1,50,000. So that is something this. When it comes to put option, ठीक है, so in case of put option, when we are bearish about put option, when we are bearish about the security, ठीक है, so bearish about the security means we have an expectation the prices will come down for this particular one. Let's say there is a ABC a limited आपका, ठीक है, their prices, there is a investor called X, they have some bearish आपका viewpoint about this. देखिए, let's say the current market price of this company is 500 and X is assuming कि the prices of this company will come down आपका 450 or less than that, ठीक है. So now what he'll do, he'll buy the put option, ठीक है, put option of 450 rupees आपका. If actually the prices go beyond or below the 450, so he'll get benefited from that particular put option, ठीक है. The premium amount which he have paid, that will increase. So that is the logic, ठीक है. Now call option and put option, when you comes to the call option and put option, so we have the situations, basically it comes with the kind of what we can say, what I was telling, I just missed this thing. No. So we have three logics here, like the profit and losses. We have आपका in the money, we have at the money, and we have out the money, ठीक है. One another which I want to tell you, that was strike prices, ठीक है. Strike prices is kind of expected, like benchmark. The current market price is 120. Now, if you'll open any call option or put option of any company or commodity, you will see there are let's say this is आपका 120, ठीक है. There are 7 upside and 7 downside prices are quoted for each and every month contract, ठीक है. Like let's say as a investor आपका A, so he's bullish, so let's say there are prices are like quoted at like 125. The tick size is let's say 5, ठीक है. So 35 आपका 140. So he have some sort of expectation कि prices will go beyond आपका how much 130. So he'll buy the call option of आपका this strike price, ठीक है. So this is strike price. In case of put also, we have 7 downside also, ठीक है. So if he believe कि prices will go below the 450, he'll buy the put of 450, ठीक है. Now how these get decided in आपका in case of call option, ठीक है. Put option, you just have to reverse this one. So in the money is a concept where your आपका spot price आपका, I'm talking about the date when we are exercising that contract, means that buy sell happen in the future date, okay? If your spot price is greater than the strike price, okay, so it's a आपका in the money, and in the money is equal to a situation of profit, okay? So it's a profit call. Out the money is a situation of loss, okay? So now in the money is when your spot price, it is about the call options. In put option it will get reversed, because in put option when things come down then we get benefited again. So let's say the आपका strike price was how much 130. The expectations of A was कि the prices will go beyond 130, and that's why he purchased the 130 call price आपका, ठीक है. So strike price is 130. At the time of expiry, let's say the prices was आपका 150 आपका, ठीक है. So he got a benefit. His basically the expectations with that particular security met, and it's a profit situation. Straightforward 20 rupees per आपका unit, ठीक है. At the money is आपका when spot price equal to your आपका strike price, ठीक है. That is your आपका, let's say spot price strike price is 30. This also 130. Out the money is like when you miss your target, ठीक है. Your spot price your strike price was 130, but your let's say at the time of expiry the prices remain at 125 only. Okay? It went up but little bit, only 5 points आपका, so that's a loss situation. You will lose the entire premium paid. Now what is the loss and profit payoff आपका? Again, so when it comes to payoff, that is like in case of when you buy आपका option, when you buy option, ठीक है, means call option or put option, ठीक है, when you buy these particular one, there is a unlimited profit, limited loss up to premium paid. When you sell option, ठीक है, when you sell आपका option mean you sell the call option or the put option, limited profit up to the market premium and unlimited loss आपका. That generally work in this particular market, though that is not part of this. When you'll come to the CIB examination, we will be discussing all these other fundamental also. I hope you get some areas why this definition is there. Okay, now please quickly go through this particular one. Okay. So when it comes to a call option, it give buyer a right but not an obligation to buy a given quantity underlying asset at a given price on a future date. Okay. Put option, buyer of call option, okay, buyer are bullish on the stock and believe the share prices will rise above the strike price before the option expire. Okay, as I gave you an example, na, ki like the current market price was how much? 120, and we purchased at a strike price of 130. That person A, okay, investor A. Now they have expectation that the prices will go up. This is called aapka bull trend, okay, when prices are moving up. Okay? If the investor bullish outlook realized and the prices increase above the strike price, okay, prices went to 150 in our case. Okay? So the investor can exercise the option, buy the stock at a strike price and immediately sell आपका, ठीक है, and they'll get the benefit of आपका 20 rupees per share. ठीक है, that is the case. In case of put option, it will get reversed. ठीक है? Selling put option, you can sell also आपका, it is called writing. ठीक है, writing option contract आपका, right, but it is very dangerous. What I told you in this case, your payoff is something like this. ठीक है, it is आपका, this is let's say maximum loss area, ठीक है, the premium amount which you have paid for that particular one, but the profit area is unlimited. Okay? So limited, basically limited loss up to premium paid, like max to max the premium will become zero, it will not come in negative. Okay? When you are buying option. Okay? So and unlimited profit, let's say you have the premium for this particular one was suppose that aapka 15 rupees, this is aapka 15 rupees, it can be aapka zero if it is not moving, if it is moving in this direction. Okay? So it can, aapka premium will become zero. But if it go up, so this, let's say at the time when we purchased this, premium was 15 rupees and by the exercise aapka it become 45 rupees. So 45 rupees into number of shares, that is your profit. But in case of selling call option, that is a completely reverse. Okay? So known as writing a contract, the writer received the premium fee in other words, this premium to writer. So basically you are selling ki haan, you are bearish. When you are selling option, that means you are bearish in the market. Okay? Next one, put option आपका, when you are bearish, when you buy the put option, you are bearish about the security. If you have some expectation that prices will come down, if it will come down, there is a profit. If it will go up, you are at a loss. Okay? So buyers buying put option, buyer of put option want to stock prices to decrease आपका, ठीक है. The put option is profitable when the underlying stock price is below the strike price. ठीक है, as I gave an example of that Mr. X आपका or investor X. ठीक है. So he have some expectation कि ABC prices will come down below आपका 450. If it happen, so that is the case of profit for that person. ठीक है. Selling put option means selling put option is equal to आपका bullish. ठीक है, selling put option is equal to bullish. So basically we use combination of position, like let's say when you trade in options na, so there are so many strategies like Strandal, आपका the other one, different strategies we use. ठीक है. So how we use these one? ठीक है, let's say if you are saying कि I'm 100% bullish about this security, you have your analysis कि this 100% the prices will go up. Now what you can do, आपका first you will buy call, ठीक है, buy कॉल ऑप्शन, ठीक है, बाय कॉल ऑप्शन एंड आपका सेल पुट ऑप्शन, ठीक है. सो डबल बुलिश, ठीक है. So this will give you benefit, this will give you the premium also from the market itself. So that is the case. We have American option and European option. Simply saying these are the type of form of contract. In India, we use European options. So basically, when it comes to American options, they can be exercised any point of time before the expiry date or on expiry date. Okay? And when it comes to European option, they get exercised only on the expiry date. That contract will end only on the expiry date. Like in case of India, it is last Thursday of every month. That is the expiry date. Okay? Last Thursday of every month. Okay? So that is a form of European option. Okay? American option can be exercised at any time between the date of purchase and the date of expiration. European options are different from the American option in that they can only be exercised at the end of their life, means the expiry date आपका, that is the case. ठीक है. Now the next one is आपका swap. ठीक है. Swap contract, the next area which we are going to discuss आपका. ठीक है. So swap, we have swap is basically flip of position. ठीक है. Like let's say आपका there are two parties. ठीक है. How you make your basic understanding around this particular one. ठीक है. Let's say आपका there is two companies, company A and आपका company B. ठीक है. Let's say company A have taken loan, a bank loan of 10 crore rupees for suppose that at the rate of आपका 11% per annum. ठीक है. which is आपका फिक्स रेट. ठीक है. फिक्स रेट लोन आपका. ठीक है. एंड the party A आपका 10 crore loan at the rate of 11% for 10 years. ठीक है. The another one is party B. They have taken a loan. Suppose that they have taken a loan of assume की 10 crore rupees at the rate of आपका suppose that it is linked with MCLR plus आपका 1%. ठीक है. For again आपका 10 years. ठीक है. For 10 years. Now party A they have taken loan at fixed rate. Party B, they have taken loan at floating rate. Okay? Now, after 1 year, both are analyzing their situation. Okay? And party A, they have some different opinion now. Okay? They have ki this, like see here, the aapka, let's assume ki the current MCLR is 10. Okay? So as of now, both the parties are paying the similar interest to the bank. Okay? Now, now there is a situation ki let's say MCLR. ठीक है. So party A, they have some sort of expectation with MCLR कि MCLR will come down. ठीक है. So party A is their expectations, their analysis is saying कि there will be more cash flow in the market. ठीक है. So that's why the overall MCLR आपका that or the any indices or any link आपका indices, ठीक है, that repo rate and others, that will come down. ठीक है. So A is expecting कि MCLR will come down. So if and it will come down to 8%. ठीक है. And it will stay 8% for remaining 9 years. So what he is expecting आपका कि the price, if it will come 8%, the effective interest rate paid by the B will be आपका 8 plus 1, which is आपका 9%. ठीक है. Party B, they having आपका different sort of mindset about this thing, this situation. They have an expectation कि the prices of MCLR will go आपका up. ठीक है. And it will be for the remaining आपका 9 years, it will be आपका 12%. That means 12% plus 1% आपका this buffer. So it is आपका they have to pay 13% of a rate of interest. Two parties, same situation but different opinion. Now what they can do in this situation? ठीक है. They entered into an agreement. ठीक है. They entered into an agreement आपका. ठीक है. Party A and B both they entered into an agreement. ठीक है. Where they are flipping their position. ठीक है. Where they are आपका what they are actually doing. ठीक है. They are flipping their position. Party B is coming with this fixed rate and आपका party A is going for the floating rate. ठीक है. तो basically there is an agreement between आपका party A who is now entering into the floating rate. ठीक है. Floating rate and party B which is entering to the fixed rate आपका. So there is a exchange of fixed and floating rate between these two. So whatever happened, let's say they are planning कि we will settle things on monthly basis, quarterly basis or yearly basis. So let's say after some time suppose that the expectations of party A met. So party A expectations got met. It came down to 8%. Now in this particular situation, this party B will pay 2% आपका to party A आपका. That is the case which is your swap. So basically where we are exchanging fixed versus floating आपका with each others. So now please go through this particular one. You will get a basic idea. Swap are derivative contract that are traded over the counter, primarily between financial institution or businesses. You'll hardly see the individual participation in this market. Since they are traded OTC, the term of the swap contract are negotiated and customize the need of both the parties. So swap are private agreement between two parties to exchange cash flow in future according to pre-arranged formula that which we have arranged between party A and party B. Swap are usually involve the exchange of fixed cash flow which was A earlier with floating which was B. The most popular type of swap are like we have commodity swap, currency swap, interest rate swap. But in your curriculum, we have only three. So we have forward rate agreements, FRAs, we have plain vanilla, and we have interest rate. These are the only three type of swap which are generally part of your curriculum. So let's discuss all these particular ones. So first one is FRA. So forward rate agreements. So forward rate agreements these are the first one. So customizable being OTC contract, if they can be tailored in size and period, only interest differential are settled, so credit risk is minimal. So this is something that one example which I gave you. That is something like, let's say here two parties are entering into a contract on a notional amount. Ki party A is saying ki, let's say this is something like this ki let's say there is a contract between party A and B about the repo rate. So party A is saying repo rate will go up and party B is saying repo rate will go down. They have taken one notional amount. Let's say the calculation will be based on notional amount 1 crore. They do not have to exchange this 1 crore rupees. They are just exchanging the consequences on this. Let's say if right now at the time of contract the repo rate was 5%. After 1 month it become suppose that 6%. So party A expectations met. That means this party B, the party B will pay to party A 1% of your 1% of 1 crore rupees. That is the case. So sometimes parties they enter in these kind of things. Used to hedge short-term interest rate risk. Liquidity, FRA are not very liquid, difficult to trade because they are OTC contract and all. Nature of contract, agreement between two parties to settlement interest differentials on a notional principle for the future settlement date. See, agreement between two parties to settle interest differential on notional principle for future settlement. Maybe party A and party B, they have some opposite position in their balance sheet. They have taken a loan where that is based on the repo rate. That is linked with repo rate. So to deal with the movement of that particular one, so if repo rate will increase or decrease, there will be some losses or profit situation. To fix that particular problem, they can enter in these kind of contract. So borrowers buy FRA. Borrowers, those who are the borrowers in loan, they buy FRA to hedge against the rising interest, and lenders they sell against the falling in the interest rate. So effectiveness useful for locking interest rate, managing gap between rate sensitive asset liabilities and aiding in asset liability management. FRA. These things are very, very important. Please do remember this. Then we have plain vanilla interest rate interest rate swap. Usually this happen between two countries. Party A is from another country, B is from another country. They are swapping interest rate. Company A from India, company B from US. Company A, they are planning to make setup or some expansion in US. they need some money. That another company they want to make setup in India, they need some money. Okay? So what they'll do, in India we have different interest rate, US different interest rate. So they exchange the interest rate only, and they are taking loan in their own home countries, and they are providing they are exchanging interest rate whatever the differences it is. Okay? So simplest type of interest rates are fixed rate exchange for the floating rate, or vice versa, as we took that example also, A and B, notional principal and pre-agreement. RBI guidelines, this is something which is important. Bank can use IRS for balance sheet management and market making. Bank may also offer IRS to corporate for hedging their exposure. Bank must have proper infrastructure and risk management before market making. Market making means where you are initiating these kind of thing. You working as a आपका kind of a channel where you meeting buyer or sellers and you are facilitating them. Okay? Benchmark rate should evolve naturally in the market and gain acceptance. Any domestic money or debt market rate can be used as a benchmark, okay? Like ARR and others. No restriction on minimum, maximum notional principal amounts. Okay? No restriction on tenure. Bank must maintain capital for the आपका forward rate agreements and IRS. Okay? Means you have to maintain according to the risk categorization. You have to maintain your CRAR for these particular one, or that capital adequacy ratio. Silent feature of interest rate swap आपका ठीक है. So IRS, which is series of forward rate agreements, part of notional principal is not exchanged between parties. Two parties exchange interest rate on notional principal at pre-arranged interval. Buying IRS, pay fix आपका receive floating, price quoted in term of fixed lag, and pricing is based on the present value of future fixed versus floating cash flows. Okay? So this is all about your IFRS. The next one, credit derivatives. Okay? Now this is again very important one that get asked so many times. Okay? So like we have credit default swap. Okay? CDS, they get used, they are evolving very rapidly in the international market as well as in Indian market. Okay? So when it comes to credit derivatives, so credit derivative which include contract like आपका credit default swap. Okay? Let's say basically, let's say there's a bank, let's say SBI, they have given loan to a company X. Okay? They have given loan to company X worth rupees 50 crore. Okay? So and this loan is for आपका 10 years. Okay? So now SBI, they have created an asset worth rupees 50 crores with आपका company X. Okay? Where they are getting आपका, let's say the 50 crore amount which I have quoted here, this is principal plus interest. Okay? Let's say the by for your understanding, let's say principal is आपका 35 crores, and interest is आपका 15 crores during this particular period. Okay? Now the overall asset is आपका 50 crore rupees. Now see, when we do the loan appraisal, obviously we check everything about the company, but still there is a probability of default. Okay? That probability of default which generally comes from like maybe आपका in future the company X, they are dealing with something, some product and all, there are some restriction by the government or anything else happen. The 10 years is a very huge period. We know about the cases like Kingfisher Airlines, Satyam Computers and all. Okay? So still there is a probability of default. So what SBI can do in this particular case to protect this आपका amount without transferring the asset itself. So what they did, there's a आपका ABC Financial, one another bank or any other financial company. So as they आपका SBI and ABC, they enter into a contract where ABC Financial as a protection seller, okay? He is selling आपका, he is making some sort of commitments कि this, if this company A or company X default, we will pay you the outstanding balance. Okay? For that sake, we will charge something that is called premium. This is a kind of a simple case as insurance. Okay? So basically, SBI, this ABC is making some sort of commitment to SBI. If this X will default, we will pay you the remaining or the outstanding balance. But for this, you have to pay us, let's say 2 crore rupees. Now, SBI, they are getting, let's say 5 crore rupees. The overall premium is equal to 5 crore rupees for the entire tenure. Still, we are getting 10 crore rupees. It's a good deal. So what they'll do, this SBI is a protection buyer and they'll enter into a contract with ABC Financial to protect this one. that asset will remain in the book of SBI itself. ठीक है? So without transferring the ownership of that asset, we are transferring the risk. That is your credit, आपका uses of credit derivative, and the tool which I have explained you, that is credit default swap. ठीक है? Let's go through this one now. So purpose is आपका has a risk against asset without transferring the asset itself. Right? Nature work like insurance. Then we have traditional method, financing, guarantee, collateral. Earlier we used to have these kind of things, but now they are getting replaced with this thing. Innovative instruments like credit risk transfer or आपका collateralized debt obligations. They are not usually they did not enter in India, but credit default swap emerging as important instruments for the risk hedging. This is like this has 4 billion plus market now worldwide आपका, but even in India also we are accepting this one. So credit default swap आपका, protection buyer pay premium, that SBI in our case, protection buyer and आपका protection seller. These are the two cases. So protection seller आपका company who generally commit some sort of guarantee. If that other party will default, we will make the payment. Payment continue until maturity or credit events. Credit event means the date when that person got default. Now it is a time of आपका protection seller to pay the amount or outstanding balance, whichever is earlier. Otherwise, that protection seller will keep getting the premium. Eligible instrument as per RBI, instruments as per RBI. So commercial paper, certificate of deposit, non-convertible debentures, maturity less than 1 year, rated INR corporate deposit, listed or unlisted. आपका unrated INR bond issued by special purpose vehicle for infrastructure companies must be dematerialized and not allowed ABS, MBS आपका and structure obligation, credit enhanced, guarantee bonds, convertible bonds are not allowed in this case. So this is something आपका eligibility instrument. Please do remember these one. They'll help you out in your upcoming examination. Next one. So operational direction for credit default swap in OTC market. No CDS with related party or references entities. As a bank, you cannot enter into a CDS contract with related parties like your subsidiaries and others. No CDS trade violating cash market exposure restrictions. Retail CDS transactions only for hedging, not for speculation. Retail users must exist a CDS within 1 month for seizing underlying exposure. Contract can be excited by unwinding or assignment. CDS contract to be settled bilaterally or by RBI approvals clearing arrangement must be denominated and settled in INR rupee or INR, Indian rupee. Settlement can be cash, physical, auction based. For retail user, mandatory physical settlement. RBI, FIM, DDA, which regulate the money market and all, but the kind of a SRO for money market, will prescribe settlement procedures. So these are some guidelines. Alright, so this is all about the fundamental aspect of this particular one. So very, very important one unit, because this unit will help you in your 2 subjects. Again, that's why we have explained everything in detail. I hope you get these particular thing clearly. Alright guys, so this is it from my side. I hope you enjoy the session. You have learned these particular things. Please do attend these live classes on regular basis. They are definitely going to help you to score, maximize in your upcoming examination. Alright, so this is it from my side. I'll see you tomorrow at same time. So we have done with Module C. Now we'll start with Module D. So this is it. Bye-bye. Take care all. Have a nice day. Thank you.